Regulators
You
are
can
to unlock
have the
pension
economy
capital.
continue to be fairly strong while inflation continues to moderate.
I don't understand the sticky inflation argument. If there is still a recession at some point, the market hasn't priced it.
All of the ingredients are kind of there for a sustained expansion of the U.S. economy.
It really does boil down to that we are simply not slowing down. Where is the slowdown?
It feels like we're in that kind of sweet spot of benign disinflation and Goldilocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Chairman Powell testimony on Capitol Hill, 2 hours away. It is all about jobs data this hour. 15 minutes from now, the ADP employment report a little bit later this morning. Job openings on to tomorrow, jobless claims, then the big one Friday. Bramo payrolls Friday just around the corner.
UK's Chancellor Hunt says I will reform the ISA system to encourage more people to invest in UK assets.
Look, all of the tea leaves are important. The data's been messy. I do think that the JOLTS report, given what we just heard from Kelsey Barrow, is going to be really important to basically either confirm or dispute what we saw yesterday from ISM services.
Torsten's Lock Apollo said reasons to be constructive on Friday.
UK's Hunt says new British ISA will allow an extra £5,000 a year tax-free investment allowances in UK equities.
How long rates have had a 5 handle in America.
If you're looking for weakness, you got to look hard. You got to look at the hours worked. You've got to look at some of the quits rates. You've got to look around the edges at some of the commentary. Given that, this data is getting so much messier because you can pick and choose what you want to, but the overlying headline numbers, strong, strong, strong. Unemployment not picking up. 353,000 jobs created in January. Does that get revised lower, or do we just keep on chugging?
Forgive me for what I'm about to say because it sounds so harsh. If you're looking for weakness, look to South Carolina at 10 a.m. Eastern time. Nikki Haley really weak showing on Super Tuesday, and most reports suggesting dropping out later this morning.
Yeah, she'll be dropping out. That's what reporters, even Bloomberg has now reported, following on the Wall Street Journal. You know, Matthew Bartlett said yesterday it's not a presidential campaign, it's a messaging campaign. So the next question is, does she continue the message? And she's got quite critical of the former president in the last few months. Does she continue that messaging campaign, or does she endorse him? And that's what everyone's going to be looking at, because if Donald Trump wants to encompass the whole party, it means bringing her voters along with him. And right now he's not. And that showed last night as well on Super Tuesday.
I'm going to just offer a little hope right now. This is where I basically say we've talked a lot about who is going to be in the race. It's been Trump and Biden the whole time. Now we know definitively it's Trump and Biden. Are we going to hear something substantive and more focus on what their second terms would look like should either of them win? Now that Nikki Haley is out of the picture officially, do we start to shift to really what are they going to be like if they get second terms?
We'll have a realistic conversation then. Let's look to tomorrow evening. All reports suggest that we might hear something from the president about capital gains. I mean, if we hear something from capital gains, that's politics, that's not policy. Because as we've seen over the last couple of years, they can't get it done. They can't get it done when everything's blue. Why are they going to be able to get it done in the next term?
Well, he's going to be playing to a lot of different constituents within his own party when the president speaks tomorrow evening. A number of things he's going to want to talk about, especially taxing the rich. When you talk about policies that could remain the same under Trump or Biden, tax cuts, not for everyone, but definitely those under $400,000, maybe $500,000. Democrats, maybe you could see a slight inch up higher in corporate gains, but it completely depends on the shakeup of the House and the Senate. And what Lisa's talking about, and some of the analysts you've seen, it looks like a mixed government. It's going to be a divided government. So then you could expect not a lot to happen.
What both leaders will do is spend, 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 because, Lisa, that's exactly what they have done over the last 8 years.
Okay, so if that's what happens, then when do you get the bond market pushback? I do think, again, fiscal is so important. We hear that from everybody, that that's been the driving force. So at what point does that end? And if it doesn't, when does the bill have to get paid?
Taxes and tariffs. You're going to hear a lot about that in the next few months. Equity futures right now on the S&P, session highs up by 0.5% on the S&P 500. Jobs data just around the corner. In the bond market, yields lower by a single basis point.
FTSE 250 index ticks higher as Hunt delivers the UK budget. Last up 1.1%. And keeping an eye on cable as well. That's paired some of its gains. It's just close to flat on the session now.
Ira Jersey of Bloomberg Intelligence reacting to ADP data, and PGIM's Tom Porcelli previewing Friday's payrolls report.
It's in 10 minutes time now at 8:15 a.m. Eastern time. See the release of the US ADP employment change for the month of February. Forecast 150k, prior 107k, with a range of 200k to 75k expected. It's been the first of the US employment reports this week.
A higher degree of confidence before rushing to cut rates. We view rate cuts will likely be appropriate in 24, and we believe that a June 1st cut is realistic. Kate Moore joins us now for more. Kate, great to catch up with you ahead of this testimony from Chairman Powell. We've pushed out the timing of the call. We've reduced the magnitude, and stocks have done okay. A theme for us this morning is just how important, how relevant is monetary policy to this equity market as we speak?
I think people are still fixated, of course, on inflation and on kind of the messaging and tone from monetary policy decision makers. That said, if you kind of look at the internals, John, and what has been performing within the equity market, it has been fundamentals that have been driving stock prices much more than just expectations around inflation. So when we initially got excited about inflation coming down, a disinflationary trend, and rate cuts in 2024, there was a pop in some really kind of lower quality stuff that was getting hit hard on higher rates for longer. But what is performed today and what is performing right now in this market are companies that are putting up good numbers on earnings, that have been raising guidance, and that have very strong fundamentals. So look, we're going to talk about it till we're blue in the face. Inflation and Fed policy and parsing all of the speeches is going to be what we do for hours on end. That said, we really have to focus on what companies can perform in this economy in order to make money.
Okay, for years you and I were talking about pricing power. When inflation was high, they had this ability to kick up prices and boost margins. Have you been impressed by their ability to preserve margins given the backdrop currently?
Yeah, John, I think you're asking this question because you know I have great faith and confidence in the U.S. corporate sector to continue to maintain margins, even through lots of last year where prices were rising and where there was a lot of strain. We saw companies continuously focus on maintaining margins and think about strategies that would allow them to expand their margins in 2024. I'm actually very optimistic, and I think this is the consensus of a lot of analysts on the street, that margins will gradually expand over the course of this year as prices come down and as companies continue to have this laser focus on maintaining and expanding margins. This is going to be critical for the fundamentals, and as I said, the fundamentals are going to underpin equity risk and sentiment, I think, for the balance of this year.
So your overweight risk assets, strongly overweight risk assets, piling on, shrugging off all the bubble talk. Are bonds a good diversifier? Or right now, are they the toxic ones at a time of concern about deficits and inflation being stickier for a longer period of time?
Yeah, look, we have a significant portion of our portfolio in bonds, but we're not massively overweight when it comes to, say, treasuries. You know, we're seeing a more opportunity in the credit side. I think the fixed income plays an important part in a balanced allocation portfolio. That said, there are lots of parts of fixed income that are more attractive than others. And we've used cash as a tool aggressively over the last, 12 to 18 months. We're seeing more alternatives and currency opportunities as well. So I think we need to think holistically about the asset class opportunity set, even though, Lisa, you know this, I'm very constructive on equities for the balance of the year. We're going to get this periodic pullbacks, but I think that is where you're going to deliver the bulk of your returns for a multi-asset portfolio.
Kate, I've been putting together a project where I'm trying to collect all the worries and put them on a list and then tick them off as people basically shrug them off. Do you have any to put on the list?
Of course. I mean, I barely slept last night thinking about all of my worries. No, Lisa, for sure. There are a couple of things that really concern me. One of the things I'm focused on, and we were paying attention to this with Target reporting yesterday, was what is the true health of the U.S. consumer? Some of the data gets masked by the higher end, or we'll think about the upper 2 quintile of earners. Does low-end consumer continue to show cracks, and what does discretionary demand look like? I worry a little bit about that. I frankly worry a little bit about the election cycle having an impact on overall spending. We've seen in previous election cycles that companies pull back or hold back on non-essential CapEx as they're waiting for, trying to figure out who the next administration is going to be and what that policy will look like. So I worry that that could have a dampening effect on overall economy. And then I worry a decent amount around the impact that geopolitical risk and geopolitical tensions could have on multinationals in terms of their overall operations. Does any of this take my enthusiasm out of the S&P and NASDAQ? Not fully, but I think these are things that could be risks for certain sectors as we look through the year.
Okay, I was going through your old calls at the end of last year. Credit where it's due. Top favourite markets US 1, Japan the other.
In 5 minutes time now at 8:15 a.m. Eastern Time, we see the first US employment report of the week with the ADP employment change. Forecast 150k on the prior 107k, with a range of 200k to 75k expected.
And there was also a large positioning and technical component, John. You know, Japanese equities have been underloved for some time. We continue to see, stronger growth across Asia and with some of the trading partners that we thought would bolster earnings across the Japanese corporate sector. And we, like a lot of people, remain hopeful that we will continue to see a change in BOJ policy over the balance of this year, which will change sentiment for the overall asset class. I will say U.S. is our largest overweight by a long stretch, and that's where we're taking our concentrated equity risk. But I think Japan continues to bear some fruit, and we'll continue to have an overweight there through coming quarters.
Some pretty decent fruit, that's for sure. Kate Moore of BlackRock, congrats on the call. Big call. Japan, just massive outperformance year to date so far. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Republican presidential candidate Nikki Haley is said to end her campaign after poor showing in a string of primary contests, setting up a rematch of the 2020 election in November. Haley is due to speak in her home state of South Carolina at 10 a.m. Eastern. Former President Donald Trump swept the Super Tuesday primaries, winning all races except Vermont. Tesla's factory in Germany remains closed after a fire at a nearby electricity tower halted production, adding to the car maker's strains. The company said it doesn't know when production will resume at the factory, which makes about 6,000 cars a week. Tesla stock has fallen almost 11% just in this week alone, driven in part by a plunge in shipments from its Shanghai factory. House Speaker Mike Johnson will host the parents of imprisoned Wall Street Journal reporter Evan Gershkovich at the State of the Union. Ella Milan and Mikhail Gershkovich will meet with Johnson privately before President Biden's address. He was detained by Russian authorities almost a year ago and has been held on allegations of espionage that he, the Journal, and the U.S. government denied.
UK's Chancellor Hunt says defence spending will rise to 2.5% of GDP when possible.
Danny, thank you. Up next on this programme, ADP
says we need a more productive state, not a bigger state.
What we expect to get from the payrolls is a sequential cooling from the very hot print that we saw last month, but a still robust payroll print.
The ADP jobs report coming up next. You know, the one that people say doesn't really matter and then it depends what happens, and it kind of does for 5 minutes. That's coming up next from New York. This is Bloomberg.
UK's Hunt says I will keep planned growth in the day-to-day public spending at 1% in real terms.
Was going to keep Green World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley.
1 minute remaining for the US ADP employment change.
Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
Live from New York City, equity futures rallying into the ADP report. Futures positive by 0.5% on the S&P, and the NASDAQ 100 up by
140k, 140k, lower than forecast 150k.
Previous number 107 in the bond market. The scores going into that.
The breakdown, so again, US ADP February private employment, that's up 140k, which is lower than estimates of 150k. Goods producing jobs are up 30k, as noted. Service producing jobs up 110k is the breakdown.
But you've got to remember, ADP doesn't match up very well with what the government provides us on Friday. 140,000 jobs is what they see were created in the month of February. That is up from 107, which was their initial print last time. The forecast for the Friday jobs payroll report is over 200,000. Now, ADP doesn't contain government jobs, so they're not going to match up exactly, but the track record is they've been way off in recent months. Of course, 107,000 last time, and we got 353,000 for January payrolls. The other news that they put into this is their new pay numbers, and the median change in annual pay for job stayers, 5.1%, for job changers, 7.6%. So not a lot of slowing in that. It'll be interesting to see how this compares with what we get on Friday, guys, because, of course, the Fed would be looking for numbers more like ADP's than what we've been getting from the Bureau of Labor Statistics.
So Mike McKee's been really diplomatic about this. But
So
I think
stock index futures are holding steady after that February ADP employment data, slightly cooler than expected.
S&P, I'll turn to the bond market briefly. Give it the scores as you were. We're down about a basis point on a 2-year, 454 on a 10-year, down 2 basis points. Just a small break of 414 here, 413.50. Mike, perhaps more instructive is the data that we got yesterday.
So the US urges Seoul, South Korea, and Berlin, Germany to limit China's access to chip
and it
tech.
drops back into contraction territory. Mike, can you tell us how important that read actually
We
is?
have posted out the US ADP employment change February report on the feed for anybody interested.
Translates into any kind of drop is hard to say because they don't match up exactly, but it does suggest that the hiring process has leveled out and maybe might even be sort of frozen at this point. We got down to 48 for services industry hiring, and of course we have seen negative numbers for manufacturing hiring. For many months, companies were just hiring anybody who would walk in the door, and now it seems they've probably filled up their payrolls and they're waiting to see what's going to happen with the economy. Interesting number out this morning. The Business Roundtable CEO confidence level reached its highest in 2 years. So maybe we'll start to see hiring pick up again if the CEO's attitudes are any indication of where the economy is going.
Let's talk about whispers, given the fact that we've seen some conflicting data with respect to the labor market. How has that affected the whisper number for the jobs report that we get on Friday at a time where we got, for example, Torsten Slok this morning saying there's reasons to think it's going to be a really positive February number?
Well, it is kind of interesting, Lisa, because in previous months we've seen the whisper number significantly higher than what the forecast number is, but that's not the case this time. They're only slightly, Wall Street's only slightly above where the forecast of their economists is. So it may be that we're seeing some sort of coming together in terms of this whole idea that maybe hiring has slowed somewhat. Whether we see a significant decline from 353 or whether we get 200 or over, both of those outcomes are not what the Fed wants to see. They'd like to see it even slower. So if you're looking for a hawkish signal one way or another on Friday, it would be the strength of payrolls.
Mike, I love today because we get a whole host of data and we're going to hear all these people telling us why it doesn't really matter, and it just sort of pushes us in the muddle that we're in. Does Fed Chair Jay Powell's testimony matter? We're going to be getting that later this morning at a time where a lot of people say there's nothing to see here. He's basically going to come out and say they're in no rush and repeat what he's already said.
That's pretty much what's expected. There's no percentage in it for Jay Powell to change any kind of testimony, any kind of pattern that the Fed has adopted. And as you mentioned, everybody on the Fed has basically said the same thing. We need more evidence that inflation is going down. So I would expect that's what you get out of the written testimony. Now, what do we see in the Q&A? Maybe depends on how things are phrased. Every once in a while, something drops. So that's always a possibility. You got to pay attention to everything he says. But I wouldn't think he's coming into this to make news.
Interesting. Mike, thank you. Mike McKee, stay close. Mike McKee's going to stand by because the last few times we've had Powell's testimony on Capitol Hill, the pre-prepared remarks have been released around 8:30 Eastern time. So I think that's something we're all going to look out for in about 10 minutes to see if we get a repeat of that. So we'll catch up with Mike again in just a moment. Let's go through that
In 10 minutes time now at the bottom of the hour, see the release of the Canadian labour productivity rate quarter on quarter. Forecast 0.18%, prior minus 0.8%.
111. And since there's nothing to see here, this equity market rally continues by 0.5% on the S&P 500, on the NASDAQ higher by 0.9. This is a bounce back from yesterday's losses and maybe a bit of an appetizer for the jobs data you'll get later. Job openings coming later this morning, jobless claims coming tomorrow, then on to payrolls on Friday. Lisa, even with that negative print in the ISM report, the employment component of it for services, payrolls, the estimate in our survey, can change of course, is still 200k.
And we're hearing that. We heard that from Cara Gadano. We heard that from Torsten Slok, that the expectation is for a stronger labor market report than some people are even expecting. Is services specific to really just this issue of trying to gauge whether things can go further rather than a real test to the overall economy?
Let's get some commentary from Ira Jersey of Bloomberg Intelligence, some reaction to these jobs numbers and a preview to Chairman Powell later on this morning. Ira, your thoughts on what we got from ADP and ultimately what we heard yesterday and what you're looking for on Friday?
Yeah, so I agree with what you had said before, John. You know, this is a come and go kind of number, especially since it's usually overshadowed by the payrolls report. Importantly, what I'm looking for on Friday is you know, even if we get a 300 print or 150 print on payrolls, yeah, that'll catch some attention. But it's really the job data, the wage data, as well as the hours worked, because you know what's keeping and propping up the economy right now is consumer spending, and consumers, as long as they can continue to get raises and continue to have disposable income increases, they'll continue to spend some of, at least a large portion of those wage gains, and that can keep the economy going for much longer. And I think that's something that will need to be addressed today by Chair Powell. So
U.S. Treasury 10-year yields dip after the ADP jobs data. Last at 4.138%.
Of those prepared remarks, but it is the Q&A, like Mike McKee just mentioned. The Q&A is what matters, and when you look at the bond market and where all the volatility stems from, it's usually some off-the-cuff comment that occurs sometime between 10:30 and 12 when Powell's asked some crazy question and kind of has to answer off the cuff.
Is it 30 minutes, Ira, that's how long it takes for him to get annoyed with them and just start saying things?
Well, you get the committee chair, the committee vice chair, the one of the subcommittee chairs. They all make their opening remarks. Then Powell does his opening commentary, which you know we'll already have had for a couple of hours by then, and then finally around 10:30 is when the first round of Q&A will start.
Which is when he will be sufficiently tired and irritated to basically just say what he thinks. I am curious what it would take to break out of this range of say 410 to 430 on the 10-year yield, based on testimony that people aren't expecting a lot from.
Yeah, I suspect it won't be toward lower yields, because I think that Chair Powell is going to probably be a little bit more cautious about when they're going to start cutting interest rates, and that will prop up Treasury yields a little bit, so prices down, yields a little bit higher. But it would take him being much more dovish, right? So in order to get down below 4% on 10-year Treasury yields, I think he would have to suggest that they see a more pronounced slowing in the economy than most of us see in the hard data that's coming out, right? You guys have talked about yesterday's ISM employment report. One of the interesting things that's been going on that we've highlighted over the last few weeks is you have the hard data, so things like payrolls and retail sales and that look pretty good, whereas the survey data, so the way people feel, has started to roll over a little bit. You have some chinks in the survey data, but people don't necessarily do what they say, right? And people are still spending money. People still have jobs. People are still hiring, even if it's not at the same pace that they were a year ago. So the economy is being propped up. So I suspect for the long end of the Treasury market, we're going to kind of hang out here. Whereas things like the 2-year yield, that's going to go up and down just based on, hey, is the Fed going to cut all the way to 3.5%? Or are they only going to cut to 4%? That's where you'll see the front end can be much more volatile than long end Treasuries at this point.
Ira, typically we frame this as a grilling on Capitol Hill, and every single time we get it wrong. How political is this going to be ahead of the State of the Union tomorrow evening?
I think it's going to be pretty political. I mean, you'll have things like just this morning, you had a letter from two Republican senators. He's in front of the Senate tomorrow. He's in front of the House today. Yeah, you know, the House members tend to be very political. They all get a very short amount of time. In fact, it usually takes like 3 minutes for someone to ask a question because they're trying to grandstand, and then Powell has 15 seconds to say yes or no, effectively to some.
US WTI crude futures rising by $1 a barrel to $79.15 now. So WTI futures currently up around 1.3%. That brings us now to 5 minutes away to the bottom of the hour, where we get the Canadian labour productivity rate for the quarter. Forecast 0.18% on the prior minus 0.8%.
Ira, thank you. Andrew's Holland Horse, City, just writing this one. Mr. Powell goes to Washington. This is what he's going to do, apparently. He is likely to push back against some calls to lower rates by emphasising that the Fed plans to cut rates later this year, but will proceed patiently and carefully to guard against re-accelerating inflation risks.
What I find interesting is it going to be Democrats and Republicans on the fringes both being on the same level, saying cut them aggressively. Really, I mean, it's at a certain point start to converge.
I imagine there's some Republicans that would quite like another few hikes going into the election.
Sure, yes, right. Maybe like...
I'm not sure those calls for cuts will quite be as loud as the other side of the aisle. Coming up next, PGIM's Tom Porcelli looking ahead to Friday's payrolls report and a preview of Chairman Powell. That's next. This is Bloomberg.
UK's Chancellor Hunt says cutting capital gains tax on residential property to 24%. The UK's Chancellor Hunt says extends the UK windfall tax on oil and gas companies by 1 year. So just keep in mind with regards to Fed's Powell's testimony, which is happening again at 10 a.m. Eastern Time today. So at the bottom of the hour now, so at 8:30 a.m. Eastern Time, we are looking out for a potential early release of the text for his testimony. So again, the Fed have already released Fed's Powell's monetary policy report. This came out on March the 1st. However, there is a small chance that we could see the text release early from Powell, again at the bottom of the hour. We're just keeping our eyes out for this nonetheless.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture.
UK's Hunt says will abolish current tax system for non-domiciled taxpayers.
And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after.
There's 1 minute remaining for the Canadian labour productivity rate, and also again possible text release from Fed's Powell.
Together, and one day you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch. plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
10 seconds.
The ADP report already very, very stale. Came in at 140. The estimate was 150k. Equities near session highs. Going into Chairman Powell's testimony, we're positive by 0.5% on the S&P on the NASDAQ.
So seeing an early text release from Fed's Powell here says we do not expect it will be appropriate to reduce the policy rate until we have greater confidence that inflation is moving sustainably towards the target. We will carefully assess incoming data and the evolving outlook and the balance of risks. Economic outlook is uncertain. Ongoing progress of 2% not assured. Says the policy rate is likely at the peak of this cycle. Says will likely be appropriate to begin dialing back policy restraint at some point this year. The economy has made considerable progress over the past year on the dual mandate and says while inflation is still above 2%, it has eased substantially. Risks to achieving dual goals are moving into better balance and labour demand still exceeds supply. Nominal wage growth has been easing. Fed's Powell adds the Fed's restrictive stance is putting downward pressure on economic activity and inflation, and the labour market remains relatively tight. Says risks to both cutting rates too early and too fast, as well as too late or too little. So again, we did just see the text from Fed's Powell's testimony, which is happening today at 10 a.m. Eastern Time. That was released early. The key comment is he says we do not expect it will be appropriate to reduce the policy rate until we have greater confidence in inflation sustainably moving towards the 2% target. And so markets relatively unchanged following that press release there. Slight weakness seen in the S&P 500 and a bit of strength in the dollar as well.
But no hints about timing, nothing about the balance sheet. The Fed is basically on autopilot here for the testimony of the chairman, which is only about 2.5 pages long. So it is going to be, as we said earlier, the Q&A that will provide any news that we might get.
And no big moves in this market either. Just to go through them for you, starting with stocks. Equity still positive by 0.5%, up by 0.8% on the NASDAQ 100.
We have also posted out the full text of the speech from Fed's Powell on the feed for anybody interested. So Treasuries are holding their gains after Powell says the 2024 rate cut is unlikely.
Like this line, this word, confidence. It's a word that he used, a phrase he used back at the end of January. We've had a bit of data since then. Do you think he's gained confidence or lost confidence based on the economic data of the past month or so?
I think he may be questioning where we might be going. And I think Raphael Bostic from the Atlanta Fed earlier this week is kind of saying the quiet part out loud, that there are signs maybe we're going to see a little more strength in the economy going forward, and that could push inflation up. Obviously, the CPI, the PCE coming in hotter than expected. They are concerned about that if it develops into a trend, but it's only been 1 month. So they're not really going to question their assumptions at this point, but they're going to be on heightened alert.
Mike, everyone's going to be watching and paying attention to this, but it does feel like the Federal Reserve and Fed Chair Powell has been de-emphasized in a market that's looking beyond to the data, to other types of factors and other types of spending. Would you agree with that?
Well, I think at this point there's an awful lot going on up here on Capitol Hill where they're dealing with the budget, they're dealing with the election year. So yes, the Fed has been de-emphasized some. It may be more important from a political standpoint because Republicans obviously don't want the Fed to be aggressively cutting rates into the election because that would be good for Joe Biden. And Democrats don't want the Fed on hold too long because that would not be good for Joe Biden. So in that sense, it matters. But the state of the economy is pretty good. And this is going to be one of those cases where no matter what party you're in, you're going to criticize the other party, but go home and talk about things are pretty good in my district.
Mike McKee, thank you, sir. It's always the way. Playing politics with the economic data. Mike McKee, one of the best down in Washington, D.C., breaking it all down for you. So about 18 minutes ago, we had the data, the ADP report. That came in at 140,000. The estimate was 150. The previous number, a revised 111. Not too bad. Pretty decent. in the grand scheme of things. What does it mean for Friday? Not much at all. But ultimately on Friday, the estimate is pretty lofty. 200k is the median estimate in our survey. Then we've heard from Chairman Powell in the prepared remarks. A couple of quotes for you. Here's one. We believe that our policy rate is likely at the peak for this tightening cycle. If the economy evolves broadly as expected, it would likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress towards our 2% inflation objective is not assured. This was always about gaining confidence, Lisa. He talked about that at the end of January. We've had some data that I would say to some extent, and we can debate to what degree, but to some extent, that data would have knocked their confidence just a little bit.
Which is the reason why maybe someone could read into the idea that they're talking about peak policy rate as taking the idea of another rate hike off the table, which somehow anew entered the conversation after some of this hotter than expected data. Otherwise, this is the calibration that they've been making. It's not telling us a lot of new information.
Tom Porcelli joining us now out of PGIM on the latest. Tom, you've had some time to digest those comments from Chairman Powell, think about that economic data from earlier this morning. What's the big takeaway
UK's
for you?
Chancellor Hunt says we'll cut the main rate of employee national insurance contributions by 2 percentage points from April.
You know, ADP sort of is that tree that falls in the forest that no one hears. I think that there's some interesting stuff in there that we can talk about. And I think Powell, sort of hit one right down the middle, which is exactly what he was supposed to do. I mean, there was no reason to break new ground relative to what he said at the last presser. So I'd love to make this really sort of engaging and, sort of rip-roaring conversation about Powell and ADP, but we'd have to stretch.
Well, but Tom, so let's not, right? But this to me is interesting in and of itself, right? We don't have to. It's interesting in and of itself. I mean, I'm old enough to remember when the Fed was everything, and that's all the people tracked, and that Fed policy drove the markets, Fed policy
The UK's
drove
Chancellor
all
Hunt says
economic
27 million employees will get an average tax cut of £900 a year.
It doesn't matter in terms of restrictiveness, in terms of tightness.
Says the employee national insurance cuts to 8%, self-employed NIs cut to 6%.
Yeah, so I think this is a really important idea, Lisa, and it's something that we've been sort of kicking around. It's if I think about like the home builders, right? If I think about like new home sales.
And UK's Hunt says OBR forecasts that the national insurance cuts will bring an extra 200,000 people into the workforce.
They're hanging in there for, I think, one really important reason. The builders are doing these pay downs, right? They're doing these mortgage pay downs. And if you speak to our home building team, what they would tell you is that it seems that there's some like magical number around 6%. If you offer sub 6% mortgage for a potential buyer, they sort of leap at that. Now, that's interesting to me as an economist because I think, well, okay, mortgage rates on average are around 7% right now. If the home builders are an example.
And Hunt just comments that the average earner in the UK is to have the lowest effective personal tax rate since 1975 now.
75 basis points. Then all of a sudden you're at this sort of magical number. Why is that important? Not so much from hey, let's reignite sales, but let's maybe get some home equity extraction. I mean, I think this, if you think about the amount of home equity that's sort of, in just sort of sitting out there idle, locked, because rates are so high. I think that's where sort of the rubber meets the road on this. I think it's an interesting idea that not a lot of people are talking about.
So, Tom, given that, do you think that the risk of reacceleration in the economy is that much greater?
And UK's Chancellor Hunt says the long-term ambition is to keep cutting national insurance.
With an economy that's being fueled by fiscal stimulus and by consumer balance sheets that are pretty good.
Yeah, balance sheets are pretty good, Lisa. And, I would say, look, we've been in the soft landing camp. I've been at PGIM for 8 months. We've been in the soft landing camp for 8 months and maybe even a little bit longer than that. And what I would say is, when we were thinking about soft landing, we were thinking of it in a range of, call it 1 to 1.5%. But you're easily in the upper end of that range now, and maybe even bleed a little bit north of there. So not making any wholesale changes, just sort of acknowledging that sort of things have come in a little bit better. We do recognize, though, so one of the things I've been saying is, look, so sure, 24 I think is going to be a good year. From a growth perspective, full stop. I do think it's worth remembering how it's basically being driven. And it's being driven by credit usage, and it's being driven now by a drawdown in the muscle of saving, right? Forget about excess saving. Right? We all appreciate that's long since gone. But if you look at sort of, the pool of saving that exists now, and if you look at that relative to, where you would have been had the pandemic not happened, you're getting below that now, right? So you're cutting into saving muscle.
And the UK's Chancellor Hunt has now finished the spring budget.
How sustainable is that really? Can you continue to sustain that over the coming couple of years? And the short answer is you sort of can. I mean, you can continue to drift into that saving muscle. You can continue to.
The UK plans £265 billion in gilt sales through this year to next year versus £258 billion previously. So again, an increase in the amount of UK planned gilt sales throughout this and next year.
Three-cut camp for a while. I don't think of that as anything other than this is sort of the Fed just sort of right-sizing policy, given the fact that inflation has slowed.
Right-sizing policy to where it may end, which might be, say, 4.75%.
And the UK OBR adds that a medium-term economic outlook remains challenging.
This is where I was going to go. When you talk about credit, you're referring to
So the Office for Budget Responsibility in the UK says living standards are expected to recover more quickly than they forecast in November and grow by around 1% on average over the forecast.
When it comes to understanding investor pushback.
Yeah, I think the reality is, this is one of the benefits of being
The OBR also expects nominal average pay growth to halve in 2024 as UK inflation falls and the labour market loosens. Says the level of GDP in 5 years is virtually unchanged from the autumn budget, and the level of GDP per person is seen as slightly lower. OBR notes that overall outlook for public finances is also similar to November. Recovery in output is largely driven by a pickup in household consumption growth to around 2% from 2025 to 2028.
Going forward, I think it's going to be very difficult for fiscal policy to really provide any meaningful sort of thrust. Short of providing consumers with some direct stimulus, which, as I think we all appreciate, is simply not happening. So I don't know that you get a lot of additional fiscal
The OBR, a real GDP per person, is forecast to trough at 1.25% below its pre-pandemic peak in the first half of this year.
Well, to Lisa's point and almost obsession with this, what would happen first? Would fiscal policy be changed because of an issue and a mistake that potentially could happen in the bond market?
So here's an interesting thing that I think everyone should sort of keep in mind. Recessions make fast friends of politicians. I mean, that's sort of almost always the case. And again, we don't have one built in right now. We have relatively elevated.
UK's OBR adds the latest data suggests that post-pandemic rise in economic inactivity is likely to prove more persistent than we previously thought.
Proposition is mostly because we're acknowledging that maybe there's a risk that the Fed does not cut at all.
UK's OBR forecast £8.9 billion headroom is a small fraction of the risks around the central forecast.
That no politician, whether it's a Democrat or a Republican, likes to endure recession.
So UK bonds hold on to their losses after the DMO remit. 10-year yields up 3 basis points at around 4.0%. So again, that's UK 10-year yield up 3 basis points at 4.04%.
True. Hey, Tom, before you go, I just want to get your thoughts on payrolls on Friday. What are you and the team looking for? What should we be focused on?
Yeah, Jonathan, I think it could actually be a really sound number. I mean, we think it could easily be 250,000, which I think was probably above consensus last I looked. I don't know that I'm a big believer in that, though, Jonathan. I would stress I think that there is some seasonal quirkiness going on here. I think once you get to the March number, I think
UK OBR says fiscal forecast is also conditioned on the tax take rising to near record highs.
I hate average hourly earnings, honestly. It's just such an incomplete measure of wage dynamics.
Why, Tom? Why?
I always look at average because average weekly earnings is
and UK's OBR says market participants now expect a sharper fall in interest rates than they did in the autumn.
So if you actually had a setup where hours fell by more than average hourly earnings rose, then average weekly earnings was down. And that's exactly what happened last month. So to me, that's the right way of thinking about wages, and that's what we'll be focused on.
Interesting, Tom. Love that. It's good to catch up, sir. It's good to see you. It's been too long. Tom Porcelli there of PGIM breaking down the jobs data. 140 a little bit early this morning, 140K in the ADP report. The estimate was 150. Looking ahead to payrolls later on this week on Friday, 200K there is the median in our survey. So that's the consensus call, if you will. We're looking for 250 over at PGIM. If you're just catching up with us, we got some prepared remarks from Chairman Powell as well. These are the comments we've had from the chairman going into this testimony on Capitol Hill. Day one in front of the House Financial Service Committee, a little bit later this morning, 10 a.m. Day two tomorrow in front of the Senate Banking Committee. Here are the quotes for you. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook outlook is uncertain, and ongoing
The
progress
UK
towards our
budget
2%
decisions give
inflation
away
objective is
£12.7
not
billion in
assured.
2024 to
Lisa, again,
2025
this word
and
confidence
£10.4 billion
coming from the
in
chairman, a lack
2025 to
thereof.
And what's
2026.
going to give them that confidence? Remember all those times we were asking, is anyone going to ask them that? Are they going to give any insight into that? And the answer is no. And basically, we're probably not going to today, and probably no one will even ask them about that. But that really is the key question. What will be the threshold to get them over and have that confidence?
I hope that question is asked. Otherwise, what's the point? Equity futures going into the opening bow, 46 minutes away. Futures are positive and near session highs up by 0.5%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. government is pressing allies to further tighten restrictions on China's access to chip technology. Washington wants the Netherlands, Germany, South Korea, and Japan to limit Chinese access to exports and repairs of specialized chemicals and equipment critical for making semiconductors. Sources say Tokyo and The Hague have reacted coolly to the latest push, arguing they want to assess the impact of current curbs. Senator Bob Menendez has been indicted again in connection with an ongoing bribery. Federal prosecutors added obstruction of justice charges to existing criminal counts against Mendez
So
and
the
his
UK
wife.
10-year
Many
gilt
Democrats
yield
have
rises
called
after
the New
the
Jersey
UK
senator
budget
to
and
step down
borrowing
after he was
forecast
initially
last up
indicted last
4.9
September.
basis points at
Meanwhile, independent
4.061%.
Arizona Senator Kristen Sinema has announced she won't run for a second term. Her decision ends the possibility of a turbulent race in one of the nation's most politically competitive states. Wells Fargo is set to unveil a new credit card aimed at competing with the Chase Sapphire Preferred program. Sources tell us the firm is planning to add $95 per year travel-focused card to its roster as soon as this week. Wells Fargo will also add transfer partners, including Air France, British Airways, and Choice Hotels to its reward platform for the first time. The new card is part of the CEO Charlie Scharf's mission to make Wells Fargo a bigger player in the consumer space. That's your Bloomberg Brief. John.
Danny, thank you. At this point, why doesn't a bank just buy an airline? Or why doesn't an airline just buy a regional bank?
100%.
You know, why don't they just get it done?
I think about this all the time.
Same industry.
What is this
get it
dance?
over with.
Exactly. I mean, are we flying something, or are you basically flying a credit card?
Stop pretending you're in the flying business.
Exactly.
Buy Spirit. Or not.
Well, I don't know. Well, let's see.
Will they let that happen?
Maybe they'll
I don't
ask
know.
about that on
Big
Capitol
ideas
Hill.
coming up on this show. Up next, Chair Powell, day one.
We've gotten strong data, but we want to look at things not just 1 month, but we want to look at them more holistically. What I'm watching for is the risk that they're re-accelerating. And right now, I still see that risk of re
levels is 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Celebrating the good old days, just around the table. The days when Steve Raschuta had to go down to Washington, D.C. to watch the testimony himself because there was no internet.
Yeah. Go to the public records.
I was saying I heard some great stories about that. I remember covering the ECB and the old Bundesbank reporters talking about how they used to go to the decision and then run to the payphone. Gen Z's watching thinking, like, what are they talking about?
What is a payphone?
Payphones? Unsurveillance this morning. Chair Powell, day one.
We've gotten strong data, but we want to look at things not just 1 month, but we want to look at them more holistically. And so I think what you're seeing is inflation that has come down a lot. Core PCE and headline PCE both have 2 handles on them as it relates to the year-over-year rates. I mean, that is a lot of progress from just a year ago. What I'm watching for is the risk that they're re-accelerating. And right now, I still see that risk of re-acceleration as fairly low.
Here's the latest. Powell set to speak in just over an hour in front of the House Financial Services Committee. The Fed chair saying in prepared remarks, quote, "We believe that our policy rate is likely at its peak for the tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain and ongoing progress towards our 2% inflation objective is not assured." Steve Raschuta of Mizuho with us around the table for more. Steve, we won't talk about the good old days. We'll talk about the next couple of hours down on Capitol Hill. What are you expecting from the Fed chair?
He's got to walk a fine line. He knows he has to walk a fine line. He's capable of doing it. The problem really becomes when he gets off into the weeds. You know, when he's answering a question and he starts to deviate from script, then the Jerome Powell comes out that the market loves. And that's a Jerome Powell that wants to maximize social welfare. It's a Jerome Powell that really likes the idea of keeping the labor market tight as long as the markets allow them to do it. And let's be honest, where 10-year notes are right now is telling you the market's inflation expectations are still anchored. So there's more likely that if he's going to skew towards 2 rather than 4, rather than 3, or 4 rather than 3, I think there's more likely Jerome Powell's inside nature leads him towards 4.
You've touched on something really quite revealing. Are you saying that Chairman Powell instinctively just wants to make people happy? Because that's what we've heard on this program before.
I don't think he wants to make people happy. I think he looks at his job and his dual mandate, and the dual mandate essentially requires the Fed to maximize social welfare. If you think about it, we want full employment and low inflation. That's maximizing social welfare. And he really takes that seriously. And to a great extent, let's look at where we are. We've got an economy where the labor market is tight. It's been tight for a very long period of time. We've got a market where inflation expectations are low, and they remain low, and yields as a result at the long end of the curve remain low. So why wouldn't you be happy? To me, to a certain extent, this is a bit of a victory lap for them. They're getting what they want. Why upset the apple cart?
I feel like this is kind of kabuki theater. Everyone's talking about the Fed's testimony, but no one actually cares. Why does no one care about this particular testimony?
Well, I think the whole nature about this particular testimony is the fact that we know at the end of the day there's going to be a meeting very soon. And at that meeting, we're going to have a new summary of economic projections. We're going to have new dots. So a lot of what comes out of this is believed to be sort of old information. We don't expect them to cut new ground in here, where a few weeks from now, we're going to be cutting new ground. In fact, the Fed is going to distribute to all the primary dealers later this week, if not today, the questions that they want us to answer before they go into their deliberations. So everyone knows and is waiting for that, and everyone's waiting for payroll employment. So this is kind of like responding to old news. It's a little bit like the JOLTS data. You know, it's January JOLTS. We know the labor market was tight in January, so the probabilities are the JOLTS data for January will be healthy numbers.
So, and forgive me, but then what will jolt this market, right? If we're looking right now at data points that are backwards looking and that are confusing, you've got Fed officials who are basically not telling us anything. What will give us some sort of lodestar to kind of guide to some new economic narrative that sticks for longer than 3 minutes?
I don't think you're going to get that until you get closer and closer to results of the election. To be honest with you, the period we're in right now kind of reminds me of the period that we had during George Sr. Bush as president. He had done a lot of the fundamental work to bring long-term rates down, but the market didn't care. The market just kept long-term real rates high. And that was one of the reasons why he lost the election. And the reality is when Bill Clinton came along and changed the fiscal narrative, suddenly we all cared, and long-term rates dropped, and we had the Bill Clinton economy that followed on the backdrop of it. Today, I'm sitting here, real rates are very, very low. Overall nominal rates are very, very low. We have a fiscal budget that's out of control. I think once we get into the narrative of what's really going to happen with fiscal policy with the next administration, and we begin to realize that both of these people are going to spend money, and they start talking about tax cuts on top of a $1.6 trillion deficit, that's when I think the real long end of the curve, the real yield to the long end of the curve.
Just as an early reminder then, so today at 9:45 a.m. Eastern Time this morning, do you see the release of the Bank of Canada rate decision and the rate statement from them as well. So our very own Tony is going to be doing a live preview ahead of this, which starts at 9:15 a.m. Eastern Time, just going over the fundamental environment surrounding this release. So if you'd like to watch this live, the live video for that, again, is on the feed if anybody is interested.
So I think you wind up in an environment where we will probably spend all year pushing out the rate cuts. All year pushing out the rate cuts. But they're always going to promise them to you.
And you think we'll end up with what? You think we'll end up with none?
For this year, that's our call. We have none priced in. I have none priced in because I don't know when they can start. And if I don't know when they can start, how can I figure out how many they're going to put in? Because the data is just not there.
Interesting. Team Torsten Slock of Apollo joins with Steve Raschuta of Mizuho.
Yeah, well, I'm just sitting here wondering, when the Treasury market cares, what will it take to sort of care in terms of level? In other words, what level do you see it jumping to?
Well, I mean, if you look at where real yields should be in an environment of a $1.9 trillion structural deficit, as opposed to a $1.6 trillion, let's say round it up to $2 trillion structural deficit, you're looking at real yields that should at least be 100 basis points higher than they are today. So, I mean, eventually, I think there will be that step up. Right now, the biggest risk that the market faces is the market gets the sense eventually that 2% isn't really the real target. Maybe they're willing to accept 2.5%.
Yep.
And if they wind up accepting 2.5%, or that's where we bottom out, then again, the curve may actually steepen from the long end rather than from the front end, as everyone has been anticipating. And that, I think, is the other short-term risk to worry.
Steve, I could kick around this conversation with you all day. This was great. It's great to see you. Steve Raschuta of Mizuho looking for no rate cuts in 2024. Here's your tomorrow. The lineup looks like this. Ed Yardeni of Yardeni Research, Christina Campmany of Invesco, the brilliant, legendary Howard Marks of Oaktree, and Bank of America's Michael Gapin. That's tomorrow. Chairman Powell coming later this morning from New York City. This was Bloomberg Surveillance.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
The top names in tech are on Bloomberg.
There's a natural tension
between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic.
The effective Fed fund rate is unchanged at 5.33% for March the 5th. Also noting the US 10-year Treasury yield falling to a session low of 4.121%.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
From New York City for our viewers worldwide, a very good morning. I'm Menace Cranny in for Jonathan Ferro. We saved the day. It was a pause, not a panic yesterday. We lift this morning. Technologies on the up. CrowdStrike saves the day along with NVIDIA, and Powell just leaves the door open for rate cuts. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
A very good morning. Coming up, Jay Powell staying on message with the chairman heading for Capitol Hill. A muted move in markets as the Fed chief signals rate cuts are on the way. And Nikki Haley drops out, setting up another Biden versus Trump presidential election. We begin with a big issue. Chair Powell singing the same old song.
Powell, sort of hit one right down the middle, which is exactly what he was supposed to do. I mean, there was no reason to break new ground relative to what he said at the last presser. So I'd love to make this really sort of engaging and, sort of rip-roaring conversation about Powell and ADP, but we'd have to stretch.
No reason to break new ground. Mike McKee is with me. Powell reiterating, of course, Mike, good to see you, that they're going to need to see more confidence. And that's the critical word here. They just don't have the confidence to cut just yet. Mike, good morning.
Good morning, Manus. I was expecting you to break into song at the top of the show there. We all know the words. Jay Powell repeating them again today. His press conferences, the Fed statements, it's all the same thing. We believe that our policy rate is likely at its peak for the tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But he doesn't say when that point is, and he warns that the economic outlook is uncertain and ongoing progress towards our 2% inflation objective is not assured. So the bad news for everybody on the trading desk, you're going to have to watch the whole hearing because something may come up in Q&A about timing. There will also likely be questions about the budget deficit. Whose fault is it? How could they fix it? He'll dodge those questions. New banking regulations and capital requirements for banks. That's a bet noir of the Republicans, and they'll probably beat him up a little bit over that. They haven't released those proposals yet, but what we do know about it is that it represents an increase in expenses for banks that they don't like. And then what's the story with the balance sheet? Doesn't talk about it in the statement. The Fed is losing money on its balance sheet right now, not officially, but essentially in an accounting sense. So that may be a concern of some of the members here. They'll probably, Menace, all like the idea that the economy is in pretty good shape, even if they're not getting an answer that rate cuts are coming right away. Certainly the markets did not change their views. You can see May, June, July there, almost no change in Fed funds futures for the speech in the speech aftermath. So at this point, we're all still on hold, and everybody's got to watch the hearing to see if anything changes.
Okay, no reason to break new ground here. Mike McKee, thank you very much. Let's see if the narrative shifts. Let's begin and continue that conversation. Bob Elliott of Unlimited, Jim Bianco of Bianco Research. Gentlemen, good to have you with me this morning. I've got Mizuho in the last 5 minutes coming in. No reason to see a cut on the table this year. Torsten Schlock talks about last week at Apollo. No reason. The risk is no cut this year. Listening to the narrative and how
Brent
tight
crude
this
futures
is,
rising
Jim,
by
can I get to you
$1 a
first of
barrel
all? You
to
talk
around
about a no-landing scenario.
$83.04.
Can I put you down for no cut this year?
Yeah, you can throw me into that group as well, too. I was at 0 to 2 cuts at the beginning of the year, and I'm more closer to 0. And the no landing camp, what it means is what I think Jay Powell's trying to say. He wants to cut rates. He just doesn't have the data to do it. It's too strong. The inflation data, I believe, is showing signs of bottoming, and it's bottoming at way too high a level, near 3%, not near 2%. And the economic data is too strong for him to be cutting rates. So he'll wait, and he'll wait, and he'll wait. And then I think the calendar's going to run out, and we're going to wind up with no rate cut this year.
Okay, so you're joining that band, and of course you talk about a reevaluation of inflation and the interest rate expectations. So good morning, good to have you with us. Let's talk about the no landing, no rate cut scenario. Bob, I take it you're a little bit less keen on joining the no rate cut camp today.
Well, I think the main thing to focus on is the ordering, because the ordering of market conditions is going to determine the Fed's policy. And the way that I describe it is until bond yields rise, the Fed is not going to cut. And the reason why that is that under the current interest rate structure, this economy does have an incredible amount of momentum. Asset prices are reaching new highs. Employment continues to chug along. Income growth is strong. And so what interrupts that cycle is it doesn't just fall on itself. What has to happen is we have to have a rise in bond yields. That rise in bond yields has to start to slow the asset price appreciation, and that has to start to shift the amount of demand coming from consumers. But the ordering matters. So that's why I like to say until rates rise, the Fed will not cut.
But Bob, the rates market has retested near-term highs without any demonstrative hit on the equity market. So are you talking about a more extreme pricing in bonds to the upside?
Yeah, I mean, just think about if you just go back last summer, what we saw is we saw bond yields rise up to 5, and we only got a modest equity correction in response to that, and not nearly enough for long enough in terms of the rate rise to create a drag on the economy. Now, fast forward, we're basically 9 months later, 6 to 9 months later, and asset prices are reaching even higher levels. There's even more positive momentum in the economy. We're seeing actually cyclical upticks in areas like manufacturing, global exports, et cetera. And so in order to get that slowing, at this point, we probably need to move yields back up to the 5 or even higher in order to slow the economy.
Bob, you're sort of trying to give people a little bit of a heart attack here. Jim, come on, join this. What's the risk of, well, I mean, I say that. If markets, could they retest 5%, Jim, in your view, in terms of a yield pop, if this inflation remains sticky? Have a look at 5-year break-evens, gentlemen, and to our audience this morning. Have a look at 5-year break-evens, because that's where the sticking point is for a lot of the swaps traders. The break-evens are perhaps underpinning Bob's hope that we will retest higher ground in yields. Jim.
Yeah, I agree. I think that we are going to do that. And I think that when rates go up, I agree with Bob, that the equity market or the risk markets will have indigestion. Now, one of the reasons that they don't have indigestion now, because you could argue we've gone from 380 on the 10-year note to about 420, is because of what just happened an hour ago. Chairman Powell says, I will cut rates later this year. And the stock market says, okay, I'm not going to quibble about March or May or June. He says he's going to cut rates, start pricing it in. And 16 of the last 18 weeks, the stock market has been higher, underpinning that we're going to see a rate cut. And we're going to see the competition from interest rates come down. Because I think one of the problems the stock market has with interest rates is the long-term prospect for the stock market is about an 8% return. And if you could get 5.3 in a money market fund, I think there's a lot of people who say, I'll take that with a $1 NAV every single day, as opposed to taking risk to try and get an 8% return. So if the Fed cuts rates, we could dust off the TINA argument again and try and push everybody back into the equity market. And that's what it's assuming is going to come. And later this year, if it winds up that the data's too strong and yields go up, I think that then it's going to run into that indigestion that it's not going to get that.
Well, look, I could do battle with you both all day. You know, Team Transitory was wrong. We then have people calling for rate cuts. Various super economists out there calling for earlier rate cuts. Bostic throws a kite up there of one cut and done. But I need to understand, if you're both saying the risk is actually for higher rates, I just wonder then what you make of this. This was a conversation we had with Amy Silverman this morning. In a post-COVID regime, the right-hand tail, right? So the right tail is the new left tail. Basically, the biggest fear for investors is that the upside, not the downside. Now, you're both giving me a view that we could test higher rates, but all the risk, all the momentum in this market is for, my gosh, I don't want to be left out of the upside. So Bob, equity market risk. Do you agree with Amy?
Well, I think if you look at the history of equity market expansions, the way in which equity market expansions end is that, you know, at elevated valuations, it's not because valuations are so high. It's because there's a tightening which pricks, you know, either a bubble or an elevated equity price. And so I think a lot of investors are seeing right now the consequences of the self-reinforcing positive dynamic that exists with an equity market expansion flowing back and reinforcing underlying economic strength. But without that prick, that can continue. And if you look back through time, getting short ahead of the tightening of monetary policy is a recipe for lagging the equity market performance for a long time.
Jim, I mean, this was quite a gripping narrative this morning on Bloomberg Brief, which is, I get it, it's weaponized FOMO. If you're not in, and I'm not in on NVIDIA, I'm not in on the Mag 7, whether it turns into the Mag 5, if I'm not pro-risk, I do run this real risk of getting left behind, whether it's in credit, whether it's in equity, or indeed, for that matter, Bitcoin or gold.
Oh, no, I think you're right. And I think that the Mag 7 has morphed itself into the Fabulous 4 as those stocks have just continued to power higher right now. And people are looking at it and wondering, you know, it's kind of a conflicting narrative because we've got the stock market going up and we've got everybody FOMOing into the stock market at the same time. We've got economists openly talking about the potential of a downturn, the potential of a soft landing or something worse, and that the Fed has to cut rates to respond to it. And those are, like I said, in conflict kind of stories right now. But I think that as the stock market continues to move forward, one other thing that was in that quote was about being a post-COVID economy. What we're learning about the post-COVID economy is the propensity to spend is much higher now than it was, say, from 2010 to 2020. So if the stock market goes up and gives you unrealized gains, you're going to spend more of it. And spend more of it is going to push the economy higher and is going to put a bid for prices, which is a fancy way of saying inflation's going to bottom and inflation might stay sticky. Because unlike 2010 to 2020, when the stock market went up, we were just satisfied that our brokerage statements were larger. Now we're going to use some of that money and we're going to spend it.
Okay, well, we need something to supplant perhaps the COVID rush that we had. Bob, Jim, stay with me. More work to do. Bob Elliott, Jim Bianco. My guest this morning, joining me now to look at the market ahead of this opening bell, 18 minutes to run, is Abigail Doolittle, as ever, every day. Abby, what have you got?
Well, let's start out with a big winner, and I'm talking about the stock that you were talking about earlier, CrowdStrike, up more than 20%. The cybersecurity firm put up a big top and bottom line beat. They also put up a forecast for both earnings and revenues that was better than what analysts had forecasted, and they are taking market share. This quarter that they just posted is in stark contrast to Palo Alto Networks, which really plunged. Palantir, the data company, up 9%. They won a $178 million contract from the U.S. Army for their tactical intelligence targeting access node. This is mobile ground stations powered by machine learning and, yes, you guessed it, AI. And then Estee Lauder down 2.3% off the lows, but nonetheless down on the news, the report that acne products in the U.S. are found to have a cancer-causing chemical in them, benzene. Some of this is apparently in their Clinique brand, Manus.
Okay, skincare is the alpha. Abigail, thank you very much, Abigail Doolittle. Coming up, Nikki Haley concedes as Trump dominates Super Tuesday.
There's never been one like this. There's never been anything so conclusive. This was an amazing night, an amazing day.
Inching ever closer to the Biden-Trump rematch. The conversation next on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
They call it Super Tuesday for a reason. This is a big one. And they tell me, the pundits and otherwise, that there's never been one like this. There's never been anything so conclusive. This was an amazing night, an amazing day.
A Biden versus Trump rematch, it's all but set. Nikki Haley speaking at the top of the hour, where she's expected to suspend her presidential campaign following a rough Super Tuesday. The former South Carolina governor managing only a token victory in Vermont, with Donald Trump dominating in the other 14 contests. Amory Hordarn joins me now with more. There's no irony that Nikki Haley won Vermont.
Well, no, that's the point, right? This was a token win, and she's obviously seeing the writing on the wall. She has no path. It's pretty much been this way, but she said she would go through to Super Tuesday, and she did. And now she is going to be backing out. One key nugget we learned from the Wall Street Journal reporting, Manis, is that she is not expected when she speaks from her home state of South Carolina, and she says, I'm no longer going to pursue this. She is not expected at that time to give her endorsement to the former president. And that is what everyone is going to be waiting on. The first question was, when is she going to back out? We have that answer, and now it's whether or not she is going to endorse the former president. And, you know, he really does need her endorsement in the sense, if you look at the voters she was able to pick up, you could see in some states, Trump is behind 40%. That's how much she is getting. To encompass the entire party, he needs to bring those Nikki Haley voters along, and that's going to be his steep climb as we head into November.
So that's about party unity. And if he needs to pick up these extra votes from her to carry the national vote. And you've pointed this out on a number of occasions. The challenge now is perhaps those undecided voters, for both sides actually,
The question is, those individuals who consider themselves Republican, but they don't consider themselves quote unquote MAGA, and they liked what Nikki Haley was selling. She was not isolationist. She talked about the fiscal health of the United States. Do they go out to the polls and back former President Donald Trump?
Or do they stay at home as a protest vote? That's the other major risk, isn't it?
Yeah, and there's a risk as well on the Biden side. You know, obviously he clearly was the winner last night. He is going to be the nominee going into November. But look what happened in Michigan. More than 100,000 individuals went out and voted uncommitted. The same happened to him last night in Minnesota. That was at 20%. He has a lot of work to do to shore up some parts of his Democratic base. We're likely going to hear him talk a lot about this tomorrow evening at the State of the Union.
You're off to Washington. We wish you well. We'll see you over the next couple of days. Anne-Marie Hordown changes venue and home, but not show. Bob Elliott and Jim Bianco are my guests this morning. Bob, Jim, here we are. You've got 9 months of this, gentlemen, to talk about political risk every day. So I just wonder if we step back for a moment and I say to you, fiscally, to me, both these candidates represent fiscal largesse. Bob, to you, first of all, it would reinforce your 5% call on yields if there really is a fiscal mandate coming, let's say, from the Trump house. But how do you think markets will inch towards the November election?
Well, I think they're probably not going to be particularly influenced by whether the election outcome is either favors Trump or favors Biden. There may be certain individual stocks that might benefit or not based upon the incremental difference in the policy, like higher tax stocks benefiting from a Trump administration. But that's pretty on the margin relative to the fact that both of these presidents, if they were to come into office, they're going to run very large fiscal deficits and be supported by Congress in doing so. And what that does is two things. It perpetuates a support to the macroeconomy and the continued strength.
Yeah.
In addition to the fact of creating all that bond supply to fund those large deficits on an ongoing basis.
Yeah, well, let's see what the ratings agencies have got to say about that, depending on who sits on Capitol Hill. Jim, it's probably a bit too early, and I think you make this point, which is it's a bit too early to put together baskets of higher tax, lower tax companies, or is it?
No, I think it is too early. I agree with Bob that on a fiscal standpoint, they're both going to spend money, and that's going to make the economy stay strong, and that's going to keep the borrowing higher, full stop. Now, where they might differ is when you start getting into non-economic numbers, you know, whether or not you're talking about foreign policy or you're talking about the south border or something like that and how that might impact it. But then again, even if we start getting into those types of things, it's really hard to say one policy differs from the other. So here's a basket of stocks you'd buy one way, or here's a basket of stocks or what you would do with the bond market the other way. So right now, I don't think that this is really playing. I know we like to ask the question, is the Fed really playing in the markets? And the answer might be yes or no. I would actually turn that around and say politics really isn't playing in the markets. But again, it's still 9 months away.
If I said to the two of you, what is a gray swan event from the political spectrum, Bob, what would you say that could look like?
I think the main question is dysfunction and whether or not they can continue to operate the government in a time where we still have divided government and it may become more divisive heading into the election. And that could create second and third order consequences and a drag on the economy if they can't get things like budget and spending done.
And for you, Jim, what would you say could be a grey and disruptive emanating from political landscape?
That the two candidates that we assume are going to be the nominees, that one or both of them doesn't. One's on trial and might be convicted, and the other one is running behind, and his party is very, very upset or very worried that he can't win and that we might see a change. You know, it's a low probability.
Jim, are those low probabilities very left-tail risks?
Yeah, I think so. But I mean, they could really change. They could be very, very disruptive if you see one or the other or both winding up changing between now and, say, the conventions or election day. Low probabilities, but they're worth mentioning. They're still out there. You see them in the betting markets. The betting markets have got them, you know, that there's a non-zero probability that there could be a change.
Okay, well, certainly the two of you have given me food for thought in terms of where we can go with bond yields and non-zero probabilities. Bob, Jim, thank you very much. My guest this morning, coming up in the show, of course, your morning calls. We've got Boca Capital's Kim Forrest joining me saying AI It's the real deal. That conversation next on Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Time for your morning calls. This is what the analysts on Wall Street are saying. First up, Berenberg upgrades Honeywell to buy, highlighting the strengthening in the aerospace business and a compelling valuation. Morgan Stanley upgrades Progressive to overweight, expecting the company to steal at least 18% market share over the next 4 years. And finally, Deutsche Bank upgrades Target to a buy with the street high price of $206. Look at that, we're 170, 120 and change at the moment. So another 20% upside there on improving traffic and good inventory levels. Coming up, Boca Capital's Kim Forrest joins me, unveiling the stocks most likely to benefit from the AI explosion on Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Was a pause, not a panic yesterday. There you go. We're saved. We've got this nice, firm tone to the markets. We've had the prepared remarks from Powell.
So looking now to the market on open imbalance, 415 million to the buy side.
He's not pushing back. He's not joining the Apollo Mizuho, along with my last guess, which is 0 rate cuts in 2024. That is a building narrative. Equities for the moment, Nvidia, we're grand, we're up, we're bid. S&P 500 holding above 5,100. NASDAQ up over 1%. We gave back 1.8% yesterday on this mild whiff of exuberance that these markets were stretched. We're dealing with the elasticity of a rally, and whether you believe the rally that you have seen in Bitcoin, the rally that you've seen in gold, is enough to sustain the overall risk rally. Are you seeing a transfer of rally in Bitcoin and other assets into the equity market? Look at that.
So on the open, noting US stocks extend gains, with the NASDAQ up 1% now.
Record again is where we're heading. And you have gold futures up 0.25%. Again, record highs. We had Schroeder's with us this morning talking about being long gold against that sticky inflation narrative. Yields dropped by 3 basis points. That is a mild reaction to Chairman Powell's narrative. One area that we're going to keep an eye on as ever, every day recently, are the U.S. retailers. It is earnings season. Nordstrom, Ross Stores, and Foot Locker all deliver disappointing results. Abigail Doolittle is with me. What gives with Nordstrom versus Nordstrom Rack? Good morning, Abby.
Well, that is the big difference for sure. And I should note that relative to the stock, we are looking at the worst day since 2022. Some of this has to do with a pretty significant bearish short interest. 18% of the float is short. But to your point on Nordstrom high end versus the Rack, the high end really not doing as well as the Rack. So some analysts are encouraged by the idea that the more discounted area, those stores, could be a bright spot in the future. But the overall forecast on the year, not so great, not a bright spot at all. They're looking for a range of -2% to up 1% versus the previous 12 months. And in fact, for the fiscal year that's starting now, that ends in January of 2025, looking basically at no growth, just down 1% on the top line and down 21% on the bottom line. So this quarter, this forecast, just not enough to get Nordstrom out of the range that it's been in over the last 12 months. Let's call it between about 14 to 24. Now over the last 12 months, Manus, on today's action, it is down.
Okay, Abby, thank you very much, keeping us up to speed on those retailers. Those were the laggards on the other side of the trade. I mean, CrowdStrike, what a belter. The shares rallying today, posting better than expected fourth quarter results. Alex Semenova joins me now. This is the cybersecurity company. Where are they outperforming, Alex? Good morning.
Hey, Manus. So investors clearly rewarding a set of upbeat results here from CrowdStrike. The stock was up as much as 25% in pre-market trading this morning, swinging higher here into the open. This is after the cybersecurity firm reported reported a forecast for revenue and profit this quarter that beat Wall Street estimates. CEO George Kurtz attributed this to a single strategy. That is that the firm offers all of its cybersecurity products on one platform, offering an integrated workflow, unlike rivals like Palo Alto Networks. In fact, during the call with investors, he flagged that Palo Alto Networks actually had been replaced by an unnamed financial services firm in a large seven-figure deal. Those were his words. This comes amid a volatile time for cybersecurity stocks in general. There have been an increase in cybersecurity attacks on firms. Some cybersecurity firms have capitalized on the opportunities while some have sat out. Analysts were really liking the results from CrowdStrike this morning. Morgan Stanley noted that CrowdStrike is one of the few software companies growing 30% this year. Piper Sandler said that the company is positioned to keep outperforming. Shares are up about 18% right now. That is the biggest intraday move since June 2019, and the stock was up 17% year to date through yesterday's close. Manus?
It's a heck of a run, isn't it? Alex, thank you so much. We're also watching Estee Lauder today, the company dropping after acne products from several brands are alleged to contain elevated levels of a chemical linked to cancer, according to a Bloomberg reporting. Simone Foxman has the scoop. Simone.
Yeah, this was a Bloomberg News exclusive from reporter Anna Edney, and it has to do with the results of tests a lab called Valisure, which is based in Connecticut, did on acne treatments looking for the chemical benzene. Now, the FDA allows 2 parts per million of benzene in products. It says that level is safe, but the lab found 12 times that amount in many common products for acne treatments. And then they tested, well, what would happen if you keep these creams at high temperatures for a long period of time, like what would happen in your bathroom if you leave that acne treatment near your shower and that becomes hot. And they found extraordinary numbers here. Estee Lauder's Clinique, for example, 401 parts per million. Taro Pharmaceuticals Proactive, 1,761 parts per million. Target product, also well above the limit. There's a $1 billion market for acne products every year. And, you know, Estee Lauder, for example, really leaning in.
So in just under 10 minutes time now at 9:45 a.m. Eastern Time, we see the release of the Bank of Canada interest rate decision. A forecast sees the Bank of Canada leaving rates unchanged at 5%. This, if realised, would be the 5th consecutive meeting where the Bank of Canada leave rates unchanged. So again, if you'd like some prep ahead of this Bank of Canada rate decision, our own Tony is going through a live video prep at the moment, the link to which is on the feed for anybody interested.
In over a month, that's after being
Elsewhere, just noting the US 10-year Treasury yields falling to 4.11% now. That's being the lowest since February 8th.
Hey, Manus, shares are rising up and around 15%. JD is recovering from a 5-year low, and it's really because the company reported earnings that beat estimates and a $3 billion buyback program that investors are cheering, as you mentioned, and also a 23% hike in its annual dividend payout. So lots of things to digest there. First, let's go to earnings. So JD.com reported a 3.6% rise in revenue. So this was helped by a broader product lineup and price cuts as Chinese customers become a little more price conscious. The company reported sales that came in at 306 billion yen. That's around $48 billion compared to an estimate of 300. And when it comes to the buyback program, this is where investors are really excited about. It's a 3-year program. It's matching the old one that they had, and it's really meant to ease worries that investors are having about the company's growth potential. But Bloomberg Intelligence said that even if we're seeing a 23% hike in its annual buyback, it may not really help because the competition could keep lowering retail profits and also offset the company's strong logistics gain. So the results came after its billionaire founder, Richard Liu, in December said that JD should get its act together and fix its issues. This involves poor merchant support and an overly pricey item list. So recall that in the past, JD.com used to focus more on big ticket items, think electronics and things like that. But recently, it's moved more towards cheaper stuff as retailers feel a little more pinch. As we all know, the growth of the Chinese economy is looking a bit uncertain with its property sector and all the other issues like deflationary issues. So it remains to be seen what happens there. But for now, it's a good day for JD with shares up around 15%.
Okay, Isabel, thank you very much. Well, the markets this morning are digesting the pre-release testimony from Jay Powell. Boca Capital's Kim Forrest weighs in writing this. We believe that the path to to inflation at the Fed's 2% target isn't linear. That's because nothing in markets is linear. Kim, good morning to you. I suppose that's everything except NVIDIA. But let's step back for a moment. We've had the pre-prepared remarks. It's clear that Powell wants to keep the door and the narrative open to rate cuts, and yet I read more and more and have more and more conversations going, I don't know when they can start to cut, and I think they may not be even able to cut this year. Is that too severe a take? Do you think the road to rate cuts is still bumpy but open?
Well, I would take Chairman Powell at his word. On the way up, when interest rates were on the way up, he kept saying, look, we're data dependent. And I don't think he's any less data dependent on the beginning of going down in the rate cut cycle. I think the core PCE keeps falling, and that is in the right direction. I don't think he's going to wait for perfection to wait till the core PCE is at 2%. He'll start cutting sometime, and I hate to say this, soon. What does that mean? I'm saying maybe before June or July at the latest.
What do you think he needs, Kim, to pull that trigger? What do you think he needs to pull that trigger? Because he talks about confidence. I reflect back to 1995. That was a period of time when the Fed talked about carefulness. And again, Bostic flies the kite of only one cut this year and done. So do you think that we're going to morph from this confidence to careful narrative?
I do, because there's some other pressures. Like, we don't live in a vacuum. Europe's rates are probably falling. China is certainly falling. And you don't want to have this unbelievably high rate in America drawing in dollars and making the dollar too strong because of our interest rate, right? So I think that's the pressure he's feeling, and that it's likely a cut will happen before the presidential election gets really going.
Mm-hmm. Okay, so that happens. To what extent are these two things
So in 5 minutes time now at 9:45 a.m. Eastern Time, we see the release of the Bank of Canada rate decision. Median forecast sees the rate remaining unchanged at 5%. If realized, this would be the 5th consecutive hold from the Bank of Canada this cycle.
I think so.
Also, in under 5 minutes time now, we see the release of the Bank of Canada rate statement.
Momentum, right? We have momentum with not only regular people interested in AI, but mostly the people that spend, which is corporations interested in AI. AI is the thing that can and will give businesses productivity, and that's why they're going to invest in it, and that's where the tech dollars are going to go. So it's as easy as I can make it, that's why I believe this is going to be the hot thing. Now, it's not going to be linear, because nothing's linear, and investors are going to be disappointed that in the next 15 minutes, AI doesn't arrive. Yeah. And that's really the narrative about any kind of large tech rollout that we've seen ever in the history of the markets.
So then that, in many ways, justifies the $300 billion destruction in value that you've seen in Apple. I mean, that's the number, a 10% retracement. So we're in that kind of correction mode on Apple. Some people say to me that's a good cathartic moment. It shows you efficient markets. Other people are saying it's an AI corrective moment. When you see moments like that, how do you think? Which justification is it for you?
I think it's a little bit of both. I mean, the new dollars are not going into Apple, right? Or at least they're going in only to support the price that we see. Apple doesn't have like a direct participation in AI, at least that's what investors think. Now, I think they're a little bit wrong. For consumers, in the developed world, Apple is the product that everyone uses, and I think unless they really mess up, which I don't think they are, Apple will be fine in the long run. And by long run, I mean 3 to 5 years. I don't see any other product coming out to replace that. So it could be a node connecting to AI, which is in the cloud. And I think that's the way to think of it. But new dollars are chasing NVIDIA and all kind of things that might be playing, that might get more dollars spent in the near future than Apple.
So people waking up and they check their NVIDIA pre-market at 5 a.m. You get it on the IB. There's an invincibility to NVIDIA, and that will be predicated on the uptake on smart technology. You say, look beyond, look at the software, actually, in fact, look beyond, look at Intel, look at AMD. So you're moving this narrative towards chips to a quasi picks and shovel. I know they're not quite picks and shovel.
Right.
But talk me through that thinking on Intel and AMD.
Sure. So these systems need a lot of processing. One of the reasons I was a software engineer, I worked in AI, and one of the reasons why it didn't work in the 90s is computing power was too expensive. And it's still kind of expensive, but not nearly what it was in the 90s, and data wasn't available. So we have both of those. That's why I have confidence in AI. But I also have confidence that the people building out these new systems need a lot of power, a lot of computing power, and if you can get close to NVIDIA performance at, let's say, half the price, you're going to use that. And that's why I like AMD and Intel, because I think they are building competitive products to what NVIDIA has. And NVIDIA's DNA isn't in offering cheap products.
1 minute remaining for the Bank of Canada interest rate.
Never will be.
I think my favorite line that I've had recently is, what is the poor man or poor woman's NVIDIA? One answer to that was Broadcom, but I think that you've broadened that spectrum for our viewers this morning. I think that's important about where the other opportunities are. Boca Capital's Kim Forrest, my guest this morning on the markets. Coming up, a consumer under pressure shows up in the latest retail results.
I think the consumer is going to continue to be discerning. I think it's incumbent upon the retailers to deliver innovation and value in order to drive demand.
We'll break down the numbers. That's next on Bloomberg.
10 seconds. No change, no change. Rate remains unchanged at 5% as expected. So looking at the Bank of Canada rate statement, they say it is still too early for the Bank of Canada to consider cutting rates. There have been no big surprises since the January rate announcement. Economic growth has remained weak and inflation has eased further. The Bank of Canada needs to give higher rates more time to work, again saying it's too easy to loosen the restrictive policy that has gotten us this far. Says the Canadian labour market has come into better balance and that shelter price inflation remains elevated and more broadly, underlying price pressures persist. Domestic inflation could prove more persistent than expected. Macklem, Bank of Canada's governor, says, "I continue to expect inflation will be close to 3% through the middle of this year before easing in the second half." Says the bank needs to see further and sustained easing in core inflation. Future progress on bringing down inflation is expected to be gradual and uneven, and upside risks remain. It's still concerned about risks to the outlook for inflation, particularly the persistence in underlying inflation. So again, Bank of Canada reiterates that it is focusing on the balance between supply and demand, inflation expectations, wage growth, and corporate pricing behavior. Reiterates that it wants to see a further and sustained easing in core inflation. The Bank of Canada do know that the Q4 Canadian growth was higher than expected, but the pace remained weak and below potential. Says overall data points to an economy in a modest excess supply. Does add that there are now some signs of wage pressures easing. So Canadian dollar extending its gains after the central bank policy decision there. A CAD JPY is close to flat on the session now at around 110.30.
Hourly, if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
trading judiciously. They are looking for value. When you think about Nordstrom's results overall, you saw that the rack business, which is the off-price business, was up nearly 15%. It's the full-line business that was pressured. And in both areas, you saw beauty do well. In almost every single retailer, beauty is what's performing category-wise. But keep in mind, the guidance at Nordstrom kind of bracketed consensus, and it's going to be a margin-pressured year in 2024.
Nordstrom seeing a cautious consumer, forecasting muted revenue for this year due to the slowdown at the high-end stores. Ross Stores warning that the consumer is under pressure. The CEO writes this: while inflation has moderated, housing, food, and gasoline costs, they remain elevated. And therein lies the point. Simone Foxman joins me now on this story. Therein lies the point, Simone, that there is incremental pressure on the consumer, and it is differentiating between the high and the low end.
That's not what all these retailers saw in the fourth quarter, though, which is so interesting because pretty much everybody beating on their results on the fourth quarter. It's really the outlook looking ahead that is the problem. And it may be most pronounced in discount. You look at into the details of these Ross store results. Comp sales, 7% in the fourth quarter gain as opposed to the estimate of 2 3/4. But when you look for the year ahead, they're looking for 2 to 3%. The estimate was more than 3%. So I think the analysts class, Wall Street investors want to see a little better, a little hotter outlook, even for these discount places, the places that people go when their wallet is tight, and they're just not seeing it at the moment. You know, talking those Nordstrom rack numbers that Dana was mentioning, and also at the higher end, you're seeing a lot of consumer weakness, whether you look at the broader Nordstrom business or you look into Foot Locker, which Bear described as having a low quality beat reflecting heavier
It's been 10 minutes time now at the top of the hour. See the release of the second US employment report this week. It's the US job openings. Forecast 8.85 million on the prior 9.026 million, with a range of 9.1 million to 8.67 million expected. We also see the US wholesale inventories month over month revised. The forecast is minus 0.1%. On the prior minus 0.1%. Wholesale sales month over month forecast 0.3%, on the prior 0.7%. So for Canada, we also see the release of the Canadian IV PMI. The prior read was 56.5. Keep in mind as well at the top of the hour, it is when Fed Powell's Senate testimony is due to begin. So again, we have already seen the text release from this, where Powell did note that they expect it will be appropriate, do not expect it will be appropriate to reduce the policy rates until we have greater confidence in inflation sustainably towards 2%. Powell did also note in this pre-release of the text that it would likely be appropriate to begin dialing back the policy restraint at some point this year. So again, Fed Powell's testimony, where he'll answer questions, is due to begin at the top of the hour. For the live video for this, it's available on Fed Powell's entry on the calendar for anybody interested.
And some more price action. Let's get across to Abigail Doolittle. She can fill in the blanks. Abby.
Well, we are looking at pretty interesting sector composition here today, Manus. Right now, we have the S&P 500 up about 0.5%. One of the most defensive sectors, though, leading the way, that is utilities, up 1.4%. And of course, dividends there are big. So when yields go down, it makes those stocks look a little bit more attractive. We are seeing tech overall seeing a bit of a bounce back, up about 0.8%, even despite the fact that Apple has once again turned negative, down 0.5%. Interestingly, the financials are the only sector down just a little bit. And a piece of this is Morgan Stanley, down more than 4% on the day, the worst day since October. We are digging into what's behind that somewhat severe price action for Morgan Stanley. As for tech on the
Canadian money markets see a 23% chance of a Bank of Canada rate cut in April, which is down from 43% before the rate decision and statement.
2.7%. The day is young. Let's see whether or not there can be a little bit of a round trip there if those dip buyers show up, or maybe we're seeing some consolidation to the big recent gains.
Okay, Abby, thank you. Perfect chart. Really rounding out this hour on TV. Coming up, we'll give you the market moving events for the rest of your day on the Trading Diary.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Context is everything. Yesterday,
So in 5 minutes time now at 10 a.m. Eastern Time, we see the release of the US job openings for the month of January. Forecast 8.85 million on the prior 9.026 million, with a range of 9.1 million to 8.67 million expected. Wholesale inventories month over month revised for January. Forecast minus 0.1% on the prior minus 0.1%. Wholesale sales month over month. Forecast 0.3% on the prior 0.7%. For Canada, we see the release of the Canadian IV PMI, which had a prior read of 56.5. So keep in mind as well, at the top of the hour, Fed's Powell is due to begin his testimony as well. The live video is pinned to Powell's entry in the calendar for anybody interested. Again, as another reminder, Fed's Powell has already released the text for this speech at the testimony. However, he will be taking questions after delivering the speech.
What will the message be? Friday, it's all eyes down on the jobs report and the wages. That jobs report, again, reaffirming the strength and the unique capabilities of the US economy. That's it for Countdown to the Open. Straight ahead with the rest of the team on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, and
1 minute
Marie
remaining now.
will bring
I'll
you
lead with the
crucial
US
data
JOLTS
and
job
expert
openings.
analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg. This week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Context changes everything.
We're 30 minutes into the U.S. trading
10
day,
seconds.
and it's Wednesday, March 6th. And here are the top stories that we're following. Powell takes the stage. The Federal Reserve Chairman begins 2 days of highly anticipated testimony to lawmakers. And Nikki Haley's exit. The presidential
8.863 million, 8.863 million. That's higher than forecast. 8.85 million. Wholesale inventories month over month revised of minus 0.3%, minus 0.3%. Lower than forecast, minus 0.1%. Wholesale sales month over month of minus 1.7%, minus 1.7%. Lower than forecast, 0.3%. For Canada, the IBPMI at 53.9, 53.9. A look into the markets, relatively unchanged following that.
We're going to get a quick check on the markets here because we're snapping some days of losses. We have the S&P 500 up about 0.5%, and the NASDAQ 100 also seeing similar gains. The SOX, the Philadelphia Semiconductor Index, up almost 2%, on track to erase the losses from yesterday. And also here we have the 2-year yield just dropping down to 4.53
So
on the
noting
day.
the prior revision for JOLTS job openings, revised down to 8.889 million from 9.026 million.
Terminal right now. We're joined by Bloomberg's Michael McKee to join us with the details.
Well, it looks like, Shonali, we have a basically unchanged kind of situation. The December numbers were revised down, the annual benchmark revisions. So in January, we have 8,863,000 job openings. The revised number was 8,889. So not a significant drop there, but it was a significant drop in the revisions from over 9 million. So we're under 9 million again for the first time in a couple of months. The quits rate doesn't change. It is still 2.1%. That's one of the things that people watch for signs that the labor market is getting looser if people don't feel they can quit and get a job right away, but it looks like no change there. So the JOLTS numbers are about what you'd expect given the number of hirings we saw in January, and this is probably not going to move the needle one way or another for the Fed.
Now, Mike, as we wait for Jerome Powell also to start his testimony to Congress as well, what is the expectation out of not just what he will say on the onset, but what types of questions he may get?
We have posted out the US JOLTS job openings January report on the feed for anyone interested.
They're at basically their high rate, and they will cut rates, they hope, sometime this year, but they have to make sure that inflation is still on its way down. So nothing new in that. The questioning will obviously revolve around timing because Republicans want the Fed to hold off until inflation is down because they don't want rate cuts to help Joe Biden. And, of course, Democrats want exactly the opposite, cut rates now to help the president and his campaign. So we'll get a lot of questions on that. We may also get questions on the budget deficit. That's an issue for both parties up on the Hill. And the Fed tries to stay out of that. But Jay Powell on 60 Minutes did say that he thought the U.S. was on an unsustainable fiscal path.
Mike, we thank you for your time, your analysis. Stick around. We'll be back with you. Now, Republican presidential candidate
We've also posted out the US wholesale inventories January final report on the feed.
Where she's expected to end her presidential campaign. With us, we have Bloomberg's reporter Anne-Marie Hordern, surveillance host as well. What is expected out of her speech today?
So she's going to be backing out of this campaign. And, you know, we had Matthew Bartlett on yesterday who talked about the fact this was less of a presidential campaign, but a messaging campaign. So the question now becomes, she's going to there's no path for her. This was very likely, and Super Tuesday just confirmed
Treasuries
that.
extend
She said
gains,
she would go
10-year
into
yield
Super
dips
Tuesday,
below see 4.1%.
Felt like she needed to do that for her supporters. Oh, and here she is now. Let's take listen to what the Governor Haley has to say.
Good morning. Just over a year ago, I launched my campaign for president. When I began, I said the campaign was grounded in my love for our country. Just last week, my mother, a first-generation immigrant, got to vote for her daughter for president. Only in America. I am filled with the gratitude for the outpouring of support we've received from all across our great country. But the time has now come to suspend my campaign. I said I wanted Americans to have their voices heard. I have done that. I have no regrets. And although I will no longer be a candidate, I will not stop using my voice for the things I believe in. Our national debt will eventually crush our economy. A smaller federal government is not only necessary for our freedom, it is necessary for our survival. The road to socialism is the road to ruin for America. Our Congress is dysfunctional and only getting worse. It is filled with followers, not leaders. Term limits for Washington politicians are needed now more than ever. Our world is on fire because of America's retreat. Standing by our allies in Ukraine, Israel, and Taiwan is a moral imperative. But it's also more than that. If we retreat further, there will be more war, not less. As important, while we stand strong for the cause of freedom, we must bind together as Americans. We must turn away from the darkness of hatred and division. I will continue to promote all those values, as is the right of every American. I sought the honor of being your president. But in our great country, being a private citizen is privilege enough in itself. And that's a privilege I very much look forward to enjoying. In all likelihood, Donald Trump will be the Republican nominee when our party convention meets in July. I congratulate him and wish him well. I wish anyone well who would be America's president. Our country is too precious to let our differences divide us. I have always been a conservative Republican and always supported the Republican nominee. But on this question, as she did on so many others, Margaret Thatcher provided some good advice when she said, quote, "Never just follow the crowd. Always make up your own mind." It is now up to Donald Trump to earn the votes of those in our party and beyond it who did not support him. And I hope he does that. At its best, politics is about bringing people into your cause, not turning them away. And our conservative cause badly needs more people. This is now his time for choosing. I end my campaign with the same words I began it, from the book of Joshua. I direct them to all Americans, but especially to so many of the women and girls out there who put their faith in our campaign. Be strong and courageous. Do not be afraid. Do not be discouraged, for God will be with you wherever you go. In this campaign, I have seen our country's greatness. From the bottom of my heart, thank you, America. God bless you.
You've been listening to former Republican presidential candidate Nikki Haley. We are still joined by Bloomberg Surveillance's Anne-Marie Hordern. Anne-Marie, she said it is now up to Donald Trump to earn the votes, and I hope he does that. How close is that to an endorsement?
Well, she didn't go outright endorsing him, said she wishes him well, so she stopped short of that moment. She did say she launched
So this is a reminder for our users. Tomorrow, the ECB is due to announce their latest interest rate decision as well. So if you'd like some prep ahead of this interest rate decision from the ECB, our very own Tony again will be doing a live video stream, just going over the fundamentals surrounding this. So the link to tune in is now available on the FJ feed. Again, the video due to start tomorrow at 7:45 a.m. Eastern Time.
Karl Rove has been talking about the division within the Republican Party. It's very obvious. It's been obvious, but it's at this moment, the issue for Trump is this is the battle he needs
US
to
stocks
fight
pair their
going into
gains. The
November.
S&P
How does he
500 now
encompass
up
the entire party?
0.3%, NASDAQ 0.2%, Dow up 0.3%.
For that reason and another one, we are still waiting for testimony from Chairman Jerome Powell, Fed Chairman Jerome Powell on Capitol Hill. And while we wait for that, we're going to welcome back Bloomberg's Michael McKee and Bloomberg's Liz McCormick because we are already seeing action in the bond market here. Mike, when we think about how Chair Powell is going to be addressing Congress, we spoke about some of the issues already. What is he coming up against, especially as inflation is still top of mind?
Well, he's going to come up against criticism of the Fed for not moving quickly enough to bring down inflation, and the Fed has admitted it was slow on the trigger there. But in his opening remarks, he talks about how the Fed is absolutely determined at this point to bring inflation to its 2% target. So he's not going to cut rates prematurely. Of course, that will be something of a political issue, as we talked about earlier.
Liz, how about the bond market? How are they supposed to expect it? Investors expected to react throughout the 2 days of testimony. We are already seeing it met by a bid in the short-term market here. 2-year yields down a little bit, even just from yesterday.
Yeah, I think, Shanali, his prepared remarks, although you'll see a lot of the research report, nothing new, but he kind of seemed hawkish enough. He didn't lean more hawkish than he had to. He focused a little bit on the dual mandate, which some people thought, oh, that shows they're more balanced. But he did say, hey, listen, we're not clear we have enough progress on inflation to cut yet. But I think he kind of cut some of the tail risks, so to speak, out of the market by saying, again, rates are at their peak, and sometime later this year we'll cut rates. So that and some of the JOLTS data, like Mike laid out of the revisions and the ADP, was enough to kind of push bond yields lower. But yeah, we're going to be watching as soon as he starts talking and all the back and forth with folks on Capitol Hill. We know some of it is more politically spun, but we're going to look to see, does he say something on the balance sheet or any more inklings on monetary policy the bond traders will be watching.
Liz, is it worth taking note here that the long end of the curve here still has question marks around it? How do you think about longer-term rates, particularly as we think about more sensitive markets, refinancing markets for U.S. Treasuries, when we think about mortgage markets here?
Yeah, I think, kind of looming in the background, although there are times where it seems like, oh, nobody cares about the deficit, but you're hearing that come up more, that we still, have a problem of big deficits. Treasury's been getting people to buy their debt, no question about it. But I think, even though it hasn't quite worked out yet, a lot of people are thinking the yield curve will steepen, meaning ultimately the longer rates will head back towards being higher than the shorter rates, especially when the Fed starts cutting. But I do think there's a backdrop. That's why I'm wondering in the questioning what he typically says, Chairman Powell, our deficit situation is not sustainable. He doesn't want to get into politics, but I think we're going to hear some questioning on that, like what needs to be done to cut the deficit, and interest costs on our debt have been rising as, the Fed raised rates over 500 basis points since March 2022. So I think, yes, Shanali, that's kind of looming in the background. People feel safer to go to the middle of the yield curve-ish or shorter, especially when cash is making over 5%.
Mike, the reality of the situation is, while these 2 days are a busy 2 days for the bond market, you still have payrolls at the end of the week as well. How do you think about that kind of capstoning all of this?
Well, it tells me that the people on bond trading desks won't get to the Hamptons early on Friday. But beyond that, we're looking for clues to when the Fed might start cutting rates.
BP cuts crude capacity at Gelsenkirchen refinery from 2025.
Market's mind. Now, Powell's testimony this morning did nothing to futures pricing of Fed rate cuts. We're still looking at a July move before they get to a full rate cut priced in. So it's hard to see that he would say a lot that's going to move the markets today significantly. There is more volatility in bond markets on days when the Fed has some sort of announcement or Powell testifies, so we might see some of that. But over the course of the week, I don't think we're going to get a lot out of this, with the possible exception of any discussion on the balance sheet. Everybody in bondland is waiting to find out when the Fed is going to start tapering its QT, and if there are any plans to stop anytime soon. They're suggesting no, but if he does suggest that that's going to be an issue going forward, then you might see some reaction there.
Now, Liz, on that QT front as well, you know, if you're a lawmaker and you're worried about your constituents here, how much do you really drill down on the balance sheet here? Do you think it's even of concern for lawmakers?
Well, I think, you know, their staff, you know, sometimes I'm surprised. I don't mean it against them. There's really great questions that come up sometimes. Going through the pace of the QT, which is allowing their balance sheet to roll down. You know, broadly speaking, many politicians have long felt that they don't like kind of the optics of the Fed having this big balance sheet. You know, why are they have a heavy hand in the marketplace? So the Fed's trying to get the balance sheet down. They're just doing it in the background with rates, you know, setting policy, their key one. But I do think there's some questions on that. What's the plan? What's the path? I don't think anyone, you know, on Capitol Hill is worried. They are worried about mortgage rates and things like that. So they don't want the Fed to do anything that will cause issue. But I do think it's a topic. And the general consensus is that they will probably slow the pace of QT, like Mike mentioned, and maybe they'll wrap up by the end of the year. But that will still leave them with a pretty big balance sheet.
Mike, if you're the Fed chair right now and you're looking at an economy that is still largely running very strong, how do you explain to lawmakers at this point that is still thinking about jobs, that are still thinking about wages, that you may be worried about wage prices here in relation to inflation? I mean, how does he strike that balance?
He basically just needs to come at it from a Fed and economist point of view, that they're trying to do the best job they can for the most people. We could look at it different ways. If job growth is really strong, the Fed could worry about inflation taking off and raise interest rates to head it off. And then the people on the committee who are worried about jobs and people losing their jobs, unemployment rising, they'll get mad at the chairman for that. In terms of wages, it's a tough thing because the Fed wants wages to keep rising, but not enough to touch off inflation. That would be, they think, 3 to 3.5%, but right now they're in the 4 to 5% range. So when he talks about that, that's going to upset some of the progressives who think that we should be paying people a lot more and that companies need to do more for their employees. So he's in a no-win situation politically. He just has to say that they're going to do the best thing that they can, that getting inflation down is job one because that hurts everybody. And beyond that, they will try to manage the economy to provide the best outcome for the most people.
What do we think about how he handles the question about housing and mortgages? Because the reality was things were looking a little smoother at the end of last year, but we have seen rates stay roughly elevated this year so far, finally taking a breather here. But interest rates as it pertains to mortgages might still remain high, Mike. And when you think about how much pressure there has been on the housing market, how frustrated might these lawmakers be walking into this conversation?
Some of them may be very frustrated because it is an issue with consumers. The price of mortgage is not only something that raises what they have to pay each month, but it also makes it harder to buy a house. And that's all pretty much stopped at this point. So, yes,
Mike,
he's hearing a lot of it.
Cut you off shortly here too, because we're waiting for the chair to start speaking shortly. We're going to go now to Capitol Hill, where Fed Chair Jay Powell is testifying to the House Financial Services Committee. Let's take a listen in.
Waters and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
Taking a look at the Fear and Greed Index, 74 out of 100 equaling greed, and the Crypto Fear and Greed Index, 75 out of 100 also equaling greed. And looking at the VIX, currently down 0.9% at 14.35.
I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters.
At 10:30 a.m. Eastern Time, we get our weekly EIA data. Crude oil inventories forecast a build of 2.741 million on the prior build of 4.199 million, with a range of 4 million to minus 2.6 million. Distillate inventories forecast draw of 0.663 million on the prior draw of 0.51 million. Gasoline inventories forecast draw 1.75 million on the prior draw 2.832 million. And crude Cushing inventories prior build 1.458 million. We also get the Bank of Canada press conference.
Dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
Fed's Powell says rate
I
cuts
say
will
that
depend
really
on the
will
path of
depend
the
on
economy.
The path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation
Fed's Powell says we would like to have more confidence on inflation. We have some confidence, but we want more.
We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime
Fed's
this year.
Powell says strength of the economy and labor market means we can approach that carefully and thoughtfully.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions.
Powell says we have some confidence inflation is moving toward 2%.
The proposal goes
And at 10:30 a.m. Eastern Time, we get our weekly EIA data. Crude oil inventories forecast build 2.741 million on the prior build 4.199 million, with a range of 4 million to minus 2.6 million. Distillate inventories forecast draw 0.663 million on the prior draw 0.51 million. Gasoline inventories forecast draw 1.75 million on the prior draw 2.832 million. Crude Cushing inventories prior build 1.458 million. We also get the Bank of Canada press conference.
And very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out? You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that.
Fed's Powell says it's more important that we get this right than we do it fast.
Potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings?
1 minute
on the
remaining. I'll lead
Capital
with
One
EIA
and
crude
Discover
oil
merger?
inventories.
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate
10
this
seconds.
possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
We haven't even. I haven't
Build
talked about that with anybody. I will say
1.367
this,
million.
we've done-
Build
we've done that in
1.367
many,
million,
larger
lower than the
mergers, but that's
forecasted
not
build
a-
of
that's not a conversation we've had
2.741
yet.
million.
We literally
Gasoline
don't even have an
inventories.
application for
Draw
merger yet.
4.46 million. Draw 4.46 million. That's lower than the expected draw of 1.75 million. Distiller inventories. Draw 4.131 million. Draw 4.131 million, lower than the expected draw of 0.663 million. Crude Cushing inventories. Build 0.701 million. Build 0.701 million.
Than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed
And
has
stocks in the U.S.
sufficiently
Strategic
emphasized the
Petroleum
role
Reserve
that
up
housing
706
costs play
million
in keeping
barrels
us
at
from your 2% inflation
360.96
goal?
million
Do you think it's
barrels.
reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do,
We
how
have
long will
posted
it
the
take to get
weekly
there?
US EIA petroleum status report on the feed for all those interested.
Services inflation is one of the three components that we look at that make up the core PCE and index, and it has been coming down from its heights of a couple years back. It's part of the story. I think the overall story is that goods price inflation has
US
turned
and Brent
negative.
oil
Goods
futures
prices are
extend
actually coming
gains
down a
after
bit.
US EIA storage
Housing
report.
services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's
And
been
that leaves
reported that the
non-housing
methodology used to assess housing costs as an indicator of inflation is imperfect. Namely, because it considers costs based on both new and old rents, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease
Fed's
rents,
Powell says
which
the
is referred
forecast
to
for housing
as
services
new
inflation will come
tenant
down.
Repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill, is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics. And you all discussed the interactivity of that rule with other rules. So if you were to repropose the Basel III endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively. But yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets in abundance of caution in case there needs to be a resolution, obviously. We know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that.
And Majority Leader Schumer says, I see House passing spending bills with bipartisan
We want to
backing.
understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households. And in my view, there's three principal causes. Certainly, we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then. But it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period.
And oil futures extend gains, U.S. crude up by $2 a barrel.
We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But
The Fed's powell says the pandemic may have changed in a sustained way how we target inflation.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct? at the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains was disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the, of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet just about. Is that not correct?
I think that's right, yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high in people. So that's something else that we need to get in control. Is that not correct?
Bank of Canada's Rogers says we have to keep our eyes on commercial real estate and exposure in Canada spreads more broadly.
Conflicts in other areas of the world, like Russia's war against Ukraine and/or the turmoil in the Middle East and the economic pressures that the United States feels, does not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up sharply.
So could you tell you what is the, what would the connection lead you to believe that there is an urgent need for us, I would think, for, when we're running out of time, for us to do everything that is in our power in Congress to support Ukraine so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction.
And Bank of Canada's Macklin says shelter price inflation is weighing on our decisions.
But if we had more grain that was going through, it wasn't blocked by Russia, things of that nature, that generally just, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia, and we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying
Canadian dollar ticks higher as Macklem
our commodity
speaks.
markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses.
Bank of Canada's Macklem says we most likely won't get to 2% inflation this year.
Unfortunately, the Fed could undermine this long-standing work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder
Dollar
for end
slips
users
to a near
find a
6-week
bank to
low
offer
versus
this
the euro,
service.
last up
There are some estimates that
0.38%
the
to
Fed's proposal will increase capital for this activity
$1.0898.
by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Boswell endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to cast a dim light on perhaps the Fed and others who are working to end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation and
Fed's Powell says what we're seeing so far this year is continued solid growth.
Growth at a solid pace. I will say so. There's no evidence or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always
And Powell says there's no reason to think the economy is in or faces significant near-term risk of a recession.
Will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate your saying this because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely.
So Macklem says the Canadian overnight repo rate average pressures are not a sign of needing to end quantitative tightening early.
What we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand.
Powell says inflation has come down sharply.
Sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions.
So Powell says so far we have economy growing at a solid pace. The labor market is still tight and strong.
While also achieving further progress on inflation. That's our goal. And do I think there's a possibility we can achieve all of that?
And Powell says, I think we can achieve a soft landing.
Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing. We want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. And we want inflation to continue to move down closer and closer to that 2% objective. And we've made quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to keep a strong labor market and strong growth while making further progress.
Powell says we are using our tools to keep a strong labor market and strong growth while making progress on inflation.
I think there's we're on a good path.
And we are on a good path so far in being able to get there.
I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing, there's a possibility of a recession. So will there ever be some official statement that would give people some comfort?
I don't think by us, no. I think we're just going to keep our heads down and do our jobs and try to deliver what the public is expecting from us. We wouldn't be declaring victory like that, but
the gentleman's time has expired.
Thank you, Mr. Chair.
Thank you.
The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this. I hope you do too. I know there's some bit of trepidation about all the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality's a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on
Bank
the
of
term
Canada's
that I would
Macklem
say
says labour market
high
adjustment to
prices
higher
are
rates has
here
been
to
relatively
stay.
smooth.
Because what I've heard you say today in this report really go to is you got everything under control, but we're going to keep the high prices. And I think the high prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat. Page 7 of your report, you don't have to go focus on it, it says, while current services, core service price inflation has been slowing, but remains elevated. It does. Labor costs, as you know, and energy costs are a driver to your monetary policy. The question that I have is, because you began referencing policy, 2 weeks ago or so, the president announced that he was going to slow down the gifting of opportunities in Texas for natural gas to be able to continue the exploration. And this in Texas is a $1 trillion answer problem to us, because if we do not constantly go find through these new finds, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high. There's no resiliency to continue this and see the American people win. You talked about policy, so what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it has a huge impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment. On if I'm commenting on energy policy, I should comment on everything. We have a mandate which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry. Jobs that are associated with it, our foreign policy as it relates to
Bank of Canada's Macklem says we have been surprised over the last couple of quarters by the strength of the U.S. economy.
Almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a huge impact on, I think, your monetary report about how many houses get built, how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulation is having a lot to do with the nervousness, not only on this panel, but also by the American people. It would be my hope that you would pass some sort of a memo and tell them you have no opinion, but you want them to see what the impact is. I want to thank you for being here. Thank you, Mr. Chairman. I yield back my time.
Gentleman yields back. The gentleman from Connecticut, Mr. Himes, recognized for 5 minutes. Thank you, Mr. Chairman.
Bank of Canada's
Chairman Powell,
Macklin
thanks
says
for
we are
being
comfortable with
us
our
today.
measures of core
I have a
inflation.
question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend Mr. Sessions talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump, and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts.
Canadian dollar extends its gains, touching the strongest since February 27th at 1.3511 per US dollar.
We don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps the most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it?
Bank of Canada's Governor Macklin says, I'm looking for consistency across inflation indicators.
Vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been working hard to management for some time now, really. And what it really is it's a lot of downtown real estate.
Powell says commercial real estate risk is manageable
because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations. And we've been
Bank of Canada's Macklin says there was clear consensus inside the governing council that rates needed to stay at 5%.
It isn't really the big banks, it's really medium and small-sized banks that have these higher concentrations. It's going to be with us. This is a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium-sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. The Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but I mean, frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small-sized banks principally on this. So I am confident that we're doing the right things there, and I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you. Thank you, Mr. Chairman. Yield back. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you, Mr. Powell, for being here today. I'd like to associate my remarks, or myself, with Mr. Hill's remarks earlier with regards to the FDIC proposed long-term debt requirements that are based on the risk weighting of assets. I think it's an ill-thought-out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning, given the data from both the GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other banking services for the country's poorest citizens. Yesterday, I introduced the Secure Payments Act, which would prohibit final rulemaking until the Fed, among other things, studies the impact of the board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on low-income consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an assessment. I mean, the law does assign us a specific job, which is to assess whether an interchange fee received by a large debit issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us. Not something we thought we sought, but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. And that's all we think we're doing. But I think that the concerns that have been raised will be things that we...
Well, hopefully you'll study this and understand that from the previous types of rules along this line, they were very detrimental to a lot of low-income, middle-income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers, as they were talked about. 98% was one of the studies that showed that the retailers kept all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again, I think our reading of the law is that it's not something you do once and leave it there. It's supposed to be reasonable and proportional to certain identified issuer costs. The implication being there, if those costs change, then this should change. So that's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, stuff all rolls downhill, and as the last study showed, the smaller banks, the community banks, are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that. One of the things, yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, the Fed now, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you that China is watching this like a hawk. They are ready to pounce on this situation. To me, I've got some bills that actually would solve the problem. Do you think there's some issues here we need to be taking a look at?
Yeah, I think we're very focused on
Powell says we are very
AI,
focused on
many
AI.
government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture. There are lots of pictures.
Gentleman's time's expired.
It's interesting because the foreign banks actually are watching this. Thank you.
We'll now go to the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thank you for
And the
being with us
4-week
this
average
morning.
product
It's always
supplied
a
of
delight to have
residual
you,
fuel oil rose to its
before us.
highest level since
Chair
December
Powell, the
2021,
February
according to
Congressional
EIA.
Budget Office report estimated that the
And
US
Bank of
economy
Canada's
will
Malcolm
grow an
says, I can't put
estimated
timings of rate
$7
cuts on the
trillion
calendar.
over the next decade, thanks to, in large part, to the surge in immigration, creating a larger labor force. Immigration also increases demand for goods and services. I know you mentioned in your report that that the growth sometime during COVID was held down due to some restrictions in COVID and restrictions on immigration. Can you detail how immigrants have been fueling our national growth, and did you consider this report from the CBO in this current report?
So I am very familiar with the CBO report. I've read the demographic projections and I've read the economic projections, so I do understand. Be more output, and that's what they're showing. I just want to be very, very clear, though, that we don't make immigration policy. We don't comment on immigration policy indirectly or directly.
No, well, I'm not asking you to do that, but Mr. Chairman, I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got a big increase in workers, and it came from two sources. One was participation increased from people who were already here, and in addition, we got a significant increase in immigration, and many of those people take part in the working economy, and so there was a big increase in labor supply. That will have increased output. It will have made more people. It will have all kinds of economic effects. I'm just reporting the facts there.
Right.
I'm not going to say anything is needed for the future or good policy, or indirectly or directly. But I mean, I think it's just reporting the facts to say that immigration and labor force participation both contributed to the very strong economic output growth that we had last year.
Right. Is it possible
Fed's
for the
Powell says
Fed to
immigration
conduct
and
a
labor
formal
force
assessment
participation both
into the
contributed to
positive
strong
impact
economic
immigrants
growth we
have
had
on our
last
economy
year?
and report back to Congress?
Not really, no. I think that's a job for the CBO. We wouldn't, we don't, that's precisely what the Congressional Budget Office does, not what we do.
All right, but the other question that you've not addressed is, did you consider the CBO's assessment that the growth in the next 10 years would be $7 trillion and about $1 trillion in added revenues? Was that considered in this report? Because that was the February report, and this, I believe, is through February 29th.
So I think that the answer to your question is 10-year growth projections by CBO don't have big implications, don't have any implications really for the current stance of monetary policy. But I will say that the immigration that we saw
Bank of Canada's Malcolm says we're not going to be lowering rates at the pace we've raised them.
And 2024 economic outcomes, and of course we're aware of that, and it plays a role in our thinking about appropriate policy and the path of the economy.
Okay, well, thank you for that. And related to that, I know that the last time that you were here, you and I talked about diversity and diversity and inclusion efforts, both at the Fed, and I applauded you and applauded the president for his appointment of Dr. Adriana Kubler. I expect to visit with her this week. What other strategies and programs are you using in the Fed, not only in here, but in all of the branches to ensure that there is diversity and inclusion?
So in terms of intake of people, when we go to hire when the reserve banks go to hire a new president, those processes are very focused on having a diverse applicant pool, and you see the results of that more and more over the years. That happens. We don't have any role in appointments of governors, so that's not our job. The administration does that. In terms of, I'll just say internally, we're very focused on having an open and inclusive place to work, and also in hiring, we work hard to have diverse.
Gentlelady's time
Thank you.
expired. The
Thank you, Mr.
gentleman from
Chairman.
Michigan, Mr. Heising, is now recognized for 5 minutes.
Chairman Powell, good to see you in person. Mr. Chairman, I've got to make a comment here. It's stunning to me that equating an underground economy, which is very different and not a healthy alternative to the regular economy, and basing that on an illegal workforce that's not legally able to work, ultimately will fail. That is not a strategy to my colleagues on the other side. So just ask any farmer who's going to then have a regulator come in and fine them for employing people who are not legally allowed to be here in the country. That is one of their greatest fears. So that's just a fallacy of growth within this economy that is not sustainable. Chair Powell, last fall I sent Vice Chairman Barr a letter expressing my concern over the cumulative impact pending rulemakings governing products and services will have on consumers.
Bank of Canada news conference has ended.
There's been a fair amount of time spent on Basel III, but among the agencies, and here I'm including Fed, FDIC, OCC, CFPB, and the number of pending or final rules is frankly just staggering. Regulators last year finalized new rules for the Community Reinvestment Act. The Fed is also looking at Reg II, which in my opinion would unintentionally undermine recent significant progress in bringing low and moderate income consumers into the mainstream banking system. And just yesterday, the CFPB unveiled a rule that would cap late fees for banks. And I just literally walked out of a meeting with my credit unions who are very concerned about those things that may be in their future as well. So I think it's critical that we don't look at any of these rules in a vacuum, and we need to consider their total impact and full scope on that. So I'm going to ask you a question I've asked some of the other regulators. How much do you, as the Fed, and you personally, consult with other agencies on their own rulemaking agenda? Do you coordinate? Do you talk?
I don't lead that area of our business, but I know there's a lot of talking. Coordination, I'm not sure there is coordination.
We're in government. There's always a lot of talking. I'm concerned about the coordinating. All right, well, let me ask you this way. When a rule is finalized under another regulator, are you mandated or have any kind of policy to go back and look at your other pending rules under your purview and see if changes need to be made because of these other agencies' rule makings?
There's no mandate like that. I think where it made sense to do that, though, we would do it.
But you genuinely have some sort of review of that. It's conscious.
I don't think there is a formal review.
Okay.
No.
I've heard repeatedly that elements of Basel III overlap with the Fed's annual stress tests. What are you going to do to address that overlap?
So we're in the middle of just at the beginning, actually, of deciding what to do about Basel III. And part of that may be the interaction with the stress test. So I haven't got anything for you on that today, but that's certainly an issue that presents itself.
We'd like to continue that conversation. I do want to touch on the bank failures of last year very quickly. Do you think that the banks that ultimately needed the government bailout lacked sufficient capital, or was it more of a management problem?
So with Silicon Valley Bank, it wasn't really. Could they have used more capital? I mean, they were actually raising capital. It was a capital raise that they announced that triggered the run and everything. So you can argue that it needed more capital, but I wouldn't say that that was the proximate cause, really. It was a funding structure that was all about too much concentration of
well, many of us are, I'm asking the question because many of us are very concerned that those failures are being used as an excuse to raise capital standards across the board. And because the SEC just released its climate disclosure rule this morning, I'm going to touch on the climate related question for you. FSOC, the FSOC chair has repeatedly stated that climate change is, quote, an existential threat. Presumably a threat that is existential affects banks and financial institutions of all sizes. Why then have FSOC member regulatory agencies, including the Fed, limited their guidance on climate-related risks only to large financial institutions? Why not everybody?
Well, it's a new thing, and we are not.
It's a heck of a new thing. Yes.
We're not climate change policymakers. It's this is
Either
something that needs to be handled by elected representatives, and so we're starting this very carefully with large institutions who are already doing it. By the way, the things that we're doing, they're doing this because to remain active internationally, they have to be doing it. So we started with them because they understand it. Imposing it on smaller banks, it's not something I'm for.
Yep.
Gentleman's time has expired.
We'll be following up on the Taylor rule. So.
The gentlelady from Michigan is recognized for 5 minutes. Ms. Tlaib.
Thank you so much, Chairman. Thank you, Chair Powell, for being here. Do you agree with the April Federal Reserve report that compensation incentives contributed to Silicon Valley's bank failure?
I'm sorry, did I didn't...
So the April Federal Reserve report, it said that compensation incentives contributed to the Silicon Valley Bank's failure. Do you agree with that?
I would say it's at best a tertiary factor, but it probably had something to do with it. For me, not a major.
So that's no?
That's very small.
Okay, so it did. Okay. So do you agree the appropriate rules on incentive compensation could have reduced the likelihood of Silicon Valley's failure? Maybe. If they didn't take all that money.
I really don't think so. I mean,
So if they
I
didn't
don't think
take all
it's
that money?
I don't think it's a first-order question for Silicon Valley. A lot went wrong there.
Yeah.
Incentive comp would be.
They actually blame you guys. They
Sorry.
blame the oversight, even though they didn't respond to your
That's part of it.
correspondences.
We took our medicine.
Yeah. Do you think it also has something to do with the fact that Section 956 of the Dodd-Frank rule hasn't been finalized by you?
No, I don't.
You don't think it's the reason?
I don't.
You don't think it's because people made money off of the failure?
I think nothing.
You don't think money drove them to do what they did?
I didn't say that. What I said, there are lots
So
of.
they made money from it. They actually, it was a lottery for them,
I do not
right?
think that incentive compensation arrangements were at the heart of the Silicon Valley Bank failure. No.
Okay. Do you support a robust rulemaking for executive compensation, Chairman?
I know that the.
Oh, you don't?
I'm sorry?
Oh, do you support robust rulemaking for executive compensation? Do you believe in Section 956?
Section 956 is the law. As I understand it, the agencies are looking at doing something. It's been 12 or 13 years, right?
Yeah, multiple
Nothing
agencies.
has happened.
Yeah.
It's been hard to get it done. I lived through the last episodes of trying to get it done.
So do you believe in a robust rulemaking process for executive compensation?
I do, yeah.
Oh, great. Oh, that's awesome. Will you commit to helping finalize the Dodd-Frank section of 956 this year?
I wouldn't.
It's been 12 years, Chairman.
Yeah, no, I want.
It played a role in the bank failure.
Oil futures
Chairman.
extend gains, Brent crude up by $2 a barrel.
So you don't want to do it this year? I mean, I'm being serious. You're saying no?
If the member will allow the witness to answer the question, we've had a good day today, and the gentleman's trying to answer the question.
I would like to understand the problem we're solving, and then I would like to see a proposal that addresses that problem.
Okay. Do you believe people should profit off of bank failure? The executives that made those decisions?
No, not
They
the
should not
executives.
profit.
Well, I would say executives who are responsible for a failed bank should not profit from the failure. Absolutely not.
So they get to walk away with compensation based on their failure?
Well, you're asking about a different rule that would have clawback and things like that?
Yeah.
Yeah, so that's something I know you've been looking at for a while.
Yeah.
That's certainly an appropriate thing to look at.
Yeah, because it's just going to continue to happen, is my opinion. It doesn't have to be yours, but it sure the heck could have helped here if they knew they were going to walk away, if they could walk away with not the bonuses, the compensation. I mean, they made money, a significant amount of money for their bank failure. Last question, Chair Powell. Do you believe that the impacts of climate change pose a risk? Have you been talking about that more?
I certainly believe that climate change is real and poses risks over the longer term, sure.
So there have been some that say, higher interest rates actually makes it more difficult to build out the renewable energy projects and other investments required to prevent climate impacts. Do you believe that to be true?
It's not our. I believe that we need to do our job that you've assigned us, which is maximum employment and price stability, and we do it through interest rates. It's not our job to consider the effect on climate change of that, and I think any effect on climate change of that would be kind of minuscule.
Okay. Last question, Chair Powell. Who do you see as the major winners and losers from high interest rates in terms of income groups, age groups, and racial or other demographics?
So the point of high interest rates in the current environment is to bring inflation under control. The people who are hurt the most by inflation, as you know, are people who are on a fixed income, who right away are in trouble when the cost of transportation, food, energy, and when those things go up, they don't have financial resources to deal with it.
Have you looked
We're
at
accountable to provide price stability to the American people. Those people benefit the most over time from stable prices.
Gentlelady's time's expired. We'll go to the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Mr. Chairman, and I thank you, Chair Powell, for your service. I want to associate myself with the comments of my colleague, Mr. Himes. I am concerned about banks' commercial real estate exposure, and I do hope that the Fed is doing everything it can to ensure that the exposure that these banks have will continue to be, in your words, manageable, because this is a looming crisis out there, given the workplace changes and dynamics. Chair Powell, in remarks on Bloomberg, Larry Summers, former Treasury Secretary during the Obama administration, stated that, and I quote, "It would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise than, quote, some of the more abstract and politically driven arguments about various kinds of capital charges on the largest banks." Do you agree, sir, that it would be more productive for Fed supervisors and regulators to keep their eye on the ball, in this case, commercial real estate and other real estate investments?
I absolutely think we need to keep our eye on the ball on commercial real estate.
Moody's says the UK budget plans will perpetuate the UK's fiscal challenges.
Report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projections showed a median of, this is in
Moody's
December
says the UK
FOMC,
plans
so
for
this is now 3
spending
months
cuts
old,
are unlikely
showed
to
3 rate cuts
materialize
this
given
year.
long-term
So
spending
that would be
commitments.
75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
So are you anticipating that there would be more cuts here coming?
It's not, the way I would say it is, we're making economic projections. And so we write down a path of growth, what's happening in the labor market, what happens with inflation, and what goes with those forecasts is an appropriate monetary policy, appropriate interest rates. So we expect inflation to come down, the economy to keep growing, the labor market to remain strong. And if that's the case, it will be appropriate for interest rates to come down, significantly over the coming years.
And Moody's says the UK government's commitment to meeting fiscal rules underpins stable outlook on UK's AA3 rating.
Something different from that, and that's what will actually happen.
Chairman Powell, 15 members of Congress, including myself, Ranking Member Sherman, Chairman Barr, and
Fed's Powell says if the economy evolves as we hope, interest rates will need to come down significantly over the coming years.
Activities. The letter highlighted critical areas of our U.S. markets, including securities underwriting, securitization, and derivatives that will be severely impacted by the Basel proposal. This was also a common theme represented throughout the comment file on the Basel proposal, over 95% of them. Considering that 75% of financing in the U.S. is done through our capital markets, which are the deepest and most liquid in the world, why would the Fed continue to pursue this flawed proposal instead of re-proposing a rule that would not have such a drastic impact on the U.S. economy?
Well, in fact, the capital markets concerns you raised are among those that I raised myself in our open board meeting when we put this out for comment.
And you said you wanted broad support, and obviously there is dissent among some of your governors, the FDIC, others. So how are we coming on this, and how are we
we're working our way through the comments, and we're coming to the point where it'll be appropriate for us to begin to evaluate what changes are appropriate. I've said I think those changes will be broad and material, and that's where that is. But we haven't made any decisions yet. We just got the comments.
In my role as chairman of the Capital Markets Subcommittee, I have seen SEC Chair Gensler push the envelope in terms of rules and regulations that go well beyond the congressional mandate, even encroaching on the jurisdiction of other financial regulators. What is the Fed's response to another agency encroaching on its jurisdiction?
We do not comment on other agencies' regulation. However, if they were actually, to take your hypothetical at face value, if they were to come into our jurisdiction.
Oh, it's more than a hypothetical.
And we would react.
Good. Well, I hope you do. I yield back.
Gentlelady from New York, Ms. Velasquez is recognized for 5 minutes.
Thank you, Mr. Chairman. Right here.
Hi.
Hi. Thank you for being here, Chairman Powell. Property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in my community. The FSOC's annual report identifies property insurance rates as an increasing risk, and I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomic?
Well, we'll pause the clock. We can have staff take a look at the microphone.
We need
the clock being frozen is out of respect for Ms. Velasquez, or out of good luck, I'm not sure.
Majority Leader Schumer asks the FTC to fully investigate big oil consolidations.
We need to invest in infrastructure for this committee.
Yes. Well, we're trying to do electronic voting, and
You said no voting.
no, it's hard enough to just get the microphones to work. Madam Clerk, thank you. Thanks. So all the photographers have left, so the awkward photos for Trish will be less awkward.
Technical difficulties occurring when we have, of course, evidence being given by Chair Powell, semi-annual testimony on the Hill, discussing, of course, the role of the Federal Reserve when it comes to, well, the last question we heard there, all about the encroachment of perhaps, well, some other regulators in and of its turf. But as we know, the market has been reacting to what Fed Chair Powell has been saying. We've seen a bond market rally more broadly. And we've had sort of a lot of questions also surrounding the world of technology. We are indeed a technology show talking about Silicon Valley Bank failure and really the repercussions that came from Rashida Tlaib, of course, a little bit earlier. But more generally, the market has not seen much movement more generally, we have seen Bitcoin remaining on the higher side more broadly, as have stocks across the board, just smaller moves, and the bond market continuing to rally overall. Commercial real estate, another key focus of area that has been happening throughout the discussion, and Chair Powell has been saying that he will be continuing to focus indeed on commercial real estate. And Powell's mic, therefore, is not working across the board as we see technical difficulties happening on the Hill at the moment. So we'll continue to listen in to what's happening with Chair Powell. I think the microphone is now working again. Let's listen in.
Ms. Velasquez, you're recognized for 5 minutes.
So, Mr. Chairman, I was asking you about the property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in our community. The FSOC's annual report identifies property insurance rates as an increasing risk. And I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomy?
So yes, we are very much aware of increases in insurance, including property insurance, and it's been adding meaningfully to inflation. It's not something we have any control
Fed's
or
Powell
authority
says
over.
property insurance
Same is
has
true of
been
auto
adding
insurance.
meaningfully
Just
to
insurance
inflation.
generally prices have gone up a lot.
So when we talk about the lack of affordability when it comes to housing, the insurance, the rising cost of insurance is an important factor that is affecting the availability of affordable housing in our communities. And I hope that there are some discussions among the Feds, because it is an increasing risk and it's going to have a direct impact on our economy. Chairman Powell, I know you spoke with Chairman McHenry a little bit on inflation and interest rates. Can you explain what evidence you're looking for before inflation has returned to 2% and interest rates can be cut?
Sure. So we're not looking for inflation to go all the way down to 2%. That's not what we're looking for. What we want is just more evidence that will give us more confidence that inflation is on a path down to 2%.
Fed's Powell says we are not looking for inflation to go all the way down to 2%, but we do need to see more evidence. That means goods inflation readings.
We can be confident. We don't want to have a situation where it turns out that the 6 months of good inflation data we had last year, that didn't turn out to be an accurate signal of where underlying inflation is. So we're just being careful, and because the economy is so strong and the labor market's so strong, we think we can and should be careful as we approach that decision.
And when you say evidence, what evidence? If there's anything?
So just more, we'd like to see more good, relatively low inflation readings. We're not looking for better inflation readings than we've had. We're just looking for more of them. And what will happen is that as we go forward, the 12-month inflation will continue
Powell
to drop.
says as we go forward, 12-month inflation will continue to drop.
Thank you.
And not looking for better inflation readings than we've had, just looking for more of what we have seen.
On where Mr. Lee left off and reiterate the importance of the rulemaking on Section 956. This is an issue that I also raised with Vice Chair Barr, Chairman Grunberg, Acting Comptroller Sue, and I told them when they came before this committee that I will be asking for a status update on the rulemaking at every future hearing, because it's well past time, 12, 13, 14 years. If you are employed in a company and you are given a task, I will think that you will be fired if you don't get it done, and it has taken 12 long years. So you are the chairman of the Fed. How is the Fed working with other agencies to propose the rule?
So there's a lot going on in regulation at the Fed right now. My understanding on 956 is that there have been discussions between the regulatory agencies, and I think it's not 3, I think it's more like 6 agencies that have to agree.
I know.
I have not seen a proposal. I think something is under consideration, but it's not something that's gotten to me yet.
I will ask the next time, and believe me, I'll be here.
Great.
Thank you.
Gentlelady yields back. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Mr. Chairman, good to see you. You have said numerous times that the capital framework is about right and that banks are well capitalized. Do you still believe this?
I do.
Given that you believe that, and given the fact that the Basel III Endgame proposal dramatically increases capital requirements on banks, would a reproposal that implemented Basel III in a capital neutral way, could it do so without jeopardizing financial stability?
Could. I mean, hypothetically, yeah.
Okay. According to Latham and Watkins, 97% of the comment letters either opposed, called for a reproposal, or expressed substantial concerns about the Basel III Endgame proposal. And those negative comments came from across the ideological spectrum and from various interests. Without objection, I would ask the chair to include that report into the record. Without objection, I'd ask the chair to include that report.
Without objection.
Thank you. And Mr. Chairman, did you see that report?
I did.
Does that concern you, that 97% of the comments were negative?
So we didn't do our own count, so I can't make an assessment, but I would say it's unlike anything I've seen.
The Basel III comment period ended on the same day as the Fed's data collection on the proposal, which is an odd process since the data should have been collected far earlier, analyzed, and the results should have been available for the public to comment on before the comment period ended. Why did the Federal Reserve choose to do a quantitative impact study during the comment period for the proposal, foreclosing any ability by the public to comment on the results of the study?
Well, I mean, the movie's not over. We are where we are, and Vice Chair Barr did commit to putting the QIS out for comment. We will receive those comments, and those comments will be taken into consideration as we think about the path ahead.
Well, speaking of process, you've got your excellent general counsel right behind you there. And I don't want to get into privilege here, but have the lawyers at the Fed raised any process concerns or Administrative Procedure Act issues with the board?
Let me just say that we're committed to doing transparent and reasonable and data-based rulemaking in compliance with the Administrative Procedure Act.
Well, of course, giving the public the ability to comment on the quantitative data that has been provided obviously is consistent with good process. Sir, Governors Bowman and Waller, Vice Chair Hill, and Director McKernan all dissented on the proposal, and Vice Chair Jefferson expressed concerns with it during his statement. Under your tenure as chair, can you identify any other regulatory proposal which has elicited this much dissent?
No.
Have you in the past acknowledged in front of this committee that you will not move forward with proposals without consensus, or you have acknowledged that in the past, and we appreciate that commitment to consensus. Have you achieved consensus yet on the Basel proposal?
Let me say I am confident that we will, but that's a process that as I mentioned, we're evaluating the comments. We're just coming to the place where we're going to start talking about the path ahead, and I am confident that we'll achieve very broad support on the board.
Mr. Chairman, do you agree that the heterogeneity and business model diversity within the banking sector contributes to system-wide financial stability?
I strongly do.
And do you agree that a concentrated business model in the banking sector would present a potentially systemic risk?
Potentially, yeah.
And this is one of my major concerns with the proposal, Mr. Chairman, because by de facto repealing regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently only apply to large GSIBs, discouraging securitization, which is the private sector solution for dispersing risk, eliminating the use of internal risk models and transitioning the industry and regulators toward only a standardized framework actually would push the industry into a smaller and more concentrated looking industry, and as a result would in my view actually increase systemic risk and decrease market competition. Do you share that concern?
I think it's a real concern. And again, I think that's part of what goes into my thinking certainly about the the proposal and where it needs to go.
Well, given all of these concerns, we hope that you can commit to reproposing the Basel III endgame, and we strongly urge you to take that into consideration. With that, Mr. Chairman, I
Gentleman from
appreciate the
Massachusetts,
time.
Mr. Lynch, is recognized for 5 minutes.
Good morning, Mr. Chairman. Welcome. Good to see you again. I want to go a little deeper into the commercial real estate issue and the potential impact on regional banks. This morning, Scott Rector, who's a member of the New York Fed Board of Directors, released a white paper on CNBC this morning describing the trillions of dollars in commercial
Instead of
real
seeing a
estate
note from
loans
Wells
that will
Fargo on
come
the
due over
jobs
the next
report,
couple
they
of
say
years.
that the
He
gradual
described
rather
it
than
as a,
market
quote,
softening in the labour
slow-moving
market
train wreck,
will likely keep
close
the
quote.
FOMC comfortable in a waiting a
for
little
our
while
regional
longer
banks.
before
He went
cutting
on to
rates.
predict that it will force between a little over 500 banks, thereabouts, to either fail or consolidate. He also described what he termed as a doom loop where, similar to Silicon Valley Bank, when people lose confidence, when depositors lose confidence in the bank, they pull their money out and we end up in a bad situation. Now, I don't believe everything that I read or hear, but in Congress we do tend to repeat it. And I just wanted to get a sense from you. I am seeing in my own city of Boston, we've got 20% vacancy rates in office space. We rely on that for a lot of the tax revenues for the city. But I'm just wondering your thoughts on that issue. Is there a systemic concern here, or is this isolated? And might lowering the interest rates help some of those banks? Because I hear from my developers in our area that no one's lending. So, yeah, crack at it.
Sure. So I haven't seen that report, so I can't comment on it, but I can comment on commercial real estate. So we've had a secular change in the economy, which has left office rentals in many places, office buildings. The demand for them is significantly lower, at least temporarily and perhaps for a long time. And also the same is true for downtown, in some places, downtown retail that's associated with office workers. So it's a shock to the system, and we've known this for some time, and we've gone through the commercial banks in the United States, and so have the other regulators. We've done it jointly and identified the ones that have high concentration and are going to need to deal with that. And so we've been in contact with those banks and talking to them about how they're going to deal with this, how are they going to absorb these losses, do they have enough capital, do they have the liquidity, do they have a plan to do this, and is it consistent with their lending practices and that kind of thing. So it's going to be something we work through over a period of years, and I do think it's slow moving. I think that part of it is right. You ask about 500 banks. I have no idea about that number. But certainly there would be some banks, probably smaller ones, that have these high concentrations. It's not the very large banks. It's really a manageable thing at the large banks. So I think that's what it's going to be, and it's a serious problem, and more serious in some locations and jurisdictions and with some banks than others. But it's one we'll be working through, and I think that's how I would think about it.
Does the
Fed's
Silicon
power
Valley
says
Bank
commercial real
situation,
estate is a
Signature,
serious problem, and
the
more
money
serious
moves
in
so
some banks and
quickly
locations than in
those
others.
cases. It was instantaneous now. The velocity of money moving out of those banks really, I think, in some ways contributed to their failures. Are we looking at anything technologically that might be able to address some of that or mitigate it?
Sure. So we also, after Silicon Valley Bank, we got in contact with and worked with financial institutions that had high concentrations of uninsured deposits. And many of them have greatly improved their liquidity position. So that's the thing that we're working on. Okay. As you probably know, we're also working on some liquidity rules which will strengthen our framework of liquidity rules. But that's something we haven't proposed yet.
Let me ask you something off topic. So we know that Russia has about $300 billion in U.S. We've frozen assets. Russian assets of about $300 billion between U.S. and European banks. You want to comment on that? What I'd like to see is us give that to Ukraine, to be honest with you. I know that's a very simplistic idea, But I'm just wondering if there's any historic example that we could look to if Congress has to take the necessary steps to redirect that money to Ukraine so they can feed their people and fight that war.
This whole area of sanctions and foreign assets and things like that is really controlled and directed by the administration, by the elected branch of government. All we are is just a technical seat around, in the back row to help. We don't make those decisions, and I wouldn't comment.
I know you're big on history. I was just wondering if there was any examples out there that we might provide guidance to us.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, now recognized for 5 minutes.
Mr. Chairman, thank you for being here. When I'm back in my district in Texas, I'm constantly hearing concerns surrounding the fundamentally flawed Basel III. We've talked at length about that today, endgame proposal. These concerns are not only coming from my banking industry, but also from farmers, ranchers, small business owners who are concerned about how this proposal will impact the ability to access capital in the future. And to all of us, did it not raise alarms? And we've heard about the 97% today of public comments on this proposal, and they all came out negative. And Americans across all sectors are worried about the disastrous implications that will follow this proposal and have tried to make that known to banking regulators who continue to ignore them. It is time for federal regulators to take these concerns seriously and, quite frankly, just, I believe, start over. So I urge you and your colleagues to rethink the misguided policy and do what is best for American people, small business, Main Street America, and withdraw the Basel III proposal. Now, Chairman Powell, given the concerns raised by financial institutions, again, farmers, ranchers, et cetera, and other communities across the country, can you elaborate on how the Federal Reserve is responding to and addressing these comments that are mostly negative and request modification, delay, or complete withdrawal of the proposal of Basel?
Yes, I will. So we're in the process of reviewing the comments. They were quite voluminous. They were very detailed, a lot of data, a lot of analysis, and that's just what we wanted. So we've got those, and now it's a lot. It's hundreds of them, and we're going through them, and we're just at the point where we're about to begin then turning to the question of what changes should we make to the proposal. We haven't made any decisions. We haven't really gotten to that stage yet, but we're getting there. Remember, we only got the comments less than 2 months ago, so it's just we're at that stage. So we're looking at it. As I mentioned, my own view is that there will be material and broad changes to the proposal as we go forward, and we haven't really made decisions yet, though. It's just a little bit early for that.
We're glad you're looking at it. I want to bring up the long-term debt proposal rule, which would require banks to issue enough long-term debt to cover capital losses. Now, Congress worked to pass legislation requiring the tailoring of regulations to the size of a financial institution.
At 12 p.m. Eastern Time, we expect comments from Feds Daily, who gives a keynote address at the 2024 National Interagency Community Reinvestment Conference.
Would undo any sort of regulatory tailoring and puts into place a new long-term
text is expected, as well as a Q&A.
On regional banks, which require these banks to issue long-term debt both at the parent holding company level and the IDI level. Now, these regional banks will face increased costs when they are already facing towering regulatory burdens from this administration, and those are the banks that people do business with. So, Mr. Chairman, do you believe that this proposal rule goes against the requirements of S2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act, and will you commit to exploring this issue further with your colleagues?
So we're committed to implementing 2155. We believe that the regulatory and supervision of regulation and supervision of banks needs to reflect their size and activities, and that's something we'll be considering as we go forward with this.
Okay. Short time I got left. Americans continue to feel the pain from runaway inflation created by the Biden administration as everyday costs continue to stay expensive. As you know, I'm in the car business, and inflation is just running rampant in my industry. And the irresponsible and partisan American Rescue Plan forced through Congress by Democrats only made inflation more of a problem. And now American families and businesses have been forced to deal with runaway inflation for 3 full years now, which has caused some major hardships. So quickly, the ARPA injected nearly $2 trillion of deficit spending to our already struggling economy. And how does this type of inflated spending, combined with economic headwinds like supply chain shortages, impact the economy? And doesn't this kind of reckless spending actually fuel the pressures of inflation?
I think there are a lot of causes of the inflation we've seen. We saw this inflation everywhere in the world. So the reopening of the economy after with very strong demand and constrained supply. You saw inflation in all the advanced economies. It was a little sharper here at the beginning. I think there's a role for monetary policy in that. There's a role for fiscal policy. There's a role for the pandemic, a starring role for the pandemic. You know, our job is to deal with it, and that's what we've been doing.
Well, thank you for always keeping small business in Main Street America in your calculations. And with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Mr. Chairman, I want to thank you for recognizing in your opening statement the importance of immigrants in keeping costs down. And I want to thank you and the administration for what has been an excellent 2023 economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, you know, a one-month number. That's for the whole of 2023 and compares very favorably with the pre-pandemic portion of the Trump administration when we had inflation of 3.5%. My goal here is to convince you to cut more and sooner because for a number of reasons. The first is that I know, you know, if you ask a constituent, they want zero inflation and zero unemployment. You know that we can't have that and have concluded that the economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates, but as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis?
At 12 p.m. Eastern Time, we expect comments from Fed's Daily, who gives a keynote address at the 2024 National Interagency Community Reinvestment Conference. Text is expected, as well as a Q&A.
Not really, no. What's happened is, you pointed out in New Zealand, but what's happened is that 2% has become the global standard, and it's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. You know, we're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street. And you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis, it's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded, without objection, like to put in their article into the record. And so they're, in effect, going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got, in Basel III, ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank and is very necessary for first-time home buyers. And you've got a system where if you make
and dollar yen slips to a 3-week low, last down 0.6% to 149.16.
and mark to market. So I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.
Gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Well, thank you, Mr. Chairman. Mr. Powell, thank you for being here today. I'm concerned with the small dollar credit for businesses. As a former business owner for over 20 years, I can attest that as the small dollar business credit becomes more expensive and less convenient, businesses are going to turn to credit cards and other alternative financing for business purchases. These inevitably result in even higher costs, which goes down to the consumer, which means that they're going to pay more for the services or the products. But in February of this year, total credit card debt reached a record of $1.7 trillion. According to Intuit's Small Business Index annual report, average monthly credit card balances were 27% higher in 2023 than they were in 2019. What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy, so that'll be part of it. Just that it's a bigger economy and a bigger number. I'm not sure what that is. As you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down. Now they're borrowing.
1 minute remaining.
I'm not sure.
So, if there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, if you raise lending costs for banks, then at the margin that will make non-bank lenders, they'll get some of that business.
And if it becomes more complex or less convenient, then businesses will turn to these alternative forms like credit card. I can tell you that from experience. Yes. Well, I've called for the withdrawal of the Basel III endgame proposal entirely. Will you commit to an analysis of how bank capital proposals like Basel affect small business credit access and the small dollar lending before finalizing such proposals?
I commit to that. Let me look into that. I don't want to make a commitment that I'll undertake some big study, but we'll look at the
Fed's
issue.
Daily recognizes the high rates are also raise housing costs and says we are committed to finishing the job on price stability. Higher interest rates do raise housing costs temporarily, but are needed to bring down inflation. Rising housing costs have been a key driver of higher inflation, and the Fed is focused and resolute on getting inflation down.
Withdrawing the proposal with Vice Chairman Michael Barr or the other governors?
So I don't want to get into our internal, doings, but I will say that I understand it is a live option. Again, we're not at a stage of being able to even have that discussion yet because we're not really. We've got to decide first what changes do we think are appropriate, and that'll take a little time. And then the question will be reproposal. What I said is, when we get to that point, if reproposal is the right thing to do, we're not going to hesitate at all. It's a perfectly live option.
All right. In the current environment we have,
Yemen's Houthis say they targeted a bulk carrier, True Confidence in Gulf of Aden.
But I think you could find some agreement in withdrawing that proposal. Can you explain the importance of broad consensus at the Fed on proposals like B3E? Are you concerned with recent trends of disagreement among board members related to major proposals?
So I think we're going to get to broad consensus at the Fed. I do. I think it's very important. This has been our culture that we try to find common ground, and we've been able to do that in the regulatory space, and I expect we will be here as well. And I'm committed to that.
Could it be that we're seeing this level of disagreement because of extreme measures that are being taken now that may not have been taken in the past? I mean, a total difference of opinion and understanding and philosophy regarding a free market economy.
I won't speculate, but I will point out that 4 of the 7 governors during the open board meeting at which we put it out for comment, expressed real concerns, very specific concerns about the proposal, and said we would look at the comments when they came in, and that's what we're doing.
All right. Do you feel that they have validity in their concerns?
I was one of the four, so yes.
All right. With the few seconds I have remaining, there's a recent report of FinCEN working with financial institutions to query legal purchases made by American citizens. Has the Federal Reserve been instructed within the past 3 years by Treasury or anyone else to search Americans' legal transactions?
Not that I know of, no.
Okay, thank you. I yield back.
Gentleman from Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for being here. As Ben remarked, there's a near-term emergency to get the $60 billion in military assistance to Ukraine. And separate from that, there remains a longer-term need for reconstruction assistance to Ukraine, which the World Bank estimates is somewhere north of $400 billion. Now, at the start of the Russian invasion, the free democracies of the world froze roughly $300 billion in Russian currency assets, primarily at European banks and financial institutions. And the Biden administration and many of our allies have recently taken the stance that those assets should be leveraged somehow to provide reconstruction resources to Ukraine. I support this concept, and I believe that additional action should be taken to ensure that we hold Russia accountable. But there are real concerns on the impact that this might have on central banking system, on the primacy of the dollar, the euro, and so on. And so my question is, have you seen just the act of freezing these assets and not seizing them, but simply freezing them? Have you seen deleterious effects on the primacy of the dollar, the confidence in the central banking system? Is there any visible downside from the act of freezing that's visible so far in the 2 years since we've done it?
I can't point to any. I can't point to any.
Okay, so that's an interesting observation when we think of taking the additional step of actually seizing them, that at least so far, because, to my mind, having them frozen is as violent as and as violent as seizing them outright. And so that's interesting that so far we haven't seen that. Now, in terms of the Basel III and so on, there is there's a frustration I've had over the fact that directionally the effects of these are clear, but the magnitude of effects are not. For example, if you talk about the effect on the prices seen by derivative end users of increased capital requirement, directionally it's clear. If you raise capital requirements, banks will withdraw from these markets to some extent. Other players will step in partly and take up part of the slack, and the spreads will increase and so on. Is the data that you've collected enough for you to actually estimate the magnitude of these effects instead of simply the direction?
I think it's really hard to get down to the micro level and try to assess that, because you're right, there would be multiple effects. But you do know that you know the direction, you know what the sign is.
That's right, but if you can avoid financial crises with a microscopic increase in prices seen by end users, that's one thing. If it's a very large difference in the price, so that the magnitude matters a lot when you're doing these balancing things. And a lot of it depends on, actually, you need a model for how the different market players will react. And is that really not going to be in the scope of the analysis that you anticipate from the quantitative?
I believe we have done some work on that, and I think the banks and other participants have done work on that as well, and come up with a range of answers. But this is there are just an awful lot of variables in these equations, so it's hard to say with any confidence. That's why it's hard to, the job of deciding the precise level of appropriate capital is a hard one.
Yeah. And now with 10 years, we've had two major crises with both a fiscal and a monetary response. Are there the lessons that you can learn now that, I believe, and it seems like your testimony indicates that we're kind of approaching back to normal now? And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was, less than half of the output gap. and we limited by political political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade, and we had a long recovery. And the comparison, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now. And we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr.
Fed's
Davidson.
Powell says we should be prepared to be surprised by the next chapter in the economy.
Thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III endgame, and I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risks actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our countrymen pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money's sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. The alternative is you could simply raise requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. Banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy, they don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with the Fed over it.
According to the IIF, China stocks see $9.6 billion in inflows, the most since January 2023, and bonds post $6.5 billion in outflow.
So their incentive to lend is the same as it always was. This doesn't affect that. Really, it's they have a cost of funds and they have the ability to have reserves, but that's not going to. They're not earning a profit on that. So, or a big one, they can earn a much bigger profit by lending to small corporations.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, we've, for many years,
New York
during
Community
the QE
Bank Corp
large balance
halted.
sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.
The gentlewoman from Ohio, Ms. Beatty. Mrs. Beatty is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our ranking member, and thank you, Director Powell, for being here. Let me start by saying thank you for the monetary report. I've had a chance to try to peruse it, and there are headings in there that says the labor market remains strong. You'd probably agree to that, your report.
I would.
Let that say that's a yes. Also, it talks about unemployment rates being low by historical standards. You'd agree with that? It also states that the global pandemic played a huge role with the inflation rate, and inflation rates are on the decline, as reported in several charts in here, and also substantiated by the Federal Reserve of New York and Michigan surveys that I've read. It also talks about job gains and uses the word robust jobs. So I want to thank you for educating us on that. And Mr. Chairman, I'd like the record to show that all of this also resulted during the Biden-Harris administration of making sure. So often we hear in this committee and other committees about what the administration is not doing and what our economy and jobs look like. Now let me move on to something that's very
KBW
dear
Regional
to me,
Banking
and
Index
wanna
down
thank our ranking
2.9%.
member for bringing it up, and that's the lack of affordable housing, which is one of the primary things that I hear about when I'm back home. I'm on more panels to try to explain what you do, what we do, or oftentimes what we don't do and why we have this. While I know that interest rate hikes have successfully brought down the inflation, rising rates have also had an adverse effect on the cost and the pace of housing construction and costs. Are you concerned about the effects that interest rate hikes are having on the cost of financing new construction? And the second part, how do you expect to control for long-term housing inflation that might have a potential rate cuts, how it might affect that?
So our policy to bring inflation down is to raise interest rates, and that works through several channels. One of them is probably the most important, is interest-sensitive spending, and within that you have housing and durable goods and things like that. So, during the early days of the pandemic, the housing industry was about to all go bankrupt, and all of the facilities that we did really supported that industry through their critical time. When we're going in the other direction, when we're raising rates, housing is definitely affected. We understand that. It's not something we want to have happen, just it is the reality that housing will slow a lot when you raise interest rates. We've done that, and we're doing it for the longer run benefit of the people we serve to restore price stability, which is beyond value for people to have price stability. We get it that in the near term, that's higher rates, that's fewer sales, people are locked into low rate mortgages, we get all that, but we got to do this because it'll benefit the country and people in the longer run.
And I have a great appreciation for that. But also, when I go back home to the district, what I hear a lot from agencies and individuals who work with advocacy groups, that the effects of interest rate hikes are not borne equally to all American households. So we hear that, and there's no doubt that low-income and minority communities are hit the highest or the hardest by these monetary policy changes. Black households and business owners have historically faced challenges with home ownership and access to capital, and they're disproportionately impacted by the rate hikes. Does the Fed, do you have anything that you could help me with this dilemma and how we can better achieve economic goals in a more precise and equitable manner?
So I think it's working. You see inflation coming down, and that's why I do think it's likely at some time this year, if the economy, proceeds along the path we expect, that we will begin to reduce rates. So that's really the path that we're on, and I do hope it works out that way.
And when you say, I don't have a lot of time.
Powell
but when
says
you
it
say
is likely
economy,
sometime
what does
this
that
year,
mean?
if the economy
Helping poor
evolves
people,
as
black
we
people get
expect,
more
that we will begin
jobs,
to
more
reduce
money?
rates.
So our forecast is for continued strong growth, a continued strong labor market with wages going up and also with inflation coming down. So that kind of an economy.
Okay, my time is up. I yield back. Thank you.
The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman McHenry and Ranking Member Waters, for holding this hearing, and thank you, Chair Powell, for being with us today. I'd like to start by discussing the Independent Automated Teller Machine Owners or Operators section of the Bank Secrecy Act Examination Manual. I want to ensure that financial institutions will not be discouraged from providing banking services to the independently owned ATM industry. In 2021, you made it clear that the industry does not automatically present a higher risk for illicit finance. I'd like to know what efforts have been made by the Federal Reserve to fully communicate that position to financial institutions across the country.
I will have to get back to you on that one.
All right. Thank you. Well, and so I might just add, listening to independent ATM operators over the time that I've served in Congress, I've come to understand that unfortunately, and it was in the Bank Examiner's Manual up until just about a couple years ago, these operators were identified as being extraordinarily risky, and that was causing them to be debanked in many cases. So I do hope that you'll take a look at that and make sure that we're communicating that to financial institutions and, most importantly, to the regulators. Chair Powell, Tennessee is home to over 1,000 foreign-based businesses that have chosen to invest in our state and create more than 160,000 jobs. These jobs are reliant upon cross-border financing provided by global banks, including foreign banking organizations. The Federal Reserve has long maintained the principles of national treatment and equality of competitive opportunity when regulating foreign banks and assessing them based on their U.S. operations. Are you still committed to these principles?
Yes.
And how will these principles be reflected as you move to finalize the Basel Endgame proposal?
So we have received a whole separate set of comments from the foreign banks, and we'll look at those, very much in that spirit and make appropriate changes.
Thank you. Chair Powell, the Basel III Endgame will incentivize firms to transfer credit risks off their balance sheets. One avenue for such a transfer is synthetic securitization, the framework of which must be approved by the Federal Reserve. However, it is my understanding that there is a substantial backlog of reviews and approvals of these securitization frameworks. It is concerning that the Federal Reserve is directing the risk transfer, yet also impeding it, in my view. Can you comment or can you commit to reviewing this approval process and taking steps to reduce the backlog of pending securitization applications?
So as I understand it, these transactions are becoming popular right now. There's a lot of appetite to do them, and we're not stopping them. We're just being careful because there were similar things that happened about credit risk transfer during the global financial crisis that didn't actually work out. So we want to make sure that these structures really do actually durably transfer. And we think that they do, but we just need to be careful because the last experience with these was difficult back in the last crisis. So it's just something that we're not intending to slow these down, and I think we'll try to get through it.
Is it a lack of available resources to apply to the approval process, or is it an intentional slow walking to make sure that every I is dotted, every T crossed?
I don't actually know, but I do. What I heard was, what I have been told is, we're not stopping these, but we're going to be careful with them and just be absolutely careful that they really do transfer credit risk in a durable, kind of sustained way. And that's the thing. And I don't think it's an intention to go slow or to have a backlog. It's just, and so I don't know what the staffing issue is. We'll check.
All right, thank you. As the Federal Reserve continues to consider proposals designed and debated in Europe, such as Basel III, has the Federal Reserve Supervisory Climate Committee or the Financial Stability Committee had any discussions regarding the adoption of ESG risks in capital requirements?
I don't know.
Has there been any discussion in other committees regarding the adoption of ESG risks in capital requirements?
Any discussion, I really don't know. Let me say that's not something we're considering, but when you ask me any discussion, I don't know.
It's not a priority in capital requirements.
To put it mildly, yeah.
Okay. Thank you. I see my time is running out. I appreciate your answers, and any further light you can shed on those matters, I'd appreciate. I yield back, Mr. Chairman.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here today. I want to start just with following up on the exchange you had with Mr. Sherman. As I think you know, I led a letter with 106 of my colleagues with concerns about specifically the clean energy tax equity provisions in Basel. I appreciate your commitment to look at that. I wonder if I could just put a little bit of a sharper point on it. Can you look at that before the rule is finalized and potentially issue some sort of an addendum to the rule? The concern I have is the number of banks who are a little bit frozen right now, waiting for some clarity on that, and I'd prefer we not slow down the rate of clean energy investing in our country if we don't have to.
I don't know. I mean, I think there's a proposal, and we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it. But we're making good progress, and I think we'll be back reasonably soon with some answers.
Okay, well, time is of the essence. Appreciate anything you can do. Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
It's probably closer to neutral, actually, because
Fed's daily says policy is in a good place and there is more work to do.
So it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and or downward pressure on wages.
More workers, so that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from inflation.
And Fed's daily says, I'm encouraged we've been able to bring inflation down with labor markets solid.
You all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future. Can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version of the other. We study the CBO numbers carefully. We're just trying to get to the right answer. And but I mean, I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen, the lower quartile of earners starting to close some of those historic gaps. We've seen minority groups and women start to close some of those gaps. What I didn't see, and I don't know if this is because you all haven't done it or I just didn't read closely enough, have you seen any gaps regionally within the U.S.? Are there parts of the country that are seeing stronger wage growth than others?
There are. I don't have that off the top of my head. I want to go back and, if I can just, when I talked about immigration, I think that the immigration story for last year was part of the positive supply shock and was part of the reason why inflation came down. I was really asking the question over the longer run.
Fair enough.
And there, I think it's more of be neutral.
I appreciate that. I want to just close on this regional piece because the Atlanta Fed, which is the best I could find that looks to do at least some by census regions, that as I look through, there's and you look at which regions are consistently running above. I think that New England and the West are consistently showing wage increase above average. And the West, South, Central, Texas, Oklahoma, Arkansas, Louisiana are consistently, I think going back to like July of 2022, consistently seeing wage growth below average. And I appreciate you're not going to wade into a political question here, but those are all right-to-work states where it's harder to unionize, where it's harder to organize. And what I'm wondering is, without asking you to opine on policy, have you all at the Fed done any analysis that says, as we look at when there are gains in labor productivity, does that gain in labor productivity, is it more likely to accrue to workers in those states where there's a stronger union presence, easier to organize, and more bargaining power for labor as opposed to capital?
My guess is there's plenty of research around that area, not necessarily at the Fed, but we'll take a look and come back to you.
Okay. All right. Thank you. I yield back.
Gentleman's time's expired now. Go to the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. We continue to appreciate your work and the work of the Federal Reserve on behalf of the American people. In August of 2023, the Federal Reserve, FDIC, and OCC released the NPR requiring the issuance of long-term debt for Category 2, 3, and 4 banks. As you may know, I, along with many of my colleagues, authored a letter to each agency expressing concerns regarding the lack of tailoring in the proposal and shortcomings in estimating the actual cost of the proposed rules. I'm concerned that these shortfalls will negatively impact lending in my district, and when combined with the other ongoing regulatory proposals, could cause further consolidation of the banking industry. It appears that the Federal Reserve has primarily deferred to the FDIC concerning the proposal. Could you shed light on the Federal Reserve's role within the rulemaking process concerning the long-term debt proposal? And have you provided input regarding the proposal's interplay with Basel III Endgame?
I think we're one of the proposers of the rule, just like the other agencies are. And right now we're looking at the comments that we've gotten. That comment period, I believe, has closed. Yeah, and so we're very much in reading those comments as the law.
You're in the middle of it. Fair to say. Okay, thank you. I'm concerned that the long-term debt proposal's lack of tailoring contradicts the statutory requirements of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Instead of applying tailoring principles, this proposal creates Category 2, 3, and 4 financial institutions identically for the purposes of long-term debt issuances. Additionally, the proposal unduly burdens Category 2, 3, and 4 banks by requiring them to issue long-term debt at both the parent holding company and bank level, which actually could be viewed as reverse tailoring, considering GSIBs are only required to issue debt at the parent company level. What is the underlying rationale behind this dual requirement, particularly when such a mandate is not imposed on our largest banks? And do you believe that this represents a tailored approach as required by the statute?
So that
Fed's Daily says holding on too long with rates could create an unforced error and hurt the economy.
Thank you. It's my understanding that Category 4 banks were not included in the original advance notice of proposed rulemaking for the long-term debt rule released in the fall of 2022. Is that your understanding as well?
I didn't catch that.
Did the advance notice that was released in the fall of 22 include Category 4 banks? It's my understanding that it did not.
I can't confirm that, to be honest.
Well, I think that's something that you should take into account because the Category 2 and 3 banks have had an additional year to foresee this challenge, and so Category 4 banks are really behind the 8 ball. And Yeah, so I guess my next question is, do you believe regulatory agencies should provide smaller regional banks longer than the 3-year phase-in period to meet any final long-term debt requirements?
It's a good question. That's one of the comments we've gotten, and we'll be looking at that.
I appreciate it. I just think if we're going to impose these new regulations, giving everyone the same opportunity to comply with them is something worth considering. I guess one final question. If these proposed regulatory changes had been in effect prior to the fall of SVB and Signature, do you believe the outcome would have been different? Because honestly, I don't think anything would have changed.
You know, it's hypothetical. I'm tempted to say that if there had been more long-term debt there that was specifically there to absorb losses.
They were nowhere near being solvent, but I guess that's something I think y'all should take into account, whether if these proposed changes to our system that are designed to make it more resilient would have actually caused SVB and Signature to have a different outcome. Because again, it just seems that my colleagues across the aisle let no crisis go to waste, and these are changes that would not have in fact prevented the calamity that they are justifying the changes based on. Thank you for being here today, and with that, Mr. Chairman, I yield back.
The gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. Due to the Fed's aggressive interest rate hikes, mortgage rates have surpassed 7%, rising to 20-year highs, leaving many credit-worthy and mortgage-ready homebuyers without a path to home ownership. This is a problem for everyone. It's an urban issue, it's a suburban issue, it's a rural issue. Chairman Powell, I welcome the decision of the Fed to pause rates at the end of last year. But for families in my district and across the country, that is not enough. We need the Fed to start cutting because, like the rent, interest rates are too damn high. Chairman Powell, you've previously indicated that the Fed may cut rates this year. What would you expect the impact of lowering interest rates to be on the housing market specifically, including the rental, purchase, and construction market?
So we know that higher rates, of course, have slowed down the rate of activity. So if at such time as we start to lower interest rates, housing market will pick up broadly across new home construction and new home sales. The number, as you know, many households are in very low rate mortgages, and they really can't sell because they'd have to refinance into a high rate mortgage. That'll go away over time. So ideally, the housing market would go back into a more normal phase, but one with lower inflation in the broader economy.
Right, so just to further reiterate that, interest rate cuts would have a great benefit. Just yesterday, actually, I met with a number of representatives from state housing finance agencies from throughout the country, and they were talking about the barriers to affordable housing projects given the current interest rate environment. Obviously, higher interest rates have raised costs for affordable housing developers, and many of them have chosen to slow down or halt construction entirely. So fewer homes are being built, which means fewer people are being housed. So given that would you agree? So given that we already had a massive shortage of affordable housing supply prior to the pandemic, when interest rates were below 2%, the current rate, 5.5% rate, has been devastating. And the price of homes across the country have remained stubbornly high. It's clear that the current state of our housing market is impacting everyone and disproportionately hurting those who need stability the most. Does this concern you?
So our job is to do price stability and maximum employment. We don't target the housing market. And we're doing our jobs. That's what we're doing. It's not something we want to see, but
does this impact on the housing market? But does it concern you, Chairman Powell?
Does it concern me?
Yes. Fewer homes are being built, so fewer people are being housed.
This is the job we've taken on.
All right. Well, it concerns me greatly. Chairman Powell, the Fed's interest rate hikes have not been sufficient in addressing housing inflation. Do you agree that we need a more robust fiscal response to increase the supply of affordable housing and to lower costs nationwide?
So we don't take opinions. We don't express opinions on things like that. I will say that there is a structural housing shortage in the United States, and that's really the longer run problem. The problem with high interest rates is a short run problem. The longer run problem is lack of supply.
Well, that's why it is critical that Congress pass legislation and appropriation bills that will make those necessary investments in housing for all. You know, given the way that Ranking Member Waters fought for a $150 billion investment in housing and Build Back Better, I know on this side of the aisle that my colleagues and I are ready and waiting for the Republican majority to take housing inflation seriously. Housing affordability is the #1 issue I'm hearing about from my constituents. Families in my district and throughout this country need relief now. I truly hope the Fed will listen to them and cut interest rates. Thank you. I yield.
Gentlelady yields back. The gentleman from South Carolina, Mr. Norm, is recognized for 5 minutes.
Thank you, Chairman Powell. I think other people have noted about the crisis in the office building market across this country. That's a line of work we're in. I can tell you it's real. I can tell you the buildings that are effectively vacant, it's going to have an effect on the taxes paid. It's going to have an effect on rents. As far as affordability in housing, you know, the rates are one thing, but my good friends on the other side of the aisle don't realize that housing has got over 200 components to it. One of the biggest is gas prices. And as long as we're buying gas from countries that hate America and don't manufacture our own, housing isn't coming down. I don't know how you define affordable anyway. It's going to continue a downward slide. And I'm from a state in South Carolina that people are moving in. And we're not going to have the housing starts that we should have because of the policies of the Biden administration, which is train wrecking this entire economy. On regulations, on Regulation 2, which is has the guardrails for credit card fees, how do you answer and I know the caps you're looking at adjusting that. How do you answer the charge that this is really should not be, you're getting in the way of banks charging fees according to what their costs are? How does the regulations affect that, particularly Regulation 2?
Is this a Fed regulation we're talking about,
yes,
or is this a CFPB regulation?
No, this is, for my record, it's the Federal Reserve has finalized the routing and restrictions and proposed tighter and adjusting the price caps that currently exist. Is that not right?
It doesn't ring a bell with me. It may well be right. I'm not familiar.
If you could look at that, I know all the credit unions and banks have got some concerns on that.
I will come back to you on that.
Okay, I appreciate it. Do you need a letter from us? Or
No, we'll come back to you.
Okay, thank you. CRA, for those of us who have been involved with banking for a long time, the regulations having a clear set of standards that we abide by and know where to put the money to. When should we have regulations out that we can read about what's going to be acceptable and what's not?
Sorry, I didn't get your question.
The regulations on the changes in regulations for CRA.
Right. What about it? I'm sorry, I missed your question.
When are the regulations going to be out that we'll know, the banks will know what's acceptable for CRA and what's not acceptable?
So the final rule, of course, is out. I think we're working on, there's a lot of work to do. The requirements don't really kick in, most of them, for a couple of years at least. So I think we're working on the follow-up regulations.
Okay, that's really important for all the banks because they want to make sure they qualify, and where the dollars are spent, they need to make sure that it's going into the right spot because the credits won't be applied unless that's it. The Fed now, where the Federal, I think, Reserve launched and is operating this now, how is the participation rate going with that?
Slow, real slow. It's early days. There are network effects. These things they go slow until they don't. And it was the same way with ACH. You may remember back in the day.
Right.
So we're at fewer than 500 banks are in there now. We're working away at it. We expect it'll take some time, but it's there, and we think it'll be beneficial. We had a lot of support from smaller banks to build it, as you know.
Is the pricing below cost?
I don't believe so, no, not longer run cost.
Okay. Okay, that's all the questions I have. Thank you for being here.
Gentleman yields back. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
I want to thank the chairman and the ranking member for this hearing, and to you, Chair Powell, for appearing before the committee to discuss the recently published monetary policy report. As we continue our work on behalf of the American people, we have to keep in mind that our mission here is to grow the economy from the bottom up and the middle out. It seems as if there has been a constant series of shocks to the economy, both domestically and globally, and yet we can all see just how resilient the labor market has been as it has maintained its strength. With a robust gain of 353,000 jobs, the January numbers are a continuation of the trend that Democrats in Congress delivered through historic investments in our workforce, putting people over politics. In light of this relative economic strength, I really want to implore the Federal Reserve to take stock of the holistic economic picture before making decisions on monetary policy, and to pay particular attention to those communities that have been historically left behind during times of accelerated recovery. I want to add to the questions from my colleague, Congresswoman Presley, Chair Powell. At a time where it has become increasingly difficult for working people and people of color in particular to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a home provides. So what actions, if any, is the Federal
The New York
Reserve
Community Bank Corp tumbles 40% and is halted as troubled bank reportedly is seeking cash infusion.
Have on minority borrowers who disproportionately rely on high LTV mortgages due to the generational wealth gap that persists?
We've received comments, including many, on the mortgage changes, and we understand the concerns, and we're looking very carefully at that. Haven't made any decisions, but we will announce them when we have.
Are you concerned that these shifts in risk weights will reinforce the decade-long retreat of banks from the mortgage market and push more originations to non-bank institutions?
That's a question that people are raising, and it's something we take very seriously, and we'll be taking that into consideration as we decide about that change, that recommended change.
Could you discuss why you feel it is necessary to include new requirements around operational risk in Basel III in light of recent claims that it will significantly increase the cost of or prevent banks from offering altogether necessary services such as underwriting, investment advisory, or insurance?
That is one of the concerns that's been articulated about the proposed changes to operating risk. We take those concerns seriously. As I mentioned, we're in the middle of looking at these things, and then we'll soon, in the process of turning to the question of what changes to make.
Well, I just would underscore the sense of urgency, because the longer there's uncertainty in the market, it creates really negative effects to end users, which are all of our constituents who are looking to see these costs come down. Let me shift. This Congress, under the leadership of Ranking Member Waters and former CBC Chair Joyce Beatty, I've made it a focus of my efforts to educate my colleagues and the public at large on the far-reaching benefits of increased diversity in the workplace, in our boardrooms, and in society as a whole. Despite the efforts by some on the other side to take away the very tools of economic opportunity that create inclusive work environments and improve performance, there has been a really misguided assault on everything from diversity, equity, and inclusion to other programs following the aftermath of the Supreme Court's ruling on affirmative action. So Chairman Powell, as you know, your Office of Minority and Women Inclusion has a focus on this. So as we anticipate the upcoming release of your annual report on inclusion, would you be able to speak to the necessity of collecting this data that minority and women-owned businesses are included in the board's contracting and acquisition opportunities?
I do believe we collect that data, and we monitor that very carefully.
And why is it important?
Well, I think diversity in the workplace is an important thing, and you won't know how you're doing unless you measure it.
And just as the McKinsey Institute released in their Diversity Matters Even More report, companies that have more diverse management teams actually outperform companies that don't. That goes to the bottom line of our economy, and I wish my colleagues on the other side would stop their assault on diversity, equity, and inclusion and actually work with us to
Well, you'll review the economic impact as the empirical data comes forward.
We're not in the business of scoring, or, I mean, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you. I'll shift gears again. One of your two mandates is to maximize employment in addition to maintaining price stability. And as you know, government hiring has accounted for a large share of total job creation. More than 600,000 public sector jobs were created last year, and the federal government now employs nearly 3 million workers. So when you're examining employment data, how does the Fed view the impact of the public sector employment growth relative to private sector economic growth? In other words, how do the two data points factor into your assessment of how the broader economy is performing?
So the jobs are jobs, right? But I think we would tend to look at private sector jobs to get a better assessment. Private sector job creation is a better indicator of kind of the private sector momentum in the economy. But we look at both. I mean, they both count.
And does the dramatic increase in the private sector number of jobs give you any pause or concern as it relates to?
You mean in the public sector?
In the public sector. Sorry if I misspoke. Yes, the public sector.
The truth is the public sector was unable to hire at the beginning because wages went up a lot in the private sector at the beginning of the pandemic inflation, and public sector can't respond to that. So there's some catch-up hiring going on there now. Now that things are settling down to normal, I think there's some catch-up hiring. I'm not sure it's an issue we're concerned about.
Okay, I'll shift gears in my final minute just to talk a little bit to get your perspective on the macroeconomic developments that are having an impact on our monetary policy. Specifically,
Fed's Powell says the pace of public sector hiring is not something the Fed is concerned about.
The data is probably too early to tell whether or not we're having a true productivity view, but how does the Fed view the adoption of some of these new technologies, in particular AI, as it relates to labor productivity?
So everyone's looking at AI for that question, and it's hard to say, actually. We've had really nice productivity in the last year or so, but it's probably still very much affected by the post-pandemic factors that we're seeing. I think we need to see more to understand whether there is a longer-term boom. AI certainly has the capacity to either augment labor or to replace labor, and that's a key question. We really don't know which of the two it will do. There's tons of money being invested in it, and so it's likely to drive significant productivity. I would say
And Powell says AI certainly has the capacity to augment or replace labor. I'm not sure which one it will do.
Tight labor market, and also the rise in startups. There were a lot of people started companies during the pandemic. Those are the kind of things that do add up to higher productivity over time. So there is hope that we'll see some productivity out of this.
Thanks for your comments today, Mr. Chair. I yield back.
Gentleman yields back. We'll go to the last questioner of the day, the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Chair, I have several questions about some of the most common complaints that I've heard about Basel III
Powell says
Endgame.
there is hope
I
that
have an
current
open mind on the
productivity
subject, but I
gains
wanna
will
hear
be
your response
sustained.
to some of the arguments that have been leveled against it. First, the Fed has repeatedly reassured the public that the banking system is well capitalized. Yet the Fed is advancing Basel III on the assumption that the banking system is undercapitalized. So the first question is, how do you reconcile the Fed's repeat assurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? The second question, if the purpose of Basel III is to align U.S. banks with their banking peers elsewhere in the world, why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, and you testified, repeat reassurances about the capitalization of the bank.
So I addressed this in my remarks in the open board meeting. You know, higher capital is always going to add to safety and soundness, but there's a cost.
Right.
And so identifying the precise right level is very, very difficult. Hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I posed, and I voted for all these increases during Dodd-Frank. So I think it's a very fair question. We'll be looking at that. The second one was
the concern about gold plating.
About
gold plating?
Oh, gold plating. Yeah, no, it is, and I said this in my public remarks that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing. And so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something.
Yeah, so Congress passed a statute requiring regulatory tailoring.
No, that's
and do you think Basel III is in compliance with that statute?
I addressed that in my comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks, but we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
You know, the collapse of SVB was largely a story about liquidity risk and interest rate risk, yet the focal points of Basel III are credit risk, market rate risk, and operational risk. Like, what is your response to the criticism that the Fed should focus its energies on addressing the forms of risk that were responsible for the SVB bank failure rather than focusing on forms of risk that were largely unrelated to it?
So I agree with that, but I would say we are working on a package of liquidity measures which directly addresses the Silicon Valley Bank situation. We've also taken a lot of supervisory actions with other medium and small sized banks that had a lot of uninsured deposits and a lot of real estate risk and things like that. So we've been doing quite a lot on the supervisory section that it doesn't require new rules.
And then finally, as you know, the crippling cost of housing accounts for a third of inflation. One of the most powerful tools for producing and preserving affordable housing is the low-income housing tax credit, which has financed nearly 4 million units of affordable housing. The banking system accounts for 85% of LIHTC investments, and there's a concern that Basel III, in its present form, would diminish the availability of LIHTC and the amount of affordable housing development. And so I'm just curious, is that on your radar, and is that something you're willing to examine?
Yes, it is.
So with that, I'll leave it at that. Thank you.
Gentleman yields back. That's the final questioning of the day. We committed to the chair that would be done with a hard stop by 1 p.m. It's nice when we can honor our commitments. So I'd like to thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days in which to submit additional written questions for the witness to the chair. The questions will be forwarded to the witness.
Powell
for
ends his appearance
response.
before
I ask you, Chair
Congress.
Powell, please respond as promptly as you possibly can. And with that, this hearing is adjourned.
And Fed's Daily says we are on a path to bring inflation down as gently as we can.
Monetary policy testimony up on Capitol Hill. A very good afternoon, everybody. Welcome to an extended version of Bloomberg Business Week live on radio, TV, YouTube, and Bloomberg Originals on this Fed Wednesday. A lot going on. I'm Carol Master along with Tim Stenovic, and welcome everyone, because Wall Street, I think it's safe to say, Tim, breathing a bit of a sigh of relief, if you will, because it feels like we pretty much got the same message, a very similar one from Jay Powell that we got from the last FOMC meeting.
Yeah, I think that's true. A strong economy is going to keep officials on hold for now, though he does expect the Federal Reserve to cut rates this year. Meantime, Carol, as this was all happening, we were watching shares of New York Community Bank Corp because they were tumbling on a Wall Street Journal report that the bank is trying to raise equity capital. At one point, it was down as much as 47%. Shares now halted pending news.
All right, so that's all front and center on this Wednesday. We're also waiting in just a couple of minutes the beige book from the Federal Reserve, from those regional Fed banks. In the meantime, let's get an update on the trade. Let's head on over to Charlie Pellet with a check on that and your top business stories. Hey, Charlie.
Thank you very much. Indeed, lots of moving parts to this market. We've got you covered right to the numbers now, with stocks in the green, very close to session highs right now on the S&P 500 index, up 41 at 51.20. We're looking at a gain right now of 0.8%. Dow Industrials up 174 now, higher by 0.5%. The NASDAQ Composite Index up 157, a gain right now of 1%. 10-year yielding 4.09%, with a 2-year right now at 4.53%. Spot gold higher by 0.8%, 21,044 on gold. West Texas Intermediate crude WTI now with an 80 handle. WTI up 2.4% right now, and Bitcoin 67,245, up by 6.2%. New York Community Bank Corp trying to raise equity capital to help restore confidence in the beleaguered company. That, according to the Wall Street Journal, citing sources. A trading halt on NYCB, down last trade by 42.4%. And finally, Deutsche Bank has cut the bonus pool at its investment banking division by more than 10% after a slump in deals and a slowdown in trading last year. Again, recapping, Powell speaks, stocks higher, S&P right now up 41. That is a gain of 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. Carol Master along with Tim Stenovic live here in our Bloomberg studio at Bloomberg headquarters. Obviously, the main event is what we just heard from Fed Chair Jay Powell up on Capitol Hill. Charlie breaking down some of those key points. The Fed Chair reiterated to lawmakers at the U.S. Central Bank, no rush to cut interest rates. Feel like, Tim, we got a little bit of everything. And the Fed Chair really pointing out the importance of not going too soon and also not going too late in terms of making moves to cut rates.
Yeah, here's what he said. We believe that our policy rate is likely at its peak for this tightening cycle. He repeated language used at his last press conference just at the end of January. He also repeated his claim from the January press conference that rate cuts are likely to be appropriate at some point this year. And, you know, I think the market's reacting accordingly.
All right, so let's get to it with more on Chair Powell's comments and U.S. financial market reaction. Delighted to have with us Bloomberg News international economics and policy correspondent Michael McKee. He's there in our D.C. bureau. He's been listening all morning. So, too, has Bloomberg News markets reporter Abigail Doolittle. She's here in our studio. And, Mike, I want to start with you. It does feel like we understood the message at the last FOMC meeting, and I feel like we got a lot of that as well. But what for you, was there anything that was new, nuanced, a little bit different from the FOMC meeting? What is it that was so important in terms of what we got from the Fed Chair today?
I appreciate your asking, Carol, but
Anything new. I mean, this was the functional equivalent of Wall Street hoping for a new suit and getting hand-me-downs. It was the same old from the Fed chair. He really can't say anything else at this point. It was more explanatory than anything else, and it's a story that traders have heard now for some weeks from Chair Powell and many other members of the Open Market Committee. But what did stand out today, and what was maybe a little bit of a surprise, was how much bipartisan anger there was at the Basel III endgame bank regulations that the Fed is looking at right now. These grow out of an international effort to raise capital levels and regulation standards in banks around the world. The U.S. hasn't implemented it yet. They've put together a process for putting it in place, and they put it out for comment, and they've gotten a lot of negative comment from the banking industry, who have also
Fed's Daily says Fed policymakers are resolute, thoughtful, and data-dependent.
Like it, but today we really got an earful from some Democratic representatives as well. They think it's going to result in less lending to the banks from the banks in their districts. Their banks will be less profitable. In other words, the message from the representatives is this is bad for business, so it's bad for the economy. Jay Powell was receptive. He was one of 4 Fed members who originally said they had problems with the issue. He made that clear. He said that they are looking at it. They're still digesting all the comments. But as he said, what we could see is broad and deep changes in the regulations before they come out. And he went so far as to say that it is possible they would withdraw the proposal altogether. So the congressmen were heard today, at least on that issue.
Well, thank you very much, Mike, because you kind of opened the door to where we need to go with Abigail, because, yep, we want to talk about markets generally, but most importantly, what's going on with New York Community Bancorp, if we may, Abigail, because as the Fed chair, Jay Powell, was getting lots of detailed questions, as Mike said, on banking regulation, how to prevent another crisis, developing news on New York Community Bancorp, which is halted as we speak, but it was down as much as 47% before that halt.
Yeah, it's pretty incredible here. This beleaguered regional bank, the news just can't get worse. It just keeps getting worse and worse, it seems. And to your point, they are saying that they're trying to raise equity capital. That's been the big question with all the headlines that have come out recently in terms of they're talking about the poor oversight of loans, and then we had a couple of downgrades. One of the downgrades was key because it was a downgrade of basically a certain portion of their business to junk, and they suggested that if that happened, that they could see outflows. One thing they have not updated investors on through all of this are their deposits. So in February, deposits and liquidity was very helpful or healthy, but to not make that update through all of this, you could take it one way or the other, that it's either really bad, they don't want to share that, or they want to pull a rabbit out of the hat. So it's going to be interesting to see what comes on the other side of this.
Hey, Abigail, I want to broaden this out a little bit and just talk about the equity market reaction in general to what we heard from Jay Powell earlier. We do see stocks higher by 0.8%. The NASDAQ composite up by 1%. The Dow up by 0.5 percentage point. Any surprising moves from you after yesterday's sell-off, given what we heard from Powell?
Not really. I mean, the biggest surprise is actually Apple. It's down ever so slightly. I mean, it's not down a lot, but you would think that we'd start to have a snapback for that stock at some point, and some of the momentum indicators suggested that, given the fact that it is down about 14% from its peak. You would think that it would also be participating in this rally, but this rally is a nice snapback from yesterday's sell-off. To your point, the S&P 500 up about 0.9%. Chips doing really well, up 3.2%. So a big rally there. I think very interesting to take a look at is bonds. We have yields down just a little bit. So this tells you, I mean, my take on this, on Fed Chair Powell's testimony so far, to Mike's point, nothing new here, but I think that there was probably a little bit of fear was, would Powell suggest that there would be no cuts this year? Now, if that had happened, I think we would have seen, yields spike sharply higher and stocks tumble. The fact that the worst case scenario didn't happen, we seem to have this relief rally. Does it mean it's going to continue? Not really, because yesterday put a little bit of near-term technical damage for stocks, but investors feel a little bit more sure of themselves today.
You know, our New York team also reporting that Treasury yields hit a new session low after that initial Wall Street Journal report about New York Community Bancorp looking to raise equity capital. We've also reported this story out. And I was looking at kind of the KRE regional bank ETF. It's down about 2%, and it looked like it took a dip as well on concerns. And I do wonder, you know, when we think about the broader market, we always, Abigail, talk with you about the importance of the mega cap tech names in terms of momentum, whether it's Apple or some of the others. And you laid out some of the move to the upside that we've seen. How important is it to what we see in the financial sector broadly, in the regional bank sector, to the overall market trade?
Well, you know, it's interesting to see the sympathy that we do see in the KRE. So the biggest decliner, not surprisingly, was NYCB before it was halted. I'm looking right now, only 3 members are up out of 140. So you have 137 banks down. But what's so interesting is, as I've dug into the commercial real, and it is trading again now, NYCB. Yeah, it's not. Sorry, I was looking at KRE. Got a little bit excited to see something moving.
We have a lot of screens up right now, everybody.
Yes, we have a lot of screens here. But as I've been digging into this, so of the 25 top regional banks, they have maybe 13-14% exposure to commercial real estate, and apparently they are well funded enough that there shouldn't be an issue. The smaller regional banks, they have roughly 44%, so there could be some other blowups. But I was talking to an expert yesterday, and he was saying it's not going to be the saving and loans crisis back in the 1990s. It's not going to be hundreds of banks. If anything, it's not even going to be dozens. He said maybe it would be a dozen. So the fact that you have this contagion trade here right now in terms of stocks down. Now, even though the bulk of them are down, the next biggest one to NYCB is down 5.9%, which is a sizable decline.
Right.
That's Southside Bank shares. But I guess what I'm saying is that the contagion may not be, it's headline contagion as opposed to actual fundamentals. A lot of folks don't think it's going to be as bad.
And it's important to understand the fundamentals of each of these names.
I want
Yes,
to go
exactly.
I want to go back to Mike McKee on this and stay on New York Community Bank, because there are some parts of this that are tied to the Fed and to regulators. Mike, just weigh in on this with your observations.
Well, it's interesting. Jay Powell was certainly asked about banks and commercial real estate, and he said it's going to be a problem that can be worked out. They're not particularly worried about it, but it's going to take years for all this to go through the system, and there will be losses. But he was not directly asked about NYCB, either because members of Congress didn't know what was happening today, or because they realized that the Fed does not regulate NYCB. It's the Office of the Comptroller of the Currency that is NYCB's regulator. And one of the interesting things, Abby was talking about the deposit base. Most of their deposit base is insured, so it's not like SVB was, where people felt like they were going to lose their money. And the other thing about their deposit base is that about a year ago, they bought Flagstar Bank. They moved all their deposits into it, and apparently the deposits from Signature Bank, when they took that over, also went into Flagstar. Now, who knows that Flagstar is owned by NYCB? So the average person isn't rushing to pull their money out of Flagstar because they don't know the connection there.
Great point.
It sounds like the members of Congress got to get some terminals if they don't know that during the Fed
we'll
chair
have to ship them right
testimony.
down.
We did get.
If they're
we did
interested,
get
I know where they can
call-outs.
subscribe to the terminal. Okay,
I did
Mike?
thought I heard a few call-outs there, Mike.
Yes, I mean, more than I think any other news organization, to brag a little bit, but 2 or 3 times members cited stories from Bloomberg when they were prefacing their questions.
Abigail, let's broaden it out a little bit, too. I mean, as we continue to track the trade, after we've been concerned a lot, yesterday there was a lot of conversations about overvaluations and whether or not we were kind of maybe a new trend line and so on and so forth. You know, we're going to go back to Mike in a moment because we've had a lot of economic news, and obviously Jay Powell covering a lot of the economic backdrop, if you will. Having said that, the trade, the momentum behind the groups that are moving to the upside, is it some momentum behind it?
So overall, the momentum for the markets is down. We've been talking about this for a while, the RSI, the momentum indicator. The last time we saw a high, it was last year. So all of these record highs that we've had recently, not today, but they've been made on less good momentum. And I think some of that does have to do with the Apple trade, the fact that that stock is in a correction. Now, relative to the breadth today, it's much better because we have we might even at this point, we have all 11 S&P 500 sectors higher. So it is broad-based from a volume standpoint, let's see how excited investors are about this relief from Powell that it's not going to be a year of no cut. So it's a little bit above average. So it is somewhat healthy. I would say though, it's the consolidation that we saw yesterday for big tech, the worst day at one point going back to last year. It's healthy, so it wouldn't be a bad thing to see a little bit more.
And it was interesting because we saw buying into the close yesterday,
Yes.
which was really significant.
Yes.
Hey, Mike, back to you in terms of the economic backdrop. It's still, I think, back to the last FOMC meeting where Jay Powell several times in the press conference was like, "Folks, it's good out there, the U.S. economy." Did we get that message very strongly as well?
Oh, well, you put it that way. We got the message, but not very strongly. There wasn't a whole lot of focus on it. It was in his opening statement that job creation has been strong, inflation's been coming down. Overall, things look pretty good in the U.S. economy. Later in the hearing, he was asked about the possibility of recession, and he says there doesn't seem to be any indication that there's any short-term risk of recession in the U.S. economy. A couple of the Democrats used their time to talk about how good the economy was, maybe from a political stance, but the economy was not front and center today. Interesting, also not front and center was the stock market. You would think that maybe he would have gotten asked about asset prices being overvalued or something like that, and that didn't really come up either. Members were more concerned about things like whether the Fed is getting involved in climate change, the housing market, maybe the closest thing to the economic issues that were talked about, and basically all Powell could say is, yeah, well, we raised rates. But as rates come down, the housing market should loosen up.
All right, so having said that, we do also get a lot of economic data points. We have been over the last couple of weeks, some data today as well. JOLTS, always an important number to watch. We're going to have the Beige Book in about 45 minutes or so. Give us, remind us, Mike, about the backdrop that we continue to get in terms of some of the data points.
Well, that's the key thing. The Fed says it's going to be data dependent. They're going to look at a broad range of indicators, including jobs. And we get the jobs report on Friday. It's expected to show a relatively strong job creation continued during the month of February. They'll be looking at average hourly earnings, wanting to see if there's an inflation problem there. And then next week, we get another CPI report. Seems like only yesterday, doesn't it?
It does.
We'll get a CPI report. They'll be looking at that, and then PPI, and we'll see where inflation is. The Fed meetings the week after that, on the 20th, they've already said they're not going to move then. So then the focus turns to the May 1st meeting, and we'll see what the numbers add up to by then. But right now, it looks pretty good. The question is, does inflation keep going down? That's going to be the one major point to trade upon.
Hey, Mike, how does this set things up for Jay Powell tomorrow when he's in front of the Senate? Do we have any indication that the line of questioning will be similar, i.e. hear more about Basel III and questions about that?
I think that's what you'll get. Senate questioning tends to be more detailed, more specific, less political, and so probably some more questions about when they might cut interest rates. But then I would imagine a lot of people are going to be on both sides of the issue tomorrow in the Senate on banking, because you can bet Elizabeth Warren is going to let the chairman know they should be as tough as possible on the banks, because that's been her position. So we may get some interesting cross arguments from members of the committee tomorrow. May get more on climate change. That's also been an issue of how far is the Fed allowed to go in what it's doing on climate change. There was one question today about the Fed and its balance sheet, but it wasn't really about when they're going to start running it down. It was more about the Fed's losses. Jay Powell saying doesn't affect our operations. It's really just a bookkeeping exercise. So we might see more of that as well. I wonder if we'll see much more political posturing. We really didn't today, which is something you usually get from members of the House.
We did see some questions about housing affordability, Mike, which I found interesting, given that things aren't necessarily going the way that economists typically think they'll go when rates go higher. Home prices should go down because mortgages
Shortly
become more
expecting the
expensive.
Fed reverse repo operation.
Thrown out the window over the last couple of years. What did you make of the line of questioning around housing affordability? Because as the point that you've made many times before is the idea with the Fed raising rates is things do get more expensive, so demand goes down.
Well, that's the problem here is we're in a different environment with housing than we've been in, that anybody could remember, because rates got so low. A lot of people out there, I think something like 40-50% have rates under 4%. And right now we're over 7%. So nobody wants to sell their house because they don't want to have to buy a more expensive mortgage. It was different if you were selling a 7% mortgage and you're looking at a 6 or an 8% mortgage. It's not that much different. But now it would be a huge difference in monthly payments. So everybody's just sitting there. There's no inventory on the market of existing homes. There aren't enough new homes being built. So the price goes up, simply supply and demand. They need to get interest rates down, mortgage rates down, then maybe pent-up demand to move will take over, and we'll see some additional inventory come on the market. But this may be a one-time significant jump in home prices that doesn't go away.
Hey, Mike, theoretically, at least, the Fed is not supposed to be looking at the stock market or stock prices, but one stock that's really tough to not watch is NVIDIA. And of course, for that AI play, a lot of people are thinking that AI is going to juice the economy in a massive, massive way, if not this year or a couple of years. How much did Fed Chair Jay Powell speak about AI and the possible influence on the economy?
Not very much. He was starting to get asked about it when the questioner ran out of time, and they really didn't come back to it all that much. The Fed's position is it seems to be something that will add to productivity, but we're going to have to watch it and make sure and see where the productivity comes from and what downrange impacts that has. Who loses jobs, who gets jobs, that sort of thing. They're not really ready to comment on that. There was a big conference on Friday of Fed officials in New York City, and that was one of the major topics, but it didn't come up as much as you might have thought today on Capitol Hill.
Maybe tomorrow.
One of the few people who aren't just talking about AI. Hey, Mike, just real quickly, 30 seconds. One thing that struck me is Fed Chair Jay Powell saying the pandemic is still writing the story of our economy right now, and we should be prepared to be surprised with the next chapter. A reminder that we still don't know how this all ends.
We don't. And if you keep up with some of the medical literature, the doctors are all warning it's still out there. There's still mutations, and we have to be careful. We've also changed our inventory systems, and the supply chains that we have been modified, but have they been modified enough for the next occurrence? Those are the kind of things the Fed has to worry about.
Yep, it's why we're data dependent and just kind of finding our way through. Hey guys, thank you so much. A lot of news, obviously, on this Wednesday. Great breakdown. Fed Chair Jay Powell, his testimony, first of 2 days, and of course the market reaction. Our thanks to our Bloomberg News international economics and policy correspondent Michael McKee in D.C. and Bloomberg News markets reporter Abigail Doolittle right in studio. We're coming back in just a moment.
Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment snapped at 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
This week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Sigh of relief on Wall Street with the Dow, the S&P, NASDAQ all advancing on a Fed Wednesday. Jay Powell once again signaling that while a strong economy will keep officials on hold for now, he does expect the Fed to cut rates this year. S&P up 45 right now at 51.24, close to session highs, up 0.9%. Dow Jones Industrial Average up 202, up 0.5%. The NASDAQ Composite Index up 174 right now, higher by 1.1%. We've got the 10-year yielding 4.09%, with a 2-year that's yielding 4.53%. Spot gold up 0.9%, 21.47 a barrel, an ounce on gold. In terms of the barrels, West Texas Intermediate crude 79.54. Did see an 80 print earlier this hour. Right now, WTI up by 1.8%. Oil stocks advancing as well. Case in point, ExxonMobil up 1.5%. ADRs of BP up 2.1%. Chevron up now little changed, up 3 cents to 149.62 on Chevron. Bitcoin keeps on going, up 6.1% at 67,191. And a headline on the Bloomberg Professional Service: Democratic Representative Dean Phillips of Minnesota is ending his long-shot primary challenge against President Biden. Recapping, stocks higher. S&P up 46, up 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. For those of you just joining us, you are watching an extended version of Bloomberg Business Week on this Fed Wednesday. Carol Master along with Tim Stanovic, live on radio, TV, YouTube, and Bloomberg Originals. It's a Fed Wednesday because, as you know, Fed Chair Jay Powell up on Capitol Hill earlier today, first of 2 days in this semi-annual testimony on monetary policy before U.S. lawmakers. Chair Powell, Tim, saying a lot of things.
Yeah, as expected, he reiterated that the Federal Reserve is in no rush to cut interest rates. Here's what he said.
We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
And that, of course, was none other than Federal Reserve Chair Jay Powell in day one of his 2 days of semi-annual monetary policy testimony before U.S. lawmakers.
All right, so back with us with some more analysis. Longtime and resident Fed watcher here at Bloomberg economics reporter Steve Matthews. He's out there in our Atlanta bureau, and a go-to on all things U.S. rates, Bloomberg News rates reporter Michael McKenzie. He's here in studio. Steve, let's kick it off to you. Tim and I and many Bloomberg users kind of glued to our live blog today as Fed Chair Jay Powell was up on Capitol Hill. You wrote, all in all, a pretty balanced view on Fed policy that reflects where the rate-setting committee was at its last meeting. So not much new stuff there.
Yeah, it was pretty much down the middle and very similar to what you heard coming out of the January meeting and press conference and the 60 Minutes interview. You know, although it's like some people took his comments to be just very slightly dovish. I saw one report in the clip that you mentioned where Powell was talking about that they could cut rates at some point this year, that he chose the wording at some point this year as opposed to later this year. And this is how Fed watchers parse the language, because if it were later this year, that might imply maybe the second half, maybe some time away. At some point this year, that could mean tomorrow. I mean, that is totally open-ended. So
it's like managing a young kid, right? We're going to do it sometime, maybe later this year.
I also just appreciate the view into the way that Steve has to really parse everything that comes out of Jay Powell's mouth in order to understand what he's doing. And it is important, though. We laugh, but this is what traders are trading on. Hey, speaking of the trade, I want to bring in Michael McKenzie and talk a little bit about the bond market reaction today. We're seeing yields now down across the curve, Mike. Give us your idea of the way that the trade evolved throughout the day and sort of how things ended up after we heard from Powell.
Well, the trade, the market got going pretty well early on because the ADP numbers came in a little bit softer, and that was followed by 10 o'clock when the jobs numbers came in softer too, and there was a downward revision for the past month. So that gave a bid into the market, and that bid was also sustained, I think, because Powell, some people in the bond market were a little bit wary that coming into this, that Powell could perhaps reference some of the recent uptick we saw in inflation data. He didn't. He pretty much stuck to, as Steve said, the middle of the road. He kind of just, nailed the drive down the middle of the fairway. And so that combination of that data, Powell sort of maybe a touch on the dovish side, not as hawkish as people thought. That was enough to get the rally going. And then, of course, we got the news about the New York Community Bank. And again,
that's when we kind of went to, I feel like, lows of the
session. And then you
session.
see the sort of typical safe haven bid coming, particularly into 5s and 10s. And you can see the 2 years still above 450. It's only a little bit down on the day in terms of yield. But the belly is where people want to buy if there's any sign that the data is actually turning softer, and therefore that's going to open the way for potential rate cuts.
So kind of key that once we figure out what's going on with New York Community Bank Corp, whether or not we get this cash infusion, which is kind of floating out there in terms of some of the reporting, we're watching, we're kind of glued to our terminal to see whether or not we get a headline anytime soon. But how the market trades off of that will be more telling in terms of the real reaction to Fed policy, or no? You feel like we've got it?
I think we've got it, and I think actually, don't bear in mind we've got the payroll report coming Friday, and then we've got CPI next Tuesday.
Right.
Now, if either of those reports are firmer, stronger, stickier inflation, this bond market's going to have to it's going to inch back towards the higher end of its recent range, which in 10 years is going to be back around 420, 425.
Which you've talked about a lot with us.
Yeah.
Hey, Steve Matthews, Michael McKenzie just now saying, Powell just hitting it right down the middle, kind of in the middle today. Would you say he was more hawkish? Would you say he was more dovish? Do we have to come out with some sort of different type of bird in order to describe the way that he was on Capitol Hill today?
Is he like a turducken? He's a little bit of everything?
So, some of the Fed people like to consider themselves owls because that's sort of a wise thing as opposed to hawks or doves. So that's the other bird that you hear. I agree that he's very centrist. And the reason is, when he speaks for the entire committee, the 7 governors, the 12 Fed presidents. And unless he's done a poll beforehand and talked to everybody beforehand, he really can't pivot on policy. So he basically has to reflect what the view has been, as of the last meeting. So
68 counterparties take 456.847 billion dollars at the Fed Reverse Repo Operation.
Point you just saw the very slight touch of dovishness in terms of his personal view. He was asked about what more evidence that they needed to lower rates, and he mentioned that it would be just a bit more evidence. That doesn't sound like a lot. That sounds like it's just a little bit. So that was kind of came across as a dovish answer, but generally very much down the middle.
Having said that, Steve, he did say our policy rate is likely at its peak for this tightening cycle. I only bring this up because we've had guests. We've had Torsten Slok, who says we don't think the Fed's going to do any, over at Apollo, any rate cuts this year. We've also had individuals, Larry Summers and others, who say, wait, we could actually get a rate increase. Do you read that? Likely at its peak, not the first time he's used the word peak, that they are done raising rates? Or again, do we have to say, ultimately, folks, they're data dependent?
Unless there's some huge inflation shock, it would be quite embarrassing and quite a change to start raising rates over again. So it's like, I think that their view is that they would much rather hold rates at the current level for a longer period of time than entertain the possibility of ever going higher. So it's like, he didn't 100% close down that option, but it's pretty clear that is not something that they want to do at all.
I did hear him, too, Michael McKenzie, reiterate the summary of economic projections, the dot plot, that when it came out in December, the median projection was for 3. Interesting 3 rate cuts this year. Yeah. Interestingly enough, we are starting to see the market move closer to that. Did you see, was there anything in there that convinced you that 3 is going to be the number today? That the summary of economic projections that we'll get next time will change at all? The median?
Sorry.
That's okay.
No, I think 3 is a pretty safe kind of number for the Fed to be talking about at this point. And based on the idea that maybe they go June, September, and December.
Let me hit the same question over to Steve Matthews while we get Michael McKenzie some water right now. What about you, Steve? Was there any indication that the next summary of economic projections, and again, we're reading tea leaves here, could actually show a difference in the median projection?
As of today, it would seem like 3 is a pretty safe bet, and you would have to wonder why would he bring the number up, which he did in the Q&A, unless they were kind of thinking that that's what they want to be, at the next meeting. But the one caveat there is the CPI next week really matters. It's like this in his prepared text, he didn't mention the January CPI. January CPI was not good at all. And if you get another surprisingly bad number, it would be harder to kind of write that off as an anomaly because you would have 2 bad numbers in a row. And so, that could change things. That's the thing to really watch. The jobs data, I guess it could matter a little bit, particularly if it's a really low number that kind of suggests some softness.
Right, exactly.
You hear that, Carol? He's saying they're data dependent.
T-shirts and hats, we're making them up. Got about 40 seconds left here. Michael McKenzie, got you some water. I've been there.
Appreciate it.
It's the best of us.
We talked with you about that 10, that kind of topping out at 4.25. Do you feel like we have hit, though, the higher end when it comes to the U.S. Treasury curve, that we know where the higher ends are at this point?
Yeah, we have, unless, as Steve says, inflation does shock to the upside. And I think when people like Torsten Slock are talking, they're saying they think there's going to be a reacceleration coming for the economy, and therefore wages do pick up, and therefore inflation picks up. And that's going to force the Fed, at best, to be on hold for this year. And I think that would be something that would worry the bond market. And I do think until we see really for sure that this resiliency of the economy is beginning to be chipped away, the bond market's going to be cautious. And again, I spoke to some investors last week, and they said if it gets to 440, 450, we're definitely going to buy the 10s. But they didn't rule out a test of 440, 450. They weren't so certain that you get to 5%.
It goes back to what we said with Mike McKee. Jay Powell saying the pandemic's still writing the story of our economy. We don't exactly know how this all lands. Guys, thank you so much. So appreciate it. Steve Matthews, economics reporter at Bloomberg News out there in our Atlanta bureau. And, of course, our Michael McKenzie, rates reporter at Bloomberg News. Tim here in studio.
Hey, let's get a check on the latest world and national news. We got Amy Morris standing by in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hey, Tim, thanks so much. A Russian missile strike has landed near Ukraine President Zelensky's motorcade in Odessa. It's where he's meeting with Greece's prime minister. It was very close, but nobody was hurt. In front of a House panel today, Federal Reserve Chair Jerome Powell was asked if he believes there won't be a recession.
There's always a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Powell told lawmakers the central bank is in no hurry to cut interest rates until policymakers are convinced they've won their battle over inflation. After some overwhelming losses, GOP contender Nikki Haley is ending her campaign with a thank you to the American public and a warning for members of her party.
Our Congress is dysfunctional and only getting worse. It is filled with followers, not leaders. Standing by our allies in Ukraine, Israel, and Taiwan is a moral imperative. If we retreat further, there will be more war, not less.
Haley indicating she will not immediately endorse Donald Trump. You can add acne treatments to the list of widely used consumer products found to contain high levels of benzene, a chemical linked to cancer. An independent lab wants the FDA to recall the products. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Ursula Hurley walked me through Terminal 5 at
And so
New
just
York's
noting
John
the
F.
S&P
Kennedy
500 is
Airport,
quickly moving down. It's pairing its gains. So it's now up 0.35% on the session. A little bit of upside in the dollar as well. Dixie pairing losses now down 0.4%. Again, that doesn't seem to be a news catalyst for this move. Just keeping our eyes out on the wires.
To getting them to their destination and home from their destination, it takes an army of things to go right.
There's change on the way at JFK. Ground has been broken on a new Terminal 6. It will connect with Terminal 5 and add capacity for up to 10 gates. JetBlue joins a consortium of companies managing the $4.2 billion project, helping define its design and guide its construction towards completion in 2028.
We're still in the design phase for Terminal 6, but we leverage what other airports have done and what we've seen throughout the world, quite frankly, and we're going to pick the best of everything to really elevate the game. And technology is going to be at the backbone of that journey. We want to be able to create and give customers experiences where they can self-serve as much as possible across the travel ribbon. So whether it's checking in, whether it's checking your bag, going through security, boarding a flight, we want everyone to be able to do that seamlessly and be able to do that with your own handheld technologies.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Shares of New York Community Bank Corp, they do remain halted. Last trade down 42%. NYCB said to be trying to raise equity capital to help restore confidence in the beleaguered company. This according to the Wall Street Journal, citing sources. We'll have a whole lot more on this story coming up with our Herman Chan to discuss NYCB. As of right now, though, the stock is halted. The Dow, the S&P, NASDAQ, they're all rallying. It is a Fed Wednesday, and traders are breathing a sigh of relief. Jay Powell once again signaling that while a strong economy will keep officials on hold, he expects the Fed to cut rates this year. The S&P up 37, up 0.7%. The Dow up 141, up 0.4%. The NASDAQ Composite Index up 141 points now. That is a gain of just about 0.9%. 10-year at 4.09% with a 2-year that's now yielding 4.53%. Gold up 1.1%, 21.51 the ounce. West Texas Intermediate crude up 1.6%, 79.39 for a barrel of WTI. Bitcoin up 5.8%. Bitcoin at $67,000. Again, recapping, U.S. stocks higher across the board. S&P right now up 38, up 0.8%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. You're watching and listening to an extended edition of Bloomberg Business Week. Tim Stennebeck along with Carol Massar live on Bloomberg TV, radio, YouTube, and on Bloomberg Originals. Well, moving to another big story on this Wednesday, and that, of course, is the aftermath of Super Tuesday. President Joe Biden and Donald Trump prevailing in almost every Super Tuesday nominating contest and are set for a rematch in a general election that few Americans are excited about, and one, Carol, that Wall Street donors tried in vain to avert.
Absolutely. GOP contender Nikki Haley, as expected, ending her campaign after the Super Tuesday races, ending it this morning after those overwhelming losses. She spoke earlier from her home in South Carolina. Let's listen in.
It is now up to Donald Trump to earn the votes of those in our party and beyond it who did not support him. And I hope he does that. At its best, politics is about bringing people into your cause, not turning them away. This is now his time for choosing.
All right, that, of course, is Nikki Haley speaking earlier this morning from her home state of South Carolina. Well, covering it all last night, continuing to, of course, the post-Super Tuesday races. The host of Balance of Power, one of the hosts, Joe Matthew, joining us now from our D.C. bureau. So, Joe, good to have you here. Had some time to kind of digest all of it. It feels like it kind of went as expected, largely.
Largely, if not even more for Donald Trump than some saw. There was a thought early yesterday, even into the evening, that Nikki Haley could pick off a couple New England states. Instead, we're spending the evening obsessing over Vermont, which tells you a lot about where we are in Republican politics, the home of Ben and Jerry. But look, it just became clear that the window had closed. It would be mathematically essentially impossible for her to close the deal here. And now America is getting exactly what it did not want, which is a rematch between these two old men.
Well, perhaps it's what a lot of voters do not want, but it's what a lot of voters will likely end up getting, Joe. And it's going to be a long and extended primary season. What did we learn from exit polling last night, or a long general election season, I should say, when these two do get nominated at the conventions? What did we learn from exit polling last night about the type of voter who came out for Nikki Haley and how they perhaps could vote in the fall?
Well, it's interesting. She had a number of states last evening where you had folks other than Republicans allowed to vote. And she saw some love in those states. The poster child of them would be New Hampshire. But look, she's got fewer than 100 delegates. That's not exactly a brokered convention. And Donald Trump has had a commanding lead. We've never seen, we have to acknowledge, never seen this happen before, where a candidate, like an incumbent in this case, came in and just ran the table like this and swept all the early states. Iowa, New Hampshire, South Carolina, that alone was a feat. And so the writing is obviously on the wall here. But we did see some weakness hear about some weaknesses potentially for Trump in those exit polls, Tim, that you're asking smartly about here. In Virginia, North Carolina, and California, the exit polls included this question. If Donald Trump were to be convicted of a crime, would you consider him fit to be president? In Virginia, 37% of Republican voters said no. 31% in North Carolina said no. In California, 23% of Republican voters said no. And that tracks with our polling at Bloomberg and Morning Consult. That's why this Alvin Bragg case that's going to start in New York later this month is so important.
So, Joe, is it safe then to make an assumption that if indeed the former president in this race running for another term in the White House, if he is not convicted of anything or found guilty of anything further in terms of the January 6th insurrection and so on, that we should assume that all of those who voted for Nikki Haley so far will automatically go to Donald Trump?
No, absolutely not. Some will, but there's a reason why they were voting for Nikki Haley. She was the alternative. And it's not clear that they'll go to Joe Biden either. There's a question of whether they stay home, whether they keep that top of the ticket blank like we saw many Republicans do in Georgia in 2020 and vote Republican all the way down the ballot. Then there's, look, RFK Jr. is waving at them. Maybe there's a no labels candidate that gets into this race. That's the group that they would be aiming for here. But in terms of American politics right now, this is a two-party system. That's where the money is going. And it's hard to see this being larger than a Trump versus Biden race.
So it's a Trump versus Biden race, but if there is some sort of third-party candidate, an RFK Jr., for example, who does he then pull votes from? Would he be pulling votes from President Biden? Would he be pulling votes from former President Trump? Or would he be getting people who wouldn't have actually voted in the general election to come out and vote?
Well, it's a great question. Everyone's trying to answer that, and it really depends on who he or she is. If you're specifically asking about RFK Jr., it looks like, according to some research, it's a wash. He's politically closer, interestingly, to Donald Trump when you get, the anti-vax crowd in there and others. It aligns more with a Republican voter or a libertarian voter. But a lot of folks think this is the Kennedy family that they associate with Joe Kennedy and Bobby Kennedy and JFK. And if they're not paying attention, you remember that Super Bowl ad that stole from the old Kennedy? They might make that connection and take votes away from Joe Biden. So that one seems to be a wash. The no labels potential is the great fear of Democrats. If you get a unity ticket, that appears to be coming out of Joe Biden's pocket.
Joe, Matthew, you've seen lots of political races. You're in it. You love this stuff, the ins and outs, if you will. But what is it to have a race, a rematch that really many of, or a significant portion of the American voter doesn't even want?
That's the wacky thing about this, because we've really never done this before, at least not with this kind of research, to know how toxic both seem to be to a majority of voters here. Coupled with the fact that, we've got two incumbents running against each other, essentially. We have to look at it that way. Certainly a president and the most previous president. We haven't seen that since the 1800s. So a lot of the conventional wisdom, guys, kind of doesn't matter. History is not really a great guide here, because this is new for us. When you add social media at the 24-hour news cycle and everything else behind this, and the pull that Donald Trump has with his own avenue directly to voters, it's simply something that we've really never seen.
Joe, just in the last couple of minutes that we have with you, what's the most important down ballot result that we got last night? Is it California Senate and that runoff?
Yeah, for sure. For sure. Everyone wanted to know who was going to be running against Adam Schiff. And it's the fact that it's going to be Steve Garvey, a former ball player without a political career behind him, is going to be in a very interesting and very expensive race to watch. Also, though, this Colin Allred race against Ted Cruz. Look, it's Ted Cruz's race to lose. We're talking Texas, after all, and there doesn't seem to be necessarily a big clamoring. Beto O'Rourke, as a Democrat, couldn't unseat him. But that's going to be wild, expensive and wild. Watch as well the governor's race in North Carolina. That's where the big money is going. Those three from last night will be a lot to cover in and amongst themselves.
Joe, Matthew saved you 30 seconds. We've been fooled by polls before, and so we kind of throw them around, and we love to talk about them and what they kind of say about maybe how things go. Do they get more accurate? I mean, I don't know. As we get closer, how are you thinking about the use of polls this time around?
Just depends on the poll. You know, look at the size of the sample and whether this is a state or national polls we're talking about. The national stuff can bring a lot of noise, and as Charlie Cook reminded us last night, can inflate the standing of a Democrat with big states like New York and California. Watch our poll. Those 7 swing states are likely going to decide the presidency, and Donald Trump is leading Joe Biden in all of them right now.
All right, this is why we love talking to you. Man, sleeps it, eats it, dreams about it. It's just great
whether
stuff.
Whether he wants to or not.
Whether you want to or not. Joe Matthew, so appreciate one of the
At
hosts
2
of
p.m.
Balance
Eastern
of Power,
Time, we
of course,
get the
coming
Fed's
your way
beige
later
book.
on today. Joe Matthew joining us there in our D.C. Bureau. Shares of New York Community Bank are, by the way, still halted pending some news, so we're keeping an eye on that. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, we are getting ready to wrap up on this extended edition of Bloomberg Business Week, at least for the focus on Jay Powell, although it will continue in the next hour as well. Carol Massar along with Tim Stenevec live on radio, TV, YouTube, and Bloomberg Originals. Quick check on the markets for you, and you've got stocks definitely off their best levels of the session. What does that mean? Well, the S&P 500 still up about 25 points, 5103, your last print there. NASDAQ, we're looking at a gain of about 0.6%, a gain of about 98 points. But what's interesting in terms of what we've seen on the yield side is that we've definitely seen a pullback in yields all along the curve. That 2-year note with a yield of 4.53, the 10-year note right now yielding 4.08.
Okay, so one more to add to the list, Carol. The NASDAQ 100, completely flat right now. Not moving higher, not moving lower.
Which is kind of interesting because we did see some
earlier,
right, a bounce back in some of those mega cap tech names. In the meantime, of course, top and center is what we got from Fed Chair Jay Powell up on Capitol Hill. He'll be there again tomorrow before the Senate Banking Committee, again taking questions from senators. But, net, basically, he says our policy rate is likely at its peak for this tightening cycle. That is a quote. He also said it will likely be appropriate to begin dialing back policy restraint at some point this year. So markets kind of, in terms of rate expectations or rate cuts this year, kind of expecting still maybe about 3 cuts this year.
That's exactly right. Futures still pricing in the likelihood of the first Fed rate cut coming in June. We did see the S&P 500 up 0.8%, a little earlier in the hour at about 1:15 today.
At 2 p.m. Eastern time, we get the Fed's beige book.
To 1%, now flat, and the S&P 500 now up just about 0.5 percentage point.
I think what's interesting, too, is once again, and we've heard this from other members of the Fed and certainly from Jay Powell, this idea of risks in moving too quickly or aggressively in terms of cutting rates, which he said if it caused inflation to accelerate could require even tighter policy. So there's that. But he also pointed out again, Tim, that there are risks in moving too slowly as well, right? You don't want to keep rates too high for too long. And if we do get a slowdown, that any kind of slowdown to come, or dare we say recession, that it's going to be deeper and longer. So it's a delicate balance, and many would say it's tougher as you get near the end of that rate cycle, but nonetheless, that's something that's on Fed Chair Jay Powell's mind.
Economics reporter Steve Matthews earlier in our program reminding us that there is still a lot of data to come before the next meeting. Of course, the February jobs report, we get that on Friday, Carol. We got JOLTS earlier today. In the next week, again, CPI. So once again, the Fed waiting to see more evidence that the economy is cooling a little bit. Michael McKenzie making that point on our program earlier as well, before it does commit to cutting rates.
Yeah, and exactly. Repeating that guidance from that last FOMC statement that policymakers will assess incoming data, the evolving outlook, and the balance of risks as they set policy. So as we kind of joke here, but it really is no joke that the Fed chair has consistently kept to that message of being data dependent throughout this cycle. And so they're going to watch. We've got a monthly jobs report on Friday. That's a big one. A reminder that we get another inflation print, CPI, next week. So again, we'll get another indication of whether or not inflation is settling down or whether there's still concerns about some of the pressures that are out there, Tim.
The Fed chair was also asked about the possibility of a recession coming later this year. He did say that recession risks are not elevated in the near term. He also was asked about a soft landing for the economy, and the Fed chair did say the Fed would not make such an official declaration, but the Fed is monitoring commercial real estate issues, he said, as he was asked about that.
Yeah, and what's interesting too is the Fed expecting continued growth at a solid pace. I heard the surveillance gang this morning, not willing to say Goldilocks economy, but it is interesting in some of the strength that we continue to see, whether it's consumer spending or the labor market, that does necessarily give the room to the Federal Reserve, the U.S. Central Bank, to maybe hold off on cutting rates because the growth is still there, and they want to make sure that they get this inflation right. And, we talk about that 2% target. Inflation has eased substantially, no doubt about it. Take a look at a 12-month chart, and you can see how much it has come down in the last year. But the Fed remains strongly committed to bringing inflation back to that 2% target, so not looking to reassess that, at least not at this point.
Interesting questions, too, from lawmakers actually about immigration and the effect that immigration does have on inflation. The Fed chair stopped short of saying that more people coming into the country will necessarily bring inflation down because those people also buy stuff. He made the point, but he did say that as people do get added to the labor force, then there are more workers. Exactly, it doesn't become as tight. Hey, speaking of tight and payrolls, we are expecting that number, of course, on Friday. 200,000 is the number that economists expect. This is a survey of Bloomberg economists. Remember a survey of economists by Bloomberg, I should say. Remember last month, that number at 353 came in so much higher than every economist surveyed by Bloomberg expected.
Front and center. Hey, front and center also is New York Community Bank Core. Let's not forget that it is still halted pending news. The last trade, it was down more than 40% here. Of course, this is something we continue to talk about. It did drop as much as 47% before that halt earlier today. The beleaguered commercial real estate lender trying to raise capital to restore investment investor confidence. Bankers are gauging investors' interest in buying stock, according to a person familiar with the matter saying earlier today, company is said to be working
1 minute
with
now
advisors,
till the Fed's due
Jefferies
to release
Financial
the
Group,
Fed's beige
according
book.
to those in the know. So again, halted. We've been watching. We've kind of been glued to the Bloomberg because it's been halted for some time. I think over an hour, maybe an hour and a half at this point.
Well, let's remind everyone where we are. The shares thus so far this year have lost more than 3/4 of their value. This after NYCB slashed its dividend and set aside more provisions than expected for loan losses. And then, if you recall last week what happened, the firm announced that it was replacing its CEO and also that it had identified, quote, material weaknesses in how it tracks its loan risks.
Right, and we have seen also some pressure along all of the regionals. I'm looking at the KRE Regional Banking ETF. It is down about 2.2%, so we're seeing some of the concern spread throughout the sector. But we'll obviously break the news when we see it cross the Bloomberg and get an update on New York Community Bancorp. Don't go anywhere, anyone. We'll continue to track the markets, New York Community Bancorp, and more analysis of what we got from Fed Chair Jay Powell.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everyone. Bloomberg Business Week continuing on radio, TV, YouTube, and Bloomberg Originals on this Fed Wednesday, March 6, 2023. Keeping a watch on the Fed, we are expecting the beige book to cross the Bloomberg terminal at any moment. So looking for that.
We have seen the release of the Fed beige book now. Notice that economic activity has increased slightly on balance since early January, with 8 districts reporting slight to modest growth in activity, 3 others reporting no change, and 1 district noting a slight softening.
Semi-annual testimony before U.S. lawmakers, as you mentioned, Carol, waiting on the Fed beige book.
Employment rose at a slight to modest pace in most districts, according to the beige book. I've just posted out the link to the full beige book on the feed as well for anybody interested.
Top of mind, shares sinking as much as 47%.
Adds that economic activity increased slightly on balance, and the price pressures persisted during the reporting period, but several districts reported some degree of moderation in inflation.
It's a busy Wednesday, and folks, we're going to continue to also track some of the thoughts in terms of
consumer spending, particularly on retail goods, inched down in the recent weeks, according to the beige book.
Economic conditions, economic activity increasing slightly on balance. So that's one headline we're just getting. They're slowly starting to come across. So
again, overall labor market tightness eased further.
Banks across the 12 Federal Reserve districts. So as more headlines come across, we'll bring them to you. In the meantime, let's get another check on what's going on in the trade. Here's once again Charlie Powell.
I thank you very much indeed, Carol and Tim. Higher across the board, but on a busy Wednesday, want to add one
Wages
more
grew further across districts, although several reports indicated a slower pace of increase, according to the beige book.
Just getting word that the plant will have no power until the end of next week. This according to the Bund publication. Tesla shares, they are trading lower on an update for the rest of the market.
Beige book adds that loan demand was stable to down, and credit quality was generally healthy despite a few reports of rising delinquencies. Notes that businesses found it harder to pass through high costs to their customers, who became increasingly sensitive to price changes.
Index up 104, higher now by 0.7%. 10-year
ongoing shipping disruptions in the Red Sea and Panama Canal did not generally have a notable impact on businesses during the reporting period, according to the beige book.
Crude was trading with an 80 handle earlier in the session, 79.32 right now on WTI. It is up by 1.5%. Bitcoin up now by 5.9%, 67.47 right now on Bitcoin. Bottom line here, stocks higher across the board. The Dow, the S&P, NASDAQ all advancing. The trading halt on NYCB does remain in effect right now. Last trade with the stock down 42%. Again, recapping here, stocks higher, S&P up 25, up 0.5. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie,
Fed's beige book says the outlook for future economic growth remained generally positive, with contacts noting expectations for stronger demand and less restrictive financial conditions over the next 6 to 12 months.
He has read all of what the survey said. But let's head to Bloomberg News international economics and policy correspondent Michael McKee back in our D.C. bureau. Good to come back to you, Mike. Having some fun with you. There's a lot of information there, but what so far has jumped out for you in terms of the Beige Book?
Well, I've read the whole thing. Now I'm just coloring in the pictures.
I figured.
No longer beige.
Always can count on you.
It reads a little milquetoast, is the way I would put it, I guess. It doesn't take strong positions on any particular economic data point, but suggests that the economy is continuing to do reasonably well. Nothing to worry about going either direction. And, of course, the Fed has placed a resurgence in growth as one of their risks lately. The overall way they describe the economy is economic activity increasing slightly on balance since early January. 8 of the 12 districts reporting slight to modest growth in activity. Consumer spending, particularly on retail goods, they say inched down a little bit in recent weeks, but manufacturing activity was largely unchanged and bottlenecks continue to go away. They did mention that consumers and businesses have a little more price sensitivity these days. And when they talk about prices, which is kind of the important thing to the Fed right now, they're talking about price pressures continuing to persist during the reporting period, but there's some degree of moderation in inflation, and that companies are having a harder time passing along price increases because consumers have gotten more price sensitive. They also note that while there are some increased freight charges, the disruptions in the Red Sea and the Panama Canal don't appear to have a major effect on supply chains or costs for imported goods at this point. So that is good news. And in terms of course, employment continues to be relatively strong. There are more applicants than there had been, so it is getting easier to hire, but it is not like there is any kind of real bottleneck anymore there. Wages sort of flattening out a little.
Mike, hey, hang on a second, because we do have a headline crossing. This has to do with New York Community Bancorp, and we are getting a headline that it is raising more than $1 billion in equity led by, I'm assuming, Stephen Mnuchin's firm. New York City Community Bancorp investors include Liberty Strategic, Hudson Bay, also Reverent. So the headlines are starting to come out.
We're still seeing trading paused at this point,
which makes some sense. The stock was down 42% before these news, but before these headlines.
Mike, we have you here, so I do want to get your reaction to this, because New York Community Bank not specifically brought up during Powell's testimony, but you made the point earlier on our program today that there were concerns raised about community banks.
Well, there are concerns raised about banks which have exposure to CRE. Jay Powell said that the largest banks are not really a worry. It is the smaller banks that might have some problems, but he didn't think it was a systemic problem. There would be some individual losses, but at this point, it's something that they can work through. Will take some time, but they can work through it. Now, the NYCB is seen as a really idiosyncratic bank, given what their market is, given what their business model is, basically lending to multifamily housing in the New York City area. And so it's not seen as a systemic issue, which is why I guess you're not seeing a big follow through with other banks going down in the same way we saw last March when SVB was going down and there was a lot of pressure on other banks. Interesting about the $1 billion bailout, at least money being put into it, because Republic Bank did that, you remember, and it didn't work. So there's a lot at risk here, I guess, for some of these investors, but the feeling may be that, again, this is idiosyncratic on the other side. It's a certain problem that can be fixed with enough capital. Maybe that is the reason for optimism from those investors.
Right, and we should add into another headline crossing, New York Community Bancorp rep saying that Stephen Mnuchin will join the board of directors. Keep in mind, he is the managing partner and founder of Liberty Strategic Capital, which is one of the investors that are raising that more than $1 billion in equity that is being led, though, by Stephen Mnuchin's firm, Liberty Strategic Capital. Again, shares of New York Community Bancorp have not resumed trading, so we'll continue to keep our eye on that.
Hey, I want to bring in Henrietta Treys, Director of Economic Policy Research at Veda Partners, joining us from New Orleans. Henrietta, good to have you on the program. Forgive me, but I do have to ask you about New York Community Bank because this is front and center for us. I know you've been watching economic policy and you've been watching the Fed, but what does our investing audience need to understand about a cash infusion like this into a bank that has exhibited specific weakness when it comes to a certain type of loan?
Especially when it comes from an infusion, as you just discussed, that didn't work the last time around. Yeah. The question that I most frequently get from investors and clients is, what is Congress going to respond to this? How is legislation going to pass? Will there be any kind of influx or moves at the Fed or any of the other federal agencies to try to stall out any kind of systemic risk? I'm not hearing about that generally on Capitol Hill. It seems to be isolated. And I think maybe adding to that is the inability of Congress to do anything much beyond just keeping the lights on at this point. We're too deep in the election cycle. So I do think that a focus on regulatory actions is something that Powell indicated we're going to see later with Basel III or later on this year. And I think that's probably the main focus, if anything, is going to come of this. But sort of the hands-off approach is what I would anticipate right now.
When you think about, though, the outlook and the economic outlook, Henrietta, we continue to keep an eye on the financial sector, and in particular the regionals, because it was just roughly about a year ago, right? Then they all became front and center for us. How does potentially, if we see others that come into some concerns or continuing to come into some concerns, how does that impact your economic outlook?
What happens is actually you see almost an immediate partisan split about how to approach this. What I remember from SVB and the way that this sort of culminated in DC was you needed to have widespread, systemic, rural-focused, agriculture-oriented lending impacted. It couldn't just be a region-specific bank. The last time around, it was very tech-heavy and sort of relegated to Silicon Valley, and that allowed Congress, DC, and just sort of the macroeconomic picture to say, hey, this is confined, this is contained. We don't need to worry about it from a systemic perspective. The economy right now is doing sort of exactly as you just said, milquetoast understanding of what's happening. We have very strong GDP growth at 3.4, I believe it was, 3.2, 3.7% unemployment, 3.1% inflation. Just to sort of wait and see, expect that things will fall off. But unless it becomes widespread and systemic and hits everything, not just regional specific banks, you're not going to have a response.
Let's just rehash. New York Community Bank Corp plans to announce an equity investment of more than $1 billion led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. That's according to a spokesperson for the bank. Liberty will invest $450 million, Hudson Bay $250 million, and Reverence $200 million as part of that transaction, according to the spokesperson. In connection with the deal, New York Community Bank Corp will add new directors to its board, including Mnuchin and Joseph Otting, former comptroller of the currency. We are still awaiting shares of New York Community Bank Corp to resume trading. Keep in mind, they were down more than 40% before they halted about an hour and a half, maybe almost 2 hours ago.
Hey, I want to go back to Michael McKee, international economics and policy correspondent standing by in Washington, D.C. Mike, we brought up Silicon Valley Bank and First Republic Bank because we're really almost at the one-year anniversaries of when that crisis happened. But a point that you continue to make is that this bank is very different from a couple of perspectives. It has to do with deposits, and then it also has to do with the different type of bank that is under New York Community Bank.
Yeah, New York Community Bank is a holding company now. They put together a series, I think, of about 9 community banks in the New York area that basically made loans to multifamily housing stock, the kind of thing that you see everywhere in New York, the brownstone kind of thing. And there have obviously been some issues with people being able to pay higher rates because the mortgage rates have gone up, that sort of thing. So they have a different kind of business model than most of the others. This is not a problem with deposits as SVB and Republic had. And we were talking earlier about how they've got a different setup because it's a bank holding company. Their deposit-taking institution is Flagstar Bank, and they haven't had a problem. They did years ago, but they haven't had a problem lately. And people don't connect the two, so there's no kind of run on the bank. And even if there was, The FDIC notes that most of their deposits are in the insured category, which was not true for SVB. Of course, they've raised the insurance level since SVB, but it doesn't seem like the ingredients are there for any kind of spreading fire.
All right, guys, we're going to leave it there. So much appreciation. Michael McKee, International Economics and Policy Correspondent at Bloomberg News, and Henrietta Treyz, Director of Economic Policy Research at Veda Partners. Just to rehash our top story, I would say, safe to say here, on this Wednesday, New York Community Bank Corp planning to announce an equity investment of more than $1 billion led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners, according to a spokesperson for the bank. Liberty will be investing $450 million, Hudson Bay $250 million, Reverence $200 million as part of the transaction. Also, NYCB will add new directors to its board, including Stephen Mnuchin and Joseph Otting, a former comptroller of the currency. The board of NYCB to be reduced to 9 members, and this transaction to close on or around March 11th. And a quick check in terms of shares of New York Community Bank still halted, but we are getting some more details here, and we'll continue to follow it as they cross the Bloomberg.
Yeah, New York Community Bank also to sell and issue shares at $2 per share and named Joseph Otting as the company's CEO. For more, let's bring in Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks. Herman, a lot has happened just in the moments that you sat down in our studio this afternoon. Is this infusion enough to save New York Community Bank?
Look, it does offer a lifeline for them, especially given the way the stock has traded over the past few days. That being said, the existing equity shareholders have been massively diluted. We're talking about a bank that has a bit over $1 billion in market cap, and they're raising over $1 billion with this equity infusion. So it's a tough pill to swallow for the shareholders that were riding it, but it does give them some time to shore up all the issues that we've talked about.
Explain what this does to existing shareholders of the bank. If you're offering new shares at $2 per share,
right,
and at a $1 billion value, what does it do to existing shareholders?
Right. So basically, your ownership of the earning stream is now down by 50%. Okay. So it's great for the company that it can still operate given all the uncertainty, but it's just a changing of the guard and changing of the shareholders.
Getting $1 billion lifeline, does that guarantee that this is a bank can continue to exist? And I don't want to be inflammatory. I want to be smart here. But $1 billion is a lot of money. Is that enough to fix the balance sheet and the risks that are out there?
It really depends on what's going to happen with the deposits. Right now, it should placate a lot of folks that were maybe a bit uncertain about what the path is ahead. But we've changed the management team yet again. There's a new CEO now with Joseph Otting. He's got a lot on his to-do list to shore up its capital even more, reduce their exposure to commercial real estate, and make sure their employees and customers
Bank of America's Borthwick says loan growth is off to a slow start in Q1.
Community Bank, Sandro Danello.
Right. So Sandro looks like he's out now, and Joseph Otting has been announced the new CEO. Sandro will remain as the non-executive chairman of the board.
Can I ask you, when we've talked about this before, when we initially got that headline, was it a couple of days ago or so, about material weaknesses, and we had this conversation that that's what a bank's supposed to do, right, in terms of risk oversight. So, I mean, do we know whether or not that they've fixed that problem? Does a cash infusion just fix that problem?
It doesn't. So that's also, I should have mentioned earlier, on the to-do list.
And forgive me, about 30 seconds here.
Sure. And so that's something, Joseph Otting was a former head of the OCC, and they're regulated by the OCC. So that should give them a good plan to go ahead and make sure their regulatory issues are dealt with in a proper manner.
We should also mention another headline crossing. Investors include Citadel Securities. So reaching out to a bunch of members of kind of the financial community.
That's right.
All right. What's next on your radar?
You know, this has taken up so much time. So we're just looking for the fallouts ahead. We've got a webinar going on tomorrow about the year after with SVB.
All right, going to look forward to that. Herman Chan, thank you so much. A member of our Bloomberg Intelligence team watching these regionals for us. Again, shares of NYCB not trading yet. This is Bloomberg Business Week.
We do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
It's Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment south of 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Let us update you and reset with what is happening with New York Community Bank. It plans to announce an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. Importantly, shares of NYCB do remain halted right now. NYCB, last trade that we've got on the Bloomberg, down 42.2%. Liberty, by the way, is going to invest $450 million, Hudson Bay $250 million, and Reverence $200 million, all a part of the transaction. And finally, one more important headline in connection with the deal: NYCB is adding new directors to its board, including Mnuchin and Joseph Otting, the former controller of the currency. Again, shares of NYCB halted right now, pending this breaking news. The Dow, the S&P, NASDAQ all higher on a Fed Wednesday. You heard Jay Powell live on Bloomberg Radio and Television, with the S&P up now by 0.5%, up 25. That is a gain to 51.04 on the S&P. We've got the Dow up 44, higher by 0.1%. NASDAQ Composite Index up 106, higher by 0.7%. 10-year 4.10%. The 2-year right now 4.55%. Spot gold higher by 0.6%, 21.41 the ounce. West Texas Intermediate crude oil up 1.3%, 79.18 a barrel. And Bitcoin keeps ripping higher, up 5.8%, 67,015 right now. Another volatile day for Bitcoin. Again, recapping: stocks higher, S&P up 26, up 0.5%. Shares of NYCB halted. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, of course, breaking down New York Community Bank car. We continue to watch for any additional headlines on this over $1 billion equity raise led by Stephen Mnuchin's firm. The stock still halted, so we'll continue to keep our eyes on the Bloomberg and bring them to you. In the meantime, as you know, a busy Wednesday. We are also talking about politics, which are front and center as well for investors, and what happened after Super Tuesday, which largely, Tim, went pretty much as many expected, but a rematch it looks like at this point.
Yeah, perhaps the only surprise was just how much Donald Trump Trump did trounce Nikki Haley. We should say that Haley exited the race for the GOP presidential nomination after a near sweep of Tuesday's races by Trump. She did not this morning endorse Trump in her remarks as she announced the end of her campaign. She did say that the former president would need to, quote, earn the votes of those in our party and beyond it who did not support him.
She did indeed. Well, with more on Super Tuesday and the aftermath, and what is next, one of the hosts of Balance of Power is also with us at this point, Kayleigh Lyons, joining us now from Washington, D.C. You know, Kayleigh, we talked with your partner in crime, Joe Matthew. It went really largely as expected, but I do love asking you guys who watch the ins and outs, who pick up on the nuances that maybe others don't. You know, what struck you following the results of last night's races and kind of where we go from here?
Well, a lot of this came down to the fact that Nikki Haley just wasn't able to win any single state other than Vermont, and of course the DC primary, which she had won the weekend before. That said, though, she was capturing a pretty significant share of voters. Sure, not 50% plus, which what was needed to take the delegates in the majority of these states, but still, we're talking 20 to 30% of the Republican primary electorate who was specifically not choosing Donald Trump, who for all intents and purposes in this contest is a Republican incumbent. And that, I think, is what is really the question as we now move forward into what frankly is a general election contest, a really long one between Trump and Biden, this rematch of 2020. Where do those voters go? The ones who were not choosing him in the primary race, how many of them that were backing Nikki Haley actually would vote for him in November? Would any of them vote for Biden, or will they be looking for option C, whatever that is? Maybe it's Robert F. Kennedy Jr., maybe it's no labels should they decide to run a unity ticket, but both Trump and Biden today are clearly going to be making a grab for those voters.
So I guess the question that I have is about the electorate in the primary, Kayleigh, versus the electorate in the general election. Because what we've learned in primaries in recent years is that we see, I don't want to call them extreme wings of the party, but we do see we don't necessarily see independents we don't really necessarily see their voices being reflected because this is our primary system. That's just the way it works. What about those independent voters come the general election who are not passionate about either candidate? What do we know from polling about where they go?
Yeah, well, Tim, it's interesting because some of these primaries that were in question yesterday were open or semi-open, which means those independent voters, even some Democrats, could actually show up and vote for a Republican candidate. A lot of those people, though, were more protest voting against Trump, according to the exit polls we have seen, than voting for Nikki Haley herself. But to your exact point, these are primary elections. These are some of the most engaged of the electorate that would show up at a random day. Engaged. It's a random day. Some of them were voting in January, February, early March, braving weather. These were people who were always going to get out and vote. The question is, how many more people could turn out and vote in November? When we are talking about a contest here, Trump, Biden, more than 70% of Americans say they don't want either of these candidates. Does that just mean a lot of people don't make any choice? They just sit at home? Or could they be looking at a ballot and not vote for someone for president, even if they're voting for their other elected representatives down the ballot? It could really be a turnout question we are dealing with here.
Kayleigh, but how much of the legal overhang and how the legal outcomes for the former president, Donald Trump, how that ends up playing out, how much of that will impact ultimately, how people vote come November?
Well, it could have a really big impact, theoretically. Our polling here at Bloomberg, together with Morning Consult in 7 key swing states, really the states that, because of the Electoral College, are probably going to end up deciding this election, show that a significant amount of those swing state voters would not vote for Donald Trump if he were to be convicted of a felony. And if you even look at some of the exit polling from Super Tuesday from the likes of NBC in states like North Carolina and Virginia, a significant chunk of Republican voters said they would think Trump would be disqualified from being president, from earning their vote, if he were, again, to be convicted of a felony. That said, it becomes a real question of whether or not that's going to happen. We know the trial in New York, the state trial Alvin Bragg has brought related to hush money payments paid to porn star Stormy Daniels, does begin at the end of this month, March 25th. So theoretically, that could be the only case to go forward, as we're still dealing with delays in the other cases. The Supreme Court isn't going to hear the immunity question that would allow the D.C. case here related to 2020 election interference to go forward until the end of April. And who knows when they could actually rule on that so a trial could be scheduled.
One thing I'm curious to Kaylee about is what's the role of Nikki Haley going forward? She's been very critical of both Donald Trump and Joe Biden. So I'm curious, what's the expectations around that? Does she just go kind of away quietly, or is there a role for her going forward?
Well, this is the question. Could she want to join a second Trump administration, considering it was under Trump that she served as ambassador to the United Nations? It was very telling that she did not come out and endorse him today. As Tim said, he said that he needs to earn the votes of those that were voting for her. She said she congratulates him and wishes him well, but came up short of actually giving her full-throated support for him. As for the role that she could play going forward in this contest, surely there is still an open question, even though she suggested she didn't want to join a no-labels ticket, so just watch and see if we get any news in that regard. But a lot of this is about her more distant political future, not necessarily for the rest of 2024, but 2028. Keeping in mind that she had been still pulling in millions of dollars from donors up until last night. That is money she could use in a future contest should she decide to throw her hat in the race again. And that was probably a lot of the calculation she was making when she decided to drop out today. Do I want to keep chugging along, knowing that the math is not going to work to actually secure the nomination, or do I want to take the name recognition I have already gotten and decide I'll try again next time?
Kaylee, even though it's looking more and more like we're going to see a repeat of what happened in 2020, when it comes to the general election, a lot has changed since 2020. You have President Trump's legal issues, some of which you've talked about, but you also have the court's ruling, the Supreme Court's ruling on Roe. And we know how that has affected the way that Republicans have done in special elections and in the midterms. And it wasn't good for Republicans. What do we know about the way that this could go in the general election if perhaps we start to see independent voters associate the change
Seeing
in
NYMEX
Roe
natural gas April futures settle at $1.92. Diesel April futures at $2.66. Gasoline April futures at $2.55. Finally, NYMEX WTI crude April futures settle at $79.13 a barrel, which is up 98 cents or 1.25%.
Abortion issue was a galvanizing force for Democrats. It is why they performed better in those midterm elections than was expected. Does it have the same potency as you get farther removed from the actual Dobbs decision? And she said it keeps coming back up to the forefront of public thought because of exactly like you were just mentioning, Tim. Alabama's Supreme Court making a decision about embryos frozen being children that impacts IVF and female reproductive rights in that regard. We keep seeing the aftermath of the Dobbs decision showing up in various states, which could keep it more forefront of mind. All that said, though, we don't see abortion ranking as highly in polling as other issues when it comes to what's on the mind of the electorate. Increasingly, not only is it the economy, it's also immigration and the border, which tends to not go as well in the Democratic direction. A lot more voters give more credit to Republicans in the former Trump administration on those issues. So it's kind of going to be a balancing act, but certainly the abortion issue is going to be incredibly important.
Kaylee, just got about a minute left here. Some well-known big-name GOP donors have been backing Nikki Haley. New York Times, we are also on this about Donald Trump and maybe Elon Musk meeting and so on and so forth, whether or not Elon Musk is going to help financially. What do we know about this, and what is really more importantly the financial fundraising that Donald Trump has done so far? Does he need some assistance? Does he need help from some of these big name donors?
Yeah. Well, on Elon Musk, Carol, he did post on X today that he's not going to be financially supporting either of these candidates, so maybe we take him out of the equation. And a lot of the other big money donors that threw money behind Haley are not shifting money to Trump, but have said they're going to be spending more down ballot in congressional races. So for Trump, it might still be trying to get those grassroots donations, but to your point on his financial difficulty here, he's going to need a lot of them because he's not just trying to finance a campaign. He also, to return to the legal question, is dealing with multi-front legal battles and multiple criminal and civil cases. Those attorneys are very expensive, and we have already seen a lot of the money his PACs have been raising go to paying those legal fees. So he kind of needs resources from two ends here to finance two different efforts when Joe Biden has a very large war chest at his disposal for this long general election contest, and he doesn't have to pay any lawyers.
All right, well, great to get the lowdown on this from you. Co-host of Balance of Power, Kaylee Lyons, joining us there in our D.C. bureau. Coming up next, we'll get back to New York Community Bank. The stock still halted, so continue to track that one for you on this Wednesday.
Hey, let's stay in Washington, D.C. for a check the latest world and national news. Amy Morris is in the Bloomberg 99.1 newsroom. Hey, Amy.
ATM Republican presidential candidate Nikki Haley, as you were just discussing, has ended her run for the White House.
I am filled with the gratitude for the outpouring of support we've received from all across our great country. But the time has now come to suspend my campaign.
And interestingly, she did not immediately endorse Donald Trump. However, the Washington Post reports Senate Minority Leader Mitch McConnell says he will endorse the former president after years of acrimony between the two men. Federal Reserve Chair Jay Powell reiterated to lawmakers the central bank is in no rush to cut interest rates until policymakers are convinced they have won their battle over inflation.
It will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured.
The remarks echoed a consistent message from the Fed that the economy and labor market are strong. Skincare companies shares after a report detailing how acne products, popular ones from several brands, may contain elevated levels of benzene, a chemical linked to cancer. New York Governor Kathy Hochul is deploying 750 National Guard officers into New York City's subway system after a rash of violent incidents reignited fresh concerns about safety and security. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
Top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at
Seeing Brent crude futures settle at $82.96 a barrel. That's up 92 cents or 1.12% on the session.
Partnership revenue.
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Shares of New York Community Bank do remain halted. They are down 42%. NYCB
This is following the New York Community Bancorp story. As we did see around half hour ago, New York Community Bancorp named ex-comptroller of currency Joseph Otting as their new CEO, and also mentioned that Mnuchin would give up to $1 billion in funding to the company. So that's NYCB raising more than $1 billion in equity led by Mnuchin's firm. So again, we did put out earlier from the Wall Street Journal that New York Community Bancorp was looking for an equity injection so that they could keep up.
Right now up by 0.4%. A Senate hearing was told this morning Boeing officials have failed to fully cooperate with government investigators looking into how a panel door blew off a Boeing 737 MAX jet in January. Boeing shares trading lower right now. We've got Boeing down by roughly 0.4%. Wall Street traders certainly breathing a sigh of relief. A Fed Wednesday with testimony today from Fed Chair Jay Powell. S&P up 23 right now. We're off session highs, but up 0.5%. The Dow up 44, up 0.1%. The NASDAQ Composite Index up 99 now, up by 0.6%. 10-year 4.10%. The 2-year 4.55%. Spot gold up 0.7%. 21.42 the ounce. While West Texas Intermediate crude rallying 1.1%. 79 even a barrel. Bitcoin right now up 5.8% at 66,990 on Bitcoin. Again, recapping a trading halt for NYCB shares or the S&P 500 index up 25 points, up 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Charlie reminding us that we are still waiting the resumption. Oh, it does look like it is.
Shares of New York Community Bank higher by 30% as we speak. This after Bloomberg News exclusively breaking the news that the company plans to announce an equity investment of more than $1 billion led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. According to a spokesperson for the bank.
Stock shooting up in a big way. All right, let's get to Bloomberg News U.S. Deals editor Matthew Monks. He and the team here, he's in studio, but breaking it. Matthew, you've been working this story. Tell us about it, what we know, and how it all came together.
So, I mean, I guess the story at the moment is this 30% spike in the stock, which we just saw in real time as we're watching it.
Hitting
so I guess,
a limit. It sounds like.
But yeah, this is really something. So so the first statement is yes. They achieved their immediate goal here, which is stabilizing things by bringing in some blue chip investors. Which my takeaway here is that is the main thing here. These guys know what they're doing. First of all, they're getting the equity, which whether they need that or not, I actually am not sure they need right now. They might need some regulatory capital down the road. But this is really about investor confidence in the firm as a going concern.
So New York Community Bancorp's now resumed trading after a halt, jumping 30% after again it was halted for volatility. And this has happened quite a few times today. today. Regional banks do seem to be affected by this New York Community Bancorp news. Again, just unsure how large it is in terms of the equity volatility that we did see earlier on this afternoon, but just following this story nonetheless.
Necessarily. So I think it's a safe kind of assumption or deduction that maybe this, one of the regulators may have been leaning on them to do this. I want to highlight that that is pure speculation on my part, and that's just because you don't see banks do such dramatic moves so quickly, or perhaps the other speculation, maybe this was a contingent. This is what the investors wanted something to happen. I don't know. It's all pure speculation, but it doesn't seem like you make that type of move without some kind of incentive.
As we said earlier, the stock was halted when it dove 47% at its lows today. It was halted again as it jumped 30%. Again, obviously the exchange monitoring some of these big moves here, the volatility that we are seeing just in one day in shares of New York Community Bancorp. You say that these are investors who know what they're doing. They're smart investors. Walk us through what they probably had to look at to feel confident about this investment.
So first of all, on the outside, they're seeing an opportunity to make a ton of money. This is a classic thing that you see during times of distress. You see private equity type investors go into banks. You saw this during the last financial crisis. You can make a lot of money investing in banks if you buy in at the right price. This guy Mnuchin, the former Treasury Secretary, he made a killing on IndyMac. It was an incredible deal. He got one of the first sweetheart deals. The dude knows what he's doing when it comes to banks. Like, seriously. So first of all, the number one thing is it's cheap. You're buying in cheap. And then let's look at New York Community Bancorp. All things considered, it's actually a really good bank. It's in New York City. Those multifamily apartment loans historically are bulletproof. You take a bank in New York City where you can get deposits. You have an asset that tends to hold up historically really well over time. On the outside of it, if you have the guts, it's a bit of a no-brainer decision.
$1 billion cash infusion, $1 billion equity investment. That's a lot of money, especially as Herman Chen noted, the market cap as of earlier today of the bank was just over $1.2 billion.
Yeah, but it's actually still quite small. I mean, but what is the asset size? It's about a $100 billion asset bank, right? And then it was the market cap was $7 billion, like 6 weeks ago. In banking, it's actually not that big, but where the market cap is now, it's sizable. But the main thing here, my takeaway, and this is me just talking from the seat of my pants, is it's about a sign of confidence. It's who these guys are more than anything.
And not just the seat of your pants, because you've got a quote in there from Stephen Mnuchin in your story. And what's interesting, you go back to March 1st, when we got this concern from New York Community Bancorp about material weaknesses from the company in terms of internal controls, not expected to impact 2023 results. That's March 1st. So here we are, they get the cash infusion, and you have Stephen Mnuchin saying very aware of their credit risk profile, but they've done the homework and they feel very confident, right, that this $1 billion will do the job.
That's right. And I'm assuming that they've had New York Community's troubles have been going on for a while now. This guy knows what he's doing. I mean, going back to the IndyMac thing where they had to sort out the mortgages, like, he knows what he's doing. I'm assuming that they've been
So UK's DMO's Thiemann says the latest gilts issuance remit took account of market discussions around falling demand for long-dated gilts. So UK's DMO's Thiemann adds that steeper yield curve might reflect changing demand for long-dated gilts.
Radio.
It's Bloomberg Business Week on this Wednesday afternoon. Hey, let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hey, Tim. Federal Reserve Chair Jerome Powell reiterating to lawmakers the U.S. Central Bank is in no rush to cut interest rates. He says they do have to get that timing just right.
Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
The remarks echoed a consistent message that policymakers have time to wait before cutting rates. Republican presidential candidate Nikki Haley has ended her run for the White House, indicating she will not immediately endorse Donald Trump.
I have always been a conservative Republican and always supported the Republican nominee. But on this question, as she did on so many others, Margaret Thatcher provided some good advice when she said, quote, "Never just follow the crowd. Always make up your own mind."
And she congratulated Donald Trump for being the likely nominee. Daylight saving time starts Sunday. We'll lose an hour of sleep, but we will spring forward. However, a new study of more than 200,000 people finds lack of sleep is linked to type 2 diabetes, increasing the risk 41% in people who only get 3 to 4 hours of sleep a night. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Carol and Tim.
All right, Amy Morris, thank you so much. Carol Master along with Tim Stanovic here on Bloomberg Business Week, and continuing to watch shares of New York Community Bancorp. Looks like they're now, I think they're still halted.
Yeah, still halted. They moved around a bit, but still, this is what happens when there's so much volume and there's a lot of volatility. Right now, they're up by 4% after being halted at 18% after being halted at more than 27% earlier. So market makers trying to do their job on the floor of the New York Stock Exchange.
Which is why the volatility, we see these trading pauses. Quite a swing, though, down 47% before we got the news of raising over $1 billion in equity from a group of investors at its highs today, just after the news. And once the stock resumed trading initially, it was up almost 37%. But as we said, a lot of volatility causing some halts as we continue to track it. But nonetheless, it seems like at this point, perhaps the next chapter being written as the company moves forward from some of the concerns, some of the overhang, and some of the exposure, and particularly in terms of New York real estate.
Yeah, and
residential real estate.
That group of investors, including Stephen Mnuchin's, Liberty Strategic Capital, Hudson Bay Capital, Reverence Capital Partners. Other news coming out today, the bank also naming Joseph Otting, the former comptroller of the currency, as its new CEO. Otting replaces Sandro Danello, who became CEO just a few days ago, Carol, back on February 29th. Danello does remain non-executive chair of the company.
All right, quick check on the KRE, the regional bank index that we like to keep a track on. It's also kind of moved a little bit lower, just call it flat, a little bit lower, down about 0.05%. It had rallied a little bit earlier after that news on New York Community Bancorp.
And we are seeing shares of New York Community Bank trading again. They did move briefly negative. Now they're actually just kind of flat, up about 0.4%, but investors trying to make sense of this, up about 2%.
So my gainers list for when we get to
so
it might be a little sketchy here.
Be flexible. That's all I'm going to say.
All right, a busy Wednesday. New York Community Bancorp, yes, up about 1.5% here. On a day when the S&P is up about 20, the NASDAQ is up about 79 points here. Coming up, we're going to continue to track New York Community Bancorp, see what it does in that last hour of trading. Also, get into a hidden crisis, one of the most read stories on the Bloomberg that is brewing when it comes to U.S. housing. Tim and I are coming back here on radio. This is Bloomberg.
This is Bloomberg.
The delicate dance of monetary policy, the fragility of the regional banking sector. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic.
It's good to be back, by the way.
Welcome back.
Houston was really fun, but not as fun as here, so take that in stride. All right, let's get to the market here. S&P up just barely here, up 0.4%. I gotta say, Jay Powell didn't really do much to move the market. You are getting a little bit of a bid into the bond market on the long end. You got yields down by about 4 basis points on the 10-year, but I don't want to call it a nothing burger because it was a something burger, but it wasn't a really tasty burger. Let's put it that way. Gold, though, however, making no bones about it, continuing to grind higher, over $2,100, and that really dovetails with Bitcoin's also high, and that's confusing. So is it actually a risk on feel? And the dollar just a little bit weaker, down 0.3%, the weaker currency in all the G10 space. But meh, I would say Powell, meh. What do you think?
Alex Seal is back, and of course, looking a gift horse in the mouth once again. Alex just got to take the rally for what it is. Maybe another potential record high. Not quite on the NASDAQ, which is trying to claw back those losses from that 2-day sell-off, but a big bounce off that 20-day moving average, which is a somewhat encouraging sign that, yes, Alex Seal, there is still life left in this rally after all. But Bloomberg strategist Van Raum, he says, beware of false prophets. The size and scope of the rally has already exceeded several key historical benchmarks that would indicate a reversal might be near. Now, he points out that when you look at the aggregate market capitalization of the NASDAQ composite, last week, that briefly surpassed the $27.5 trillion size of the U.S. economy in total. That's the highest ever valuation investors have ever assigned the tech sector outside of that pandemic-induced rebound. And while the setup into equity markets may still seem, well, a bit far from the bubblish territory that people are concerned about, the macro outlook may not be supportive of additional gains. That's according to UBS strategists. Their call right now is largely around concerns about weakening productivity worldwide, a pattern, if you remember, that spelled the end of the bull run back in the 1990s. Now, those strategists also say when you look at real disposable income growth, that is weak and it will get weaker. Variables that need to start looking up for that bull run to persist. We're going to get back to that story in a second, but we got to start off with the big story of the moment, and that is the drama surrounding the regional banks and New York Community Bank Corp, and really the lagged effects of last year's regional banking crisis. A 70+% drop in the shares of New York Community Bank Corp over the last 5 weeks alone. That drop apparently paused right now after a fund run by former Treasury Secretary Steve Mnuchin, Alex, rides in with a fresh injection of capital.
Yeah, you have to wonder, is this like a private bailout in essence at the end of the day, or a private takeover with like a little smidge left for regular shareholders? This chart just says it all, right? So here is last year, and here is the turmoil in late January that moved down in the stock. And this over here, this little tick higher here, doesn't really show the drama that has encapsulated the stock. It's now trading just above $3. It was halted for trading just about half an hour ago. It's whipping all over the place. Now it's trading at relatively flat levels. I guess the question is here, are we done? Are we there yet? Are there more shoes to drop? And then also trying to find out the why behind this. Is it really just about a rent-controlled issue for your community bank, or is it the regulation that's the problem, and kind of assessing that out as we go forward, Romain?
All right, well, let's get some insights out of Herman Chan, senior U.S. regional bank analyst over at Bloomberg Intelligence. And I'll pick up on her last question there, Herman, because we talk about the regulatory drama, but some of this might have sort of been inadvertently self-inflicted. Remember, they bought up some of those signature bank assets last year during the regional banking crisis. Was the purchase of those assets, did that kind of lead us to where we are today?
Yeah, it's the classic case of be careful what you wish for. They wanted to be in the big leagues, really gain some market share within the New York area, improve their commercial banking business with the signature assets. But it flipped them over the $100 billion asset mark, which introduced a lot more regulatory scrutiny, and now which now has forced them to cut their dividend and really tank the shares and required an equity injection, as we've seen today.
So is it over now with the equity injection?
It's a lifeline. I'm not sure we're out of the woods quite yet. We still don't know in terms of what their deposits have reacted over the past month or so. They unfortunately didn't give an update on their deposits with today's release.
So this gets to a weird question about what the ownership structure is. Right now, we're talking about Steve Mnuchin's Liberty Strategic Capital. They're putting up about $450 million. Hudson Bay Reference Capital, about $250 or so, right, a piece between the both of them, and then a few extra bucks coming in. That gets us to a $1 billion. Who owns this company now?
Right. Effectively, with the equity injection and also the warrants that the release noted, it seems to me that the investor group effectively controls the bank at this juncture, with existing shareholders massively diluted. So you saw the the CEO is Joseph Otting, who's part of the Investa Group. He's now leading the charge on that front. So it looks like they hold the cards.
All right, that'll be interesting. And of course, we should point out, still pending regulatory approval. But given the circumstances, that shouldn't be too hard to come by. Herman Chan, Senior U.S. Regional Bank Analyst at Bloomberg Intelligence. As Alex was saying, New York Community Bank Corp shares had been halted. They are reopened and now up roughly about 4%, but an incredibly volatile session that saw them down as much as 47% and up as much as 37%. Robert Socken joining us right now, Senior Global Economist over at Citi. And Rob, I do want to get your take here on this because I thought the regional banking crisis was over. What happened?
Yeah, this is a great question. Certainly what we're seeing is good news for the market, takes a risk out in that regional banking space. But more broadly, I think we're in a very
U.S. Energy Department announces the solicitation of approximately 3 million barrels of oil for delivery to the SPR in September.
Banking sector, and you saw wild moves in markets as people tried to assess, what would be the spillover to the broader economy and financial stability. I think we saw then it was concentrated in a few banks, and I think we're seeing that now as well, that this issue is really concentrated within New York Bank Corp. And more broadly, we think that the risks within commercial real estate are fairly modest. When we look at the risk profile, it's really concentrated within office space, a little bit in multifamily. Those office space loans that are riskiest are maybe things that are like in New York City or urban areas. Suburban banks loans are holding up much better. And those urban loans are more concentrated in big lenders who have put aside a fair amount of money to deal with bad loans in the future. So when we look at the risks here, it really seems pretty modest from an economy-wide perspective.
Do you expect that the testimony tomorrow from the Senate for Jay Powell to be any different based on that? Like, I can't imagine that certain senators are going to appreciate Mnuchin coming in and in essence scooping up the bank.
Yeah, I think, Powell is going to stick to his script that he stuck to today, probably avoid getting too much into that issue and really say something similar, I think, to what I echoed, is that the regional banking stresses look fairly contained. Powell talked about a bit of that recently, and then he'll pivot back to more broader issues on the economy and financial stability risks, which don't look large from that sector, and the economy is holding up fairly well.
This may be a dumb question, but why should I believe that it's contained? Not so much in the sense, I know everyone sort of looks back and they want to look for that sort of Lehman, Bear Stearns kind of contagion moment. I'm not saying we're going to do that, but if we are looking at a regional banking sector that is hobbled, and even those companies that are still healthy, but maybe don't have the confidence to extend lending, does that not have an economic impact?
Yeah, absolutely. And as you said, there are a lot of aspects of this space that we don't have great visibility into. So maybe we're just, underestimating the unknowns. But I think it's telling that markets have taken it much more in stride in terms of you haven't seen the spillovers to broader bank stocks or broader equities or the interest rate market when these stresses emerge this time around. But more to your point, I think the concern is that you're going to see an effect on credit and a continued tightening in lending standards. And we are seeing that. If you look at the Fed Senior Loan Office Survey, you've seen tightening in commercial real estate loans, but also all other types of bank credit. The economy's held up impressively well despite that tightening, but it is ongoing.
I love me the slews. They're like one of my favorite indicators. But also,
you just like saying slews.
I do just like saying slews.
It's a good term, yeah.
Okay, you kind of added me on that one. But it's interesting because it does feel like, and there was a great article in The Economist a long time ago about this, that regulation begets the crisis. So you have a regulation that's solving for a crisis, and then that regulation causes a problem. And to Romain's point, the big tipping point was when they scooped up assets and got over that threshold. Do you think there's going to be a lot of pushback in terms of the regulatory framework? And is that a good or bad thing?
Yeah, it's a great question. I think you saw some of that just more broadly from Chair Powell today in his testimony, that they are
Bank of Canada's Macklem says if core inflation measures stay where they are, then our forecasts for total inflation coming down probably aren't going to materialize, and we're going to be taking our rate decision one at a time. We will take our April decision in April, when we will have the benefit of more data. I continue to believe the risks to the inflation outlook are reasonably balanced. Macklem says we're seeing progress in the fight against inflation. We expect to see further progress. Inflation expectations have remained well anchored. That's certainly helping us get inflation back.
Senior global economist over at Citi, we really appreciate your time today. But I think it does raise the question, like if you just look at what happened to, say, Signature SVB, right? The economy did really well after that.
Yeah.
So maybe the stocks tanked, maybe sentiment wasn't great, but the economy held up, spending held up, incomes held up.
Yeah, it did, and we definitely did not get that worst case scenario, that contagion issue. But it raises a broader question, though, as to did regulators do enough to really sort of shore up the regional banking system? Because that was always the takeaway, right? It was kind of mission accomplished. Fed did what they needed to do. OCC did what they needed to do. And here we are a year later, basically on the one-year anniversary in a few days of the SVB collapse. And we're talking about another bank that needs to be effectively bailed out.
Right, but the regulation was what tipped them over in the first place.
Yeah.
Like if they hadn't lowered the bar for capital requirements, maybe it would have been okay. The rent-controlled properties would still have been bad, but we knew those laws changed back in 2019.
Well, why don't you think the government gave them a little bit more of a leash, though? I mean, knowing that they took on a burden that a lot of other people didn't want to take on, and I just kind of makes you wonder what was going on behind the scenes that they let them twist in the wind like this.
I don't know. I mean, you see JP Morgan, like they were able to be like, yeah, we'll give you that sweetheart deal because we really need you to bail me out here for assets from SVB, for example, but maybe not for, but maybe they would have. I don't know. Like maybe they would have jumped in if Mnuchin hadn't gotten together.
And it'll be interesting too about the ownership structure. I mean, the shares now reopening after being halted once again, now up 10% at $3.50 here on a day where it looked like they were headed to, well, they were below $2 and a lot more. All right, we're going to continue this conversation and so much more. We want to get down to Washington, D.C. right now, where our Balance of Power co-hosts are standing by with the chair of the SEC, Gary Gensler.
Greetings to our TV and radio audiences worldwide. I'm Joe Matthew alongside Kaylee Lyons in Washington, D.C., and a pleasure to welcome the chair of the Securities and Exchange Commission, Gary Gensler. Welcome back to our Washington bureau here at Bloomberg. It's good to see you today.
Great to be with both of you.
We're looking forward to a conversation today about the climate disclosure regulations that you're unveiling. I have to ask you first about New York Bancorp with some of the drama that we've seen over this past week amidst filing concerns about commercial real estate fallout. Are you monitoring this? Is there anything you can do to protect investors here?
Well, I think your viewers would understand that I'm in the role I'm in. I'm not going to comment on any one registrant or filer, but many banks are public companies. Those banks need to make sure that they make full, fair, and truthful disclosures to the public so that the public can make their investment decisions. I know we're going to be talking about climate, but it turns out it's connected. They need to make those disclosures that investors take investment decisions on, and make sure they have proper controls to make those disclosures. And but I don't have anything more on this one bank.
But just broadly, you're not concerned about systemic risk that might be emanating from commercial real estate?
Again, I'm not going to comment on one bank and so forth, but
broadly speaking.
Broadly, at the SEC, we are always monitoring markets for systemic risk. And the reason is because investors get harmed when one bank or one non-bank, it could be a bank, it could be a hedge fund, that fails and spills out into the market. I've been it ain't my first rodeo. I was even in the Clinton administration when long-term capital management failed. I was in the Obama administration when we were, cleaning up after the 2008 crisis. And it's always the American public, both investors and issuers, that get hurt. So at the SEC, we do monitor for systemic risk in our remit. And then we work with Secretary Yellen and Chair Powell and share our thoughts.
So to return to this question of disclosures, and this gets us to the news out of the SEC today, you have adopted now climate disclosure rules that have been significantly watered down from what was initially proposed. Scope 3 has been removed. For Scope 1 and 2, companies are essentially going to have to decide whether these climate risks are material to them. It's a pretty significant change. Why not repropose it by just adopting it today rather than opening it back up for comment? Have you opened the SEC up to more scrutiny and potentially more litigation that could come from this?
Well, let's just step back for your viewers just for a moment. What we have here is that today, literally hundreds, maybe 1,000 companies already today are making information about climate risk available to their investors. They're often doing it on the internet. There's sustainability reports and so forth. What we did today is we adopted a rule. We hadn't had a rule previously. And we said these disclosures need to be in your filings, in your annual reports, in your registration statements, if material. That's consistent with 5-7 decades of what we do. Materiality is the benchmark. investors get to make the investment decision based upon the material disclosures. In this case, climate risk is something investors want to know about. Hundreds of companies are already making such information available, but this will give it more reliability.
What's the cost involved here for companies that will be new to these disclosures? Typically, critics point to red tape beyond the politics here. Red tape and increased costs. You actually have a sense of this already for those that are disclosing, and I suspect from the comments that you received, particularly companies that are just making the threshold. I know you have carve-outs for some smaller publicly traded companies, but what would be the additional cost of this due diligence? Could you put a number on it?
So we lay this all out in this release. It's over 800 pages if you want to have some weekend reading. But we really based cost estimates on what commenters had given us. And you asked, we got 24,000 comments on this. And in terms, it depends on the issuer. If an issuer actually determined that it's not material to their investors, the cost would be probably quite low. But if they determine that, for instance, to inform their investors properly that greenhouse gas emissions are material, then the costs go up. But again, in the release, it was measured from a couple $100,000 per issuer to, I think, upwards to high six figures, but still in the six-figure range per issuer.
But leaving it up to the issuer to decide whether this is material, could this actually result in less disclosure around climate-related risks, not more, to avoid incurring some of those compliance costs?
Well, what's interesting is if you look at the Russell 1000, the top 1,000 companies, some surveys show that already 90% talk about climate somewhere, climate risk, and about 60% put out something about these so-called greenhouse gas emissions. And they're already doing it because investors want to get that information. But again, our history, our remit is about that which is material for investors. And that's what we're doing here. And we're climate risk agnostic. And if more companies make this disclosure or fewer make the disclosure, it's about materiality. But I would say what we did today is important because it will bring some consistency and it's a real rule.
Kaylee referenced the potential for legal action here. I suspect that you've
it's part of our democracy.
Put some time into this, indeed, and obviously legal challenges are already being planned. There are 9 states being led by West Virginia at this point we've heard about, but I wonder when you consider this, and you've been down this road before, is it governments, is it corporations, is it environmentalists who will bring the legal challenges to the SEC, or it is all of them?
I think that at the SEC, we endeavor to do things within the law and how the courts interpret the law. And so we take the economics into consideration. We take these 24,000 comments into consideration. And, of course, we take in another law that's not the securities law called the Administrative Procedures Act, how we do rule writing. I feel quite confident that we've done something within the congressional mandate. And why is that? It's because we're a disclosure agency, and that's all we're doing here. Companies already, 1,000-plus companies are already putting out some climate risk information. Investors are already making decisions, and we're saying grounded in materiality, put it in your filings, and be consistent with what you're doing.
On the subject of consistency, though, if you're a big multinational company, the SEC rules are now what they are. California's rules, Europe's rules are significantly stricter. How is this supposed to work if you have to answer to multiple jurisdictions?
Kaylee, it's a very good question. They have different authorities. We're a securities regulator. Europe passes a law through their European Parliament that had a goal to manage the environment. California, similarly, through their legislation. That's not what we do. We stay within our chalk lines, if I can use tennis.
staying within the SEC's chalk lines, despite conversations that you're having today around climate risk, you also, I'm sure, as a 5-member commission and as the staff are going to be considering in recent months, because you are facing a deadline coming up in May around a spot Ethereum ETF.
It is, Kaylee. You had to get your crypto question in. I do have to ask this question. Of course, we are now about 2 months into a world in which spot Bitcoin products exist. They have had incredible demand, more than $8 billion in inflows. Now the optimism is Ether spot ETFs are next. Do you not first have to settle the question as to whether Ether is a security or a commodity? Can you answer that first? Well, Kaylee, again, on any one of these crypto tokens, it's about the facts and circumstances as to whether the investing public is anticipating a profit based on the efforts of others. But we do have filings in front of us. I'm not going to comment. I will say this is a highly speculative asset class. One could just look at the volatility of Bitcoin in the last few days. And look, I grew up loving roller coasters. Maybe in my adult years I don't ride them as much, but you really should be conscious as the investing public that this is a bit of a roller coaster ride on these volatile assets. And then the question is how firm is the foundation of the, you get to the top of that hill, how's the foundation underneath it, and are there cash flows, or what's the use case? For thousands of these tokens, there's about 15 or 20,000 of them. They also may be securities because the investing public is relying on the efforts of some group of entrepreneurs in the middle of these projects.
And would you consider Ether as part of that group that may be securities?
I understand you're asking the question, but again, I'm going to defer on that question.
All right, SEC Chairman Gary Gensler, thank you so much, as always, for giving Bloomberg Television and Radio your time, and we'll send it back to you.
All right, thanks so much, guys. That was SEC Chair Gary Gensler with Kaylee Lyons and Joe Matthews. So really trying to ask him about those Ether ETFs, did not want to bite.
Yeah, I mean, look, he laid out his strategy, or at least articulated what he thinks is a strategy. I'm not sure that the market interprets it the same way. I'm not trying to show shade. I mean, it is what it is.
Yeah, but that's what happens when regulation is so far behind.
Yeah, but it's been a while. I mean, he came in, looks like he was ready to run through the wall, and it's been, what, almost 4 years now, coming on the 4-year mark.
It's not an SEC problem, but isn't this the problem with AI too? It's like, it's so far ahead of regulation that you need good regulation to move forward, but the flip side is going to take so long.
Yeah, the problem isn't with AI. The problem isn't with Ether or Bitcoin. The problem is with Washington.
Oh, that feels like a snap.
Maybe you can use AI to fix Washington. How about that?
Rule out inefficiencies and work productivity? What would that even look like? All right,
I don't know.
More ahead.
More than we can handle.
This is The Close on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
right, one of the top red stories in the terminal today, and it's a doozy. Acne products from several brands like Proactive, Target, and Clinique are alleged to contain elevated levels of benzene. That's a chemical linked to cancer, and this is according to Bloomberg reporting. And basically, reporting watchdog area called Valisor. I'm gonna pretend like I said that right. So Valisor does all this stuff on consumer goods to make sure they're safe, and they came across this. It's basically when you have ingredients in acne cream to sit in hot areas or hot weather for a long time, and I'm talking like really hot shower hot, they liquefy, and that's the ingredient that can cause cancer.
Right, so this is like the benzoyl peroxide, which in and of itself is safe, but it turns into benzene if you keep it in the trunk of your car in the middle of the summer like I do.
And also nice, which everyone does, but which is interesting too is that you can also inhale it. So even if you're not putting it on your face, it can come out of the tube and you can inhale it, which is also very dangerous.
Oh, is it? Oh.
Yes.
Okay, that I did not know. This is a serious issue, and I think there's a reason why it's basically the second most read story of the day on the Bloomberg. I think we all have some connection to this, whether it's in our past life or with our current children and things like that. So it's concerning. The first thing I did, like everyone else, is you start going through the cabinet in the bathroom and looking at the ingredients.
Yep. I was like, what do I give my daughter? Yes or no? Okay, we're safe. But 100%. And you look at some of the stocks, though. So Target is not really reacting here, but you have Teva Pharmaceutical, you have Estee Lauder, you have Reckitt Benckiser over in Europe. They close lower as well. They all have these kind of products, and they close material lower today. Yeah, and it raises the whole question of liability and whether this becomes one of those cases that winds its way through the system for like, a gazillion years. Yeah, pretty much. Good times. All right, well, coming up, it's the path to net zero may be paved with carbon offsets. Some think it's a dirty word, some like it, like Tom Montag. My conversation with him next. This is Bloomberg.
Ursula Hurley walked me through Terminal 5 at New York's John F. Kennedy Airport, where the complexity of the business she oversees really comes into focus.
We operate 1,000 flights a day, we serve over 100 destinations, and we transport about 40 million customers per year. When you think about a person booking a flight to getting them to their destination and home from their destination, it takes an army of things to go right.
There's change on the way at JFK. Ground has been broken on a new Terminal 6. It will connect with Terminal 5 and add capacity for up to 10 gates. JetBlue joins a consortium of companies managing the $4.2 billion project, helping define its design and guide its construction towards completion in 2028.
We're still in the design phase for Terminal 6, but we leverage what other airports have done and what we've seen throughout the world, quite frankly, and we're going to pick the best of everything to really elevate the game. And technology is going to be at the backbone of that journey. We want to be able to create and give customers experiences where they can self-serve as much as possible across the travel ribbon. So whether it's checking in, whether it's checking your bag, going through security, boarding a flight, we want everyone to be able to do that seamlessly and be able to do that with your own handheld technologies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Context changes everything.
Just about 3 p.m. here in a rainy New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. So some breaking news for you concerning Xcel Energy and the fire in Texas and the Panhandle. So apparently a toppled utility pole that Xcel has been told to preserve as potential evidence was inspected and marked with a, quote, do not climb symbol before the start of the fire. We're looking at a set of photos that were shared by a landowner whose ranch burned in the blaze that showed a downed pole wrapped in evidence tape sporting a silver inspection tag and a red metal caution tag. And I should point out, Romaine, that stock is down. Actually, it's flat right now, but at one point it did hit the lowest level since March of 2020. It does take a long time sometimes to find the cause of a fire, but we saw it with PG&E. We saw it in Hawaiian Electric, that utility poles and unsafe poles that just can't get fixed can be a cause of fire.
Yeah, absolutely. And this now opens up the litigation phase of this, or the potential litigation phase of this, even though we still have not determined exactly what the cause was.
All right, well, we're watching that stock as we head into the close. Earlier this week, I did attend BNEF's Barrel of Tomorrow Forum in Houston. Now, it was all about energy transition, technology, and innovation. It does dovetail the SEC conversation with the Xcel conversation. And in that, I caught up with Rubicon Carbon CEO Tom Montag, and he told me his company aims to be the, quote, the BlackRock of carbon credits. So basically, if you're a company, you can go to him and buy a suite of carbon credits. And I asked him about the importance of this voluntary carbon offset market.
I'll tell you a story that I read in the paper, and I assume it's true because I read it in the paper, and was about Lego. And Lego had been trying to fix their bricks so they didn't have a carbon footprint. And they did all this work around it, and they couldn't get them right. And they thought they had the right thing, and they tried 200 different types of materials, and they were using recycled, and then they realized the recycling and all that was using actually more carbon than that, and they just were going back to the brick. And I use that analogy because it's a toy company, and they make something that kids love, and I even use, but they just can't find the way to make it that way. But they're willing to invest the money and the time. And if your journey takes you someplace where it feels impossible to make that, it'd be great if you could offset what you are doing if your in-setting process doesn't get you there. And I think most companies would tell you that they don't think their in-setting properties get them there eventually. Even today on the panel, one of the participants said, we feel we're going to need to have offsets in 10 years or something like that. We have plenty to do now, but to really get there, we're going to need offsets to finish the journey.
And that's what I think is so interesting about Rubicon is you have all of it, right? You have the Wall Street investment experience, then you have a trading part, and then there's a scientist part. Having them all together, like that's what you're trying to create, like a measurable, liquid, legit, voluntary carbon market.
Yes.
How hard is that?
Hard.
Hard. Okay, what's the hardest part?
Well, the hard part is that there's been so much about it that saying how the bad things about it, and it's like saying if somebody always was looking at, oh, this stock's bad, that stock's bad, people wouldn't like the stock market so much, as opposed to saying, oh, this stock's good, that stock's good, this stock is good. And so there's just been this narrative around a market that, by the way, is confusing because if you look at the name of a project, you don't know what it is. You don't know exactly who approved that when, what standards it was under at what time. Does anybody really audit it? And so it is a voluntary market that hasn't matured yet to the point of a financial market mature. So it's difficult because people don't want to get caught up in something that turned out to be not so good.
And that brings to like two parts. One is you got to have the supply of the stuff, and then you got to have the buyers of the stuff. Let's go to the buyers first. Yep. Who's buying these carbon offsets today, and how do you expand that?
Well, we're trying to expand it.
Yep.
We try to expand it by giving them a diversified portfolio from a credible source, which is us, that owns these things, with a science team that looks at them and opines on the credibility of those. And we also offer a risk adjustment process. So we say, well, listen, all these projects have some leakage or something that doesn't make them be 100, most of them. And so it might be 1%, but it might be a lot, as you'd see in the Guardian article. So the idea, if you want a risk adjustment, our science team will risk adjust it. So we believe we're selling you a ton as a ton.
So you do Wall Street stuff with
we
the
do Wall
carbon
Street.
market.
Yeah, it was one of the first thing I brought up was like, we should do risk adjustment. It was like kind of securitization like.
The scientists are like, what?
Well, yeah, the scientists said this is not good. Oh, this project, we don't think it's so good. I go, well, what do you mean by not good? And let's just say, let's say they said, oh, I think it's 80% of what they said. I go, oh, because in Wall Street, there'll be a bond that might be, it's supposed to be 100, it's at 80, but people are buying it because they think the 80 actually could be 90. Like, so there's still value there. It might not be the 100, but there's value there, and we need to see all the value in these things and support them so they can achieve whatever value they can. And so that's how we came up with the risk adjustment.
What kind of companies are buying the credits right now?
Well, you see most of them in the press. You see mostly, well, not a lot. So if you look at it in the market last year, if you look at retirements in America, just the public retirements of offsets, 90% of them were done by 80 companies. Now, there was thousands of companies that did small amounts, but real volume was in the United States. And again, this is private. People do retire privately and publicly. Privately, we don't really know. Publicly, we do know. And that's like 90 to 100 companies. And you know some of them by just in the press.
So it's like oil and gas companies and tech companies, right? I mean, at the end of the day,
and some service companies.
And so, but it's basically high margin companies, right, that can afford to do that.
Yes.
How do you get lower margin companies like a chemical company or a refiner or something that needs to do it,
right,
but they can't afford it?
Right. Well, you have to you try to develop good projects that meet their price point. You know, the Bloomberg NEF, who's where we are now, does a lot of great research on the emissions of companies and the margins of those companies. And a lot of the big emitters are in very low margin businesses. So they can't afford to do these very expensive carbon removal projects. And so we're trying to work with them and develop projects that they can do that meet their qualifications. And it takes some time.
That was my interview with Tom Montag, Rubicon Carbon Services CEO. Romain, what's so interesting, not only is like, this is the second career for the Wall Street guy, Tom Montag, as voluntary carbon credits, like number one.
Yeah.
Number two, credits are a really dirty word in the industry, no pun intended. There's a verification issue, there's can you really trust them? There's lots of different problems, and he's genuinely trying to use Wall Street to fix that.
I mean, I'm always really down for any sort of financialization that sort of creates incentives to sort of address a lot of the social issues like climate change. But it raises the question, are these credits, are they having a meaningful impact?
And I think that that's what the science team is desperately trying to do. And I found it interesting because he was like, well, you can take a project, maybe 80% of it's good and 20% is bad. Why throw out the whole thing? Can't we just basically securitize it? Which is something that hasn't been done before within the market. And again, a lot of companies won't go anywhere near carbon offsets because of that exact issue. And there's no transparency with the price. So getting a price together is very tricky.
Oh gosh, yeah. I remember we were supposed to have that transparency. There was supposed to be a whole market that would be there and we could all just like we look on our Bloomberg terminals and see all the prices, and that never really materialized.
I think in theory.
And I feel like that was intentional.
Like 80 years ago, I mean, fast forward 80 years ago, you and I won't be here, but someone else will be. Maybe there will be a function on the terminal, but it's very hard to come to a price otherwise. He's very horrified that he won't be anchoring in 80 years.
Do you know something I don't?
Is that awkward?
Oh,
I'm so sorry.
I guess I've been watching.
We'll be robots.
I've been
we'll
watching too many sci-fi movies. I thought I could just freeze my head and I could come back and haunt everyone 100 years from now. All right. Coming up here, a closer look at the markets trying to rebound from the big losses of the past 2 days, and a big rebound right now for New York Community Bank Corp. Big swings in that stock for the troubled commercial real estate lender, but a lifeline from Steve Mnuchin, his fund, ponying up about $450 million, leading an effort overall to inject about $1 billion in equity capital. That conversation coming up next. This is The Close on the Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's time now for our stock of the hour, and for the third time in less than a week, we are taking a closer look at New York Community Bancorp. It is not the biggest gainer out there, but it is certainly the most volatile. Right now, up about 3% after multiple halts here on the day. The lesson that we learned today here is, yes, there is a lifeline, and it's going to come in the form of private capital. Abigail Doolittle joining us right now to talk a little bit more about this story. Steve Mnuchin leading basically a $1 billion capital injection here for this company. That's moving this stock. Is it having an effect on other regional lenders as well?
A huge effect. In fact, the headlines in terms of New York Community Bank before this headline around the equity raise, that they needed equity, that took the KRE, or the Community Bank, Regional Bank ETF down sharply. It was down more than 2%. What really stood at that time, out of 140 members, only 4 were higher. So we did have at that time NYCB down 45%, but a lot of the other stocks were down 4 or 5%. But as we've been talking about in recent days, because this has been such a story, the true contagion is probably less likely to be material, because the 25 biggest regional banks, they don't have so much exposure to commercial bank. They have a lot of liquidity. The smaller ones, yes, there's going to be some blow up, but it's interesting. I was speaking to a long-term veteran yesterday in the regional banking space, and he doesn't think that this is going to be like the SNL crisis. He doesn't think that there's going to be thousands or even dozens of banks affected. He thinks maybe a dozen or so. So relatively, on a fundamental standpoint, it seems more likely to be contained. And yet, from a stock perspective, stocks really reacting to the headlines. Now we have, if we take a look at the KRE, it's actually down ever so slightly. It had moved higher on the Mnuchin headlines, but we do have the bulk of this, and we had the bulk of the stocks after that, the Mnuchin equity raise rescue up. Right now, it's about a little bit more down.
Right. I mean, also, run on the bank is different than like what they're going through. I get that's the whole deposit, what Chan was talking about, right? Like, we have to see what their deposit base looks like before you draw any conclusion on that.
Yes.
Now, obviously, the Fed doesn't oversee like overall bank regulation, but Powell did comment on bank regulation today. What did we learn about that?
Yeah, it's really interesting. So, Fed Chair Jay Powell did comment before Congress in terms of Basel III, the end game, the idea that U.S. banks, the big banks, may need to see more regulation, that they may need to raise capital by about 19% 15% or so to bring more in standard with some of the other banks around the world, and that also other tougher regulations will need to be put in place. Now, tomorrow this could come up again, and of course, Senator Elizabeth Warren could make it pretty exciting, as there could be some fireworks, because apparently she is very supportive of this. There's going to be a period of time for commentary from the public, but the bottom line is it does seem like the capital requirements for the big banks at some point, we don't know the exact timeline, are going to be raised. But to your point, they do not, the Fed does not regulate, or Basel III, the regional banks. So a little bit of a separate animal, but it is interesting just to think that, you know, more regulation could be put into place.
All right, Abigail, thanks so much. Really appreciate it. I do think that this made tomorrow much more interesting with the Senate Banking Committee and Powell. Usually it's like a snooze fest, a repeat of the second day. I do not think, I think this will make it much more.
And today was kind of a snooze fest because we didn't have that news then, but of course that's going to be the big topic of conversation. Why wasn't this resolved, Alex Steele?
What do you mean?
The whole regional banking crisis.
I don't know. I'm not in charge. If I was in charge, obviously it'd be resolved.
They told me you were in charge. Was I misinformed?
Weird. I'm misinformed, yeah. All right, coming up, we're going to count you down to the closing bells. Sarah Hunt, partner and chief market strategist over at Alpine Saxon Woods, will be joining us for her take. This is The Close on Bloomberg.
Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Market on close imbalance, currently sitting at 1.3 billion to the sell side. Just waiting for the final orders before we call it. Market on close imbalance, 1.3 billion to the sell side.
This is the countdown to the close. Romaine Bostic alongside Alex Steele, and a lot of concern yesterday, Alex, with the market hitting some interesting lows and testing a lot of those key technical levels to the downside. But it looks like some of those technical levels maybe provided a little bit of support.
I know.
Yeah.
It's like you need a reason to sell, not a reason to buy anymore. I feel like the narrative has kind of switched. You're looking at the S&P up 0.5%, tech, the second best performing sector within that. I did also want to highlight gold and Bitcoin also doing really well. The KBW Bank Index is really not, but well off the lows after the New York Community Bank news came out earlier today.
Yeah, a big story here, and a week that, well, we were going to see a few catalysts. Of course, we had the big jobs report at the end of the week, a State of the Union speech by the president tomorrow, and Jay Powell on Capitol Hill for 2 straight days of testimony. Day 1 was today, and he largely stuck to the script, signaling that the strong U.S. economy will keep officials on hold for now.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. When we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Jay Powell there in Washington. Here in Studio 2 in New York is Sarah Hunt, partner and chief market strategist over at Alpine Saxon Woods, to help us count down to the closing bells. And I had to chuckle watching that. I mean, we had the little banner that said Jay Powell speaking earlier. I figure like you could have put any date of his testimony from any of the past testimonies from the last couple of years, and it would have been the same quotes here. A consistent message. Are people finally buying it?
Well, I think that, you know, the one thing you want to do is not say something that everybody goes, oh my goodness, I can't believe what they just said, right? So this is one of those opportunities where you reinforce what's been said and you try to make sure that anything that was off piece gets back into the fold, right? So I think that was today's.
Were you expecting more, not so much out of this particular testimony, but about the communication we're going to get out of the Fed heading into a meeting that's still, what, a week and a half or so away, with regards to whether they're going to communicate to this market, not just will they cut rates, but give them a better timetable as to when those rate cuts will come?
That has been the question all along, right? Because in the beginning of this year, we had a whole bunch of rate cuts priced into the market. Then they started coming off the table. Then the question is, when are we going to start? Are we going to start in May? Are we going to start in June? And now the question is, are we going to start? If the economic data continues to stay strong, it's going to be hard to say we have to cut rates for any reason. I think the market likes the economic data staying strong. Mm-hmm. And as long as inflation remains at somewhat at least quiescent and doesn't get worse, then I think that you've got a reasonable equity path, you know, X any exogenous variables otherwise.
Which was the question I was asking before. Like, I feel like the question now is like, when do you sell? Like, not when you buy, right? I mean, it feels like we're buying the dip, like this is the thing, like we're supportive of equities. Like, when do you sell equities now?
That's a tough question too, because what's going on right now in the backdrop is you've got the earnings coming through, which is where I think that you got the first quarter, the last couple of months, the market was acting much better. People expected the beginning of the year you might see a pullback because what if something didn't go well? The AI story is continuing to play out. People are talking about productivity in the right kind of ways. Most of the things seem to be going pretty well. So there's no real catalyst for that, except that there's a lot of other things. We've got an election coming. There's still problems going on in the Middle East. You could see as oil prices creep back up, that lead to inflation. That's going to make people concerned because if the Fed can't cut rates at all this year or starts to push that out, I think the market starts to get a little more volatile on the back of that.
So I'm looking now at a comp chart on a normalized basis of NASDAQ 100 and Apple back for the last 5 years. I don't think we've ever seen this kind of disconnect between NASDAQ 100 and Apple, now trading at 169. And I wonder at what point does Apple give tech the signal to sell, Or is Apple an idiosyncratic thing at this point? Is it a China story? Is it totally different now?
So I think the reason that it can be okay, as it were, that divergence, is because you can spin each of the divergences as a problem of their own making, or not their own making, of their own industry, right? So for Tesla, it's you've got to slow down in EVs. For Apple, you've got specific issues in China, and there's just always concern around Apple without the next greatest thing, what's going to happen. Meanwhile, they're building more support, more services revenue and everything else, but they're not in any kind of financial trouble. So the stocks that are doing well, which are the ones that are working on that AI framework on the Microsofts and on NVIDIA, those are continuing to do well, and the demand is still there. So that allows people to justify saying, okay, it doesn't matter that some of the Magnificent Seven are not acting as well as they did last year, because we have a chunk of them that are.
But what do when you look at the market in aggregate and you look at valuations, and I know everyone has their own sort of historical metric that they want to cherry pick to show whether the market's either undervalued or overvalued, but there has been a lot of hay here as to just how much tech stocks now sort of comprise in terms of market cap, sort of rivaling the size of the U.S. economy, and a lot of concerns here that, you know, the lack of growth. Yeah, sure, these companies aren't in trouble, but that growth that everyone got so dependent on, investors got so dependent on, that appears to be, if not gone, certainly waning.
In some of those stocks, it is. And I think that's why you're seeing Apple diverge so much right now from the NASDAQ. And that's been the big concern on some of the companies where that growth has slowed down, as opposed to others where that growth is either accelerating, or you can see a reason why you could imagine it will accelerate in the future. And I think, you know, Apple's made some interesting moves. Pulling back from the car and looking to focus in other ways tells you that they're looking at their own portfolio and saying, what is the next place for us to grow? So I think people will hang their hats on growth that could come, because they're just such cash-generating machines. And it's the companies that don't generate cash that have lofty valuations that are more tricky at this point than anything else. But the ones that are generating so much cash, it's hard not to take that cash generation as something that has a value.
So I'm a dividend guy. I make money, but I'm value, right? That's why I'm a dividend guy. When do you buy me?
Well, there's a difference between the dividend value trade and the companies that are adding dividends on a growth profile, because I think that's changed too. Capital allocation has changed. We look at a lot of capital allocators. We look at people who are both increasing their dividends and or buying back their stocks. And to the extent that you need to grow and have cash flow that allows you to do that, you can't do that in a vacuum. You can't just be stuck at the same dividend level forever, because then you're something like a value trap to some extent. And right now the market is not putting much of a value on that, to be, you know, cute with my words here. But you know what I mean. So I think that what you're looking for is somebody who can grow that dividend, even if the yield isn't fantastic right now. Can I grow it? Am I using my own cash generating to either buy my stock back or to increase that?
All right, Sarah, always great to see you. Sarah Hunt, partner and chief market strategist at Alpine Sachs & Woods, helping us count down to the closing bells here on this Wednesday afternoon, I believe, Alex Steele, if I got my days correct here. And you missed a pretty big sell-off yesterday. You're back today.
Big sell-off?
And the market, yes, it was big.
Big?
It was gigantic.
Okay. But say it was gigantic.
It was enormous.
We're now up, so it's still buy the dip. Even if it's this much or that much, it's still going to be a buy the dip situation.
They're clawing back a fraction of yesterday's losses, up about 0.5% on the S&P 500. Stick with us. Full coverage coming up right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. Joined now here in our television studio by Scarlett Fu, and in our radio booth with Carol Massar and Tim Stenovic, as we bring together our audiences across all of our Bloomberg platforms. Coming off a pretty big sell-off yesterday, Carol, and we're getting a modest rally today.
Yeah, a modest rally, bouncing around a little bit. Obviously, to some extent, maybe the market's following a little bit of what we got from Fed Chair Jay Powell, the New York Community Bancorp news as well. But something that has been solidly in the green for most of the day is the Philadelphia Semiconductor Index, still up about 2.4% here with just a few minutes to go in the Wednesday trade.
You mentioned Powell's testimony. That's where I want to go. I think investors are breathing a sigh of relief that Jay Powell really stuck down the middle. It wasn't a dove. He wasn't a hawk. I think it was Steve Matthews who said that some Fed chiefs like to refer to themselves as owls, or Fed speakers like to refer to themselves as owls, if we think about a different type of bird out there.
I wanted to call him a turducken because he kind of covered, he kind of keeps like down the middle.
That's a lot of testimony that he answered a lot of questions.
I think he wants to be invisible right now.
Well, he's got to get through tomorrow before he does
that. It looked like he was done by the end.
I just have to think, like, how much he must hate these things.
He doesn't show it, though. He doesn't show it.
Well, yeah, because getting paid, this is part of your job. Maybe it's a job that you like the least. But anyway, it was definitely a non-mover. When it came to, say, the bond market, you saw some buying on the back end, but that's, pretty much it.
It'll be interesting to see day 2 of his testimony on the Senate tomorrow, particularly in light of the news around New York Community Bank Corp. A lot of questions here about the health of the regional banking sector. As we get the closing bells here on this Wednesday afternoon, a big flip-flop from what we saw yesterday where everything looked dour and a lot of those moving averages were being tested to the downside. A big bounce off of those moving averages for all of the major indices. The Dow Jones Industrial Average up 76 points or 0.2%. The S&P 500 going to close higher, back above 5,100 or about 0.5% gain on the day. The NASDAQ back above 16,000 with a gain of about 92 points or 0.6%. And the Russell 2000, that is your relative laggard, only by a smidge, but it's up about 0.7% or 14 points.
I love that you said schmidge. All right, let's go to the S&P 500. 365 names, guys, to the upside here. 135 to the downside, and Scarlett, 3 unchanged.
And the leadership has really changed over the last couple of hours, too. Tech was the big gainer of the day, still up 0.9%, but you can see utilities move to the front there, up by 1%. It's green mainly when you look at the IMAP, and that's because the sectors that are in the red are pretty limited. We're talking about consumer discretionary, and that's on the back of Tesla, and communications services, which is down marginally off 0.2%.
All right, guys, let's get to some of the individual gainers. I was really nervous to put this in because I thought it was like kind of a sure thing, and then of course it was bouncing around and all the volatility. But New York Community Bank Corp, which was at its lows down 47%, it was halted. Then we got the news of this more than $1 billion equity investment, if you will, or cash infusion, I should say. And then you also had the stock up as much as 36%. Many different halts as the volatility, but the stock shares of New York Community Bank Corp finishing the day up about 7.5% here on the day. Do want to also mention CrowdStrike. That was definitely an outperformer, breaking the earnings last night at its highs, up almost 23%, finishing the day with a gain of just under 11%. So a top gainer in the NASDAQ 100, hitting a record high. The company reported, as you know, fourth quarter results better than expected, and it did give an optimistic outlook for the current period. I do want to point out several analysts raising their price targets on that name following their results. And then Dexcom, wanted to go there, finishing pretty much near its highs of the day, up just shy of 10% here. It was a top throughout the day. I think it's the #1 gainer right now in the S&P 500. Also a top gainer in the NASDAQ 100. Heavy volume. FDA giving clearance to its over-the-counter Stelo product, making it the first glucose biosensor cleared in the U.S. for use without a prescription. Wall Street cheering the announcement, with BTIG coming out saying the clearance came well ahead of their expectations. So again, Dexcom shares up specifically 9.8%.
All right, let's go get some of the decliners on the other side of the chart. Taking a look at shares of Apple, finishing down by 0.6%. It did fall slightly, though it was the worst performer on a points basis in the S&P 500, just given its size. We should note Apple shares falling to levels last seen October 27th. It is down around 14% since those December highs. Certainly one to watch there. Also, Brown-Forman, the worst performers on a percentage basis in the S&P 500 today, fell as much as 10.5% earlier in the session, finishing down by 7.3%. It's the company behind Jack Daniels and other liquors. It lowered its fiscal year projections for organic net sales growth and organic operating income growth. Shareholders reacting accordingly. And check out shares of Foot Locker today. Shares falling the most ever after the company pushed back a plan to expand its sales. Yeah, $9.5 billion by 2 years after a sluggish year last year. Shares finished the day down by 29.35%. The company also predicted adjusted earnings of $1.50 to $1.70 per share for this fiscal year. That did fall short of analyst estimates. And I did want to do a rare fourth decliner here, Alex. Xcel Energy. Shares of Xcel Energy hitting their lowest level since March of 2020. Only finished down 0.4%, but they did fall as much as 3.8% earlier in the session. This after Bloomberg News reported, after seeing photos, that the toppled utility pole that Xcel Energy had been asked to preserve as potential evidence was inspected and marked with a "do not climb" symbol before the start of the worst wildfire in Texas history. This is a stock that I talked about last week because there was a law firm that sent a letter to Excel requesting it hold onto the poll and said that tags had meant it had been flagged as needing attention during an inspection earlier this year. Excel shares down about 16% since February 28th.
Yeah, it's been a really brutal ride for Excel in relation to that. Guys, buying on the curve, pretty much. We're looking at a bull flattening, buying everywhere. You have more buying in the back end, though, so yields are a bit lower. About 45 basis points negative is the spread between the two. But, you know, we didn't learn that much from Powell. Steady she goes. I feel like the only thing we did learn is that inflation doesn't have to hit 2%, just the trajectory has to be towards 2%, which we already kind of knew, and we're doubling down on that.
Yeah, absolutely. Here, you know, it's interesting too. We talk about sort of, you know, Jay Powell on Capitol Hill and all the focus right now on economic conditions. But it's kind of interesting too. I mean, there are a couple big stories out there that I think gives us a little bit more insight into some of those conditions. And one stock that you didn't mention, I don't know if it was Carol's job or Tim's job, but you failed, was Vail Resorts here. They actually
MTN.
Oh, maybe I should have left New York.
So in 10 minutes time now at 4:15 p.m. Eastern Time, Minneapolis Fed President Cash Kari participates in a moderated discussion at the Wall Street Journal's CFO Network Summit. There is no text expected from Fed's Cash Kari, but again, there is a Q&A. The event details are pinned to Cash Kari's entry in the calendar for anybody interested.
2025 season pass pricing. I mean, the 2023 to 2024 season isn't even over yet, but the price is up about 8% year over year to $982. Granted, you can go to Beaver Creek, you can go to Whistler, you can go to Hunter, you can go to Mount Snow, but that's some pricing power there.
Well, yeah, but isn't this just like Wall Street goes to Vail? Right? I mean, it's not like but it's not like everyday people are going. We're not going.
I will say, Carol's heard this a million times, but I lived in Vail when they unveiled the Epic Pass. I spent 3 years after college there. This thing was revolutionary. Really? I mean, the cost of just a season pass in Vail, this was back in like, you know, the mid 2000s, like early 2000s. Okay. Was over $1,000 just for a season pass in Vail. When this Epic Pass came out and you could go ski at all the Vail Resorts mountains, which back then was about 6 or 7, it didn't include all the ones that Scarlett just mentioned. This was like $600 at the time. I mean, it completely changed the ski industry. You had Alterra come out and try to, you know, compete with it.
There's Icon Pass as well.
Exactly, the Icon Pass as well. This completely changed the ski industry, and it also changed the cash flow for these companies too, because if you buy a ski pass now and the snow isn't good next year, well then Vail Resorts ends up being the winner.
You know, one thing that I should mention is the analysts have noted that the Epic Pass price growth is still about 19% below the CPI growth since March of 2020. So they could have priced it even more aggressively.
Okay, fine. But there is some inflation there because people are willing to pay for it. Let's take the other side of it, shrinkflation. This has been all the talk over the last 2 days, guys, because Cookie Monster is weighing in on this. Cookie Monster
Wait, is he
tweeted.
A new Fed member?
What?
Is he a new Fed member?
Do I do Fed members?
No,
Did he do
just
I don't know.
go.
He says, me hate shrinkflation. Me cookies are getting smaller. Guess me going to have to eat double the cookies. But the whole point is that it's true. It's like,
excuse me? Can you say that again, Alex?
You do that
Can you say that again?
Well.
I could a lot better. I wasn't really committing to that point. But the idea of shrinkflation is you buy the same thing, but they put less stuff in the package because everything's just too expensive. So on the one hand, maybe you go to Vail and pay the pass, and on the other hand, your cookies is small.
Yeah, that's pretty depressing. No, we've all talked about that. I feel like this has been happening for some time. So yeah, that's kind of a bummer. First of all, you do a great Cookie Monster.
No, it could have been better. It could have been better.
Good.
I feel it the most with ice cream.
Shrinkflation and ice cream?
Shrinkflation and ice cream.
The one thing I will say...
It's no longer a pint of ice cream?
Exactly right, Scarlett.
I'm going to bring it back to the Fed.
Ounces.
Don't call me boring. But in the Beige Book, right, businesses found it harder to pass through higher costs to their customers who became increasingly sensitive to price changes. So I do wonder if maybe, I don't know, maybe this is some pushback just against the environment or a sign, or maybe we're pushing back against shrinkflation. Like
people are fed up, Carol.
We're fed up and we're not going to take it. So I'm out of here. I want cookies.
Carol wants cookies.
I always want cookies. All right, guys, that's a wrap. Our cross-platform, radio, TV, YouTube, and of course, Bloomberg Originals. We call it Beyond the Bell. We will see you again, same time, same place tomorrow.
All right, stick with us. Our coverage continues right here on Bloomberg Television. A conversation on AI coming up with Salesforce signing a pledge to maximize AI's benefits and mitigate the risk. At least that's how they're pitching it. We're going to have a conversation, with the woman behind that, Paula Goldman, Chief Ethical and Humane Use Officer at Salesforce, joining us in just a bit. Stick with us. This is A Close on Bloomberg.
times in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something.
In 5 minutes' time now at 4:15 p.m. Eastern Time, Minneapolis Fed President Cash Kari participates in a moderated discussion at the Wall Street Journal's CFO Summit. No text is expected from Fed's Cash Kari in just under 5 minutes' time. There will be a Q&A, so again, no text expected.
Smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Welcome back to The Close. Romaine Bostic alongside Scarlett Fu, and a closer look right now at personal finance and financial literacy. Earn Your Leisure is a media empire built with the goal of giving rise to undervalued and overlooked voices from the world of business, finance, and entrepreneurship. They want to get people who are generally risk-averse to, well, take a little bit more risk, or at least a leap into investing, and that includes a new partnership with schools here in New York, in the Bronx, in Harlem, incorporating financial literacy programs. Pleased to say that the co-founders of Earn Your Leisure join us in studio once again, Rashad Bilal and Troy Milling. It's great to see you both once again here.
Thank you. Thank you for having us. Appreciate it.
Let's start off with the partnership here in New York with those schools in Harlem and the Bronx. What exactly are you guys going to be doing?
So we developed a financial literacy curriculum, and we think that it's needed. If you think about New York City, the capital of capitalism, but financial literacy is not mandatory in schools. And the schools that we went to, there was no financial literacy 20 years ago, and there's no still financial literacy to this day. So we developed a financial literacy curriculum, 4 different modules, investing and financial literacy basics, entrepreneurship, savings, investing, credit, and we're working with some schools in New York to pilot it. I guess we can break that information here.
Yeah, break it. So
yeah, we got 10 schools in the Bronx.
10 schools in the Bronx.
We're gonna pilot it for this year, and then next year roll it out to hopefully the entire school district.
How old are these kids that are going to be using this?
Predominantly, it's going to be for high school students, which is kind of full circle. You know, we started teaching young adults about the importance of financial education, and so to come back, especially the Bronx.